yield curve is upward sloping, or if we have an upward sloping yield curve, we will be expecting that if it is upward sloping, then we're expecting that the forward rate will be above the spot rate, right? The forward rate will be above the spot rate. If it is downward sloping, we are expecting that the spot rate is going to be above the forward rate. So if it is flat curve, then the forward rate and the spot rate will be identical, right? It will be similar. Then determination of duration. I'm conversant of my time, so we're going together. The rule 9 is about determinants of duration. Duration increases when cash flows are received later. Anything that would delay cash flow or that will make the cash flow to be received later will increase the duration. So duration increases when maturity increases, when coupon decreases, or when yield is low. So the way you remember what we do, we say maturity, coupon, and yield, and we say L, 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 right? This is the way we put it simply for understanding. Maturity, coupon, and yield. When maturity is long, coupon is low, yield is low, duration is high. All this will result to high duration. And so this rule underpins most duration comparison questions, and that is how you look at them. And again, when question comes around interest rate sensitivity rule, it is also within the same thing. Higher duration, more price sensitivity to yield changes. So it follows the same pattern. If yield changes by the same amount, then higher duration bond will have larger percentage price change. That is the rule change, and that is related to the duration. The longer the maturity, the lower the coupon, the lower the yield, the higher the duration. And that is how you interpret this. If you know this, you are good around the questions and duration. The next one is the 10th rule, where we talk about embedded options and effective duration. As long as a bond has embedded option, then the duration is lower than the option-free bond. Well, if they have everything the same, the only difference is that one has embedded option and the other one does not have any embedded option, then the bond with embedded option will have lower duration than the option-free bond. That is another rule that you have to keep. And then the last set of the rules, rule 11 and rule 12. Rule 11, we talk about convexity inside. Positive convexity, we said convexity generally is good to have. So positive convexity benefits investors. Callable bonds, however, at times exhibit what we call negative convexity at a low interest rate environment, low interest rate. However, when you look at it, what we say is convexity affects price estimate more when yield changes are large. So with a small change in yield, duration can give us a good estimate of the price change. But when the change is large, when the interest rate change or the yield change is large, then convexity addition will need to come in to correct or to augment the calculations that we have from the duration side, and that would mean that convexity is augmented. And because convexity is always positive, so it helps the bond, even in both sides, whether it's a bull market or bearish market, it is helping the bond. If it is a bull market, convexity will increase the price effect. If it is a bearish market, convexity will reduce the impact on price when yield goes up. And that is the good thing around bond having a positive convexity. Rule 12, and the last one here, is the credit and securitization risk logic. And so here we say that credit spreads will be different depending on the economic situation. If we have economic contraction, so during a bad time, right, when we have economic contraction, what we see is that the spread will widen. When we have economic expansion, what we need to see, good time, if the time is good, we'll see that the spreads will be tightening. So you see spreads in one side, you see spreads increasing. In the other side, you see spread tightening. Good news will be that spread will tighten. Bad news, spread will widen. That's how you take this. Also, we have this loss priority follows seniority. So when there is a loss, it follows this seniority of claim. So secured debt first, then senior unsecured, then subordinated debt, then equity will be the last to take the pie as what is remaining. So if two bonds are otherwise equal, then the one with higher seniority will offer lower yield. And again, I'm tying this to the other rule about the compensation. So whoever is gaining something is giving out something. If you are gaining security, then you give out yield. And that is how these rules apply. And I want you to hold it. For MBS, ABS, we just look at the prepayment changes timing risks, not total cash. What we are saying is that what prepayment does is that it changes the timing risks, that in when the thing comes, not about the total cash flow. The prepayment does not affect the total cash flow. Total cash flow is supposed to be the same. However, when you have a falling rate, during periods when interest rates are down, periods of falling interest rate, prepayment tends to be higher. So people prepare when the rates are low relative to where they're coming from. And so you see that will lead to what we call contraction risks. And then if contraction risk just means that the life of the ABS will be reduced, sort of. The risks of the life of the ABS being reduced. Then rising rates will also affect when you have high interest rates, then it means prepayment will be low. You don't expect so much prepayment, and it may lead to extension risks, meaning the life of the MBS or ABS may be extended beyond what was estimated. And then the last one I want to add there is just around the covered bond, the fact that the covered bond has two recourses, right? There's a recourse, one to the pool of asset covering the bonds, but then there is another recourse to the issuer. So I've conveniently covered the rules. Those are the 12 rules. I want you to make sure you have a good grasp on the rule. I know I'm fast. That is the logic. I'm supposed to be fast to cover all this. However, what I want you to do now is to ensure that when you get the recording, you go back and look at these things. And then I also want these slides to be shared because we have a lot of questions in there that you need to now go and start looking at the questions yourself. So let's kick in. We have spent about more than 30 minutes on this preliminary and providing the basis. Let's kick in and then start going through it. Another thing I want to say, and I usually say this before we go on, is the fact that you need to have your BA2, you need to have your approved calculator. Let me just put it that way. I use Texas Instruments, but whichever one you use, you need to have your calculator ready. You can't do and enjoy fixed income without a calculator. So please have your calculator ready, and then we'll enjoy it. And then again, I always say that whatever the calculator can do for you, allow the calculator to do it for you, so that you get the benefit of your investment. You know, this calculator that I have, my own now, I bought it. It's a long time I bought it, but when I bought it, it was the most expensive investment in a calculator that I've done in my life. So every day I tell it that it must bring out that money. So as long as they say calculator can do something, I will just hit it and say, calculator, give me the answer. So it gets to a level where when you say 13 plus 5, 15 and 16 and 17, I will just bring out calculator and start answering. So the idea generally is that please just allow the calculator to do whatever the calculator can do. And that is how I'm going to be tackling this. Some areas I will show you what we can do with the calculators, and I can show you what we can solve with the calculator, so that you just be aware that yes, these things can be done. I'm using I'm using the Texas Instrument, the BA2, and I'm using the professional again, so that some of you, when I say, some of you, okay, I saw number 10, they said I should, so I'm just even looking at so some of you know when I said talk about the calculator, you think it's a small calculator. It's a big one. It's a Texas Instrument professional that I'm using. So because I said because I talk about the investment, you are asking. Is BA2 plus I'm using Texas Instrument, and I'm using the professional. So because when we get to a place where I'll be calculating duration, and I will say use the calculator to calculate, somebody will say he has stuck somewhere. So somebody said I should talk about number 10. Sorry, I know we don't have so much time, but yes, it's good to look at some things. Let me see number 10. Oh, number 10 is just saying that the bond, any bond that has, when we look at duration is the sensitivity of the bond's price to a change in interest rate or change in yield. Now, what we are saying is, if a bond has embedded option, that sensitivity is lower than an otherwise identical option-free bond. That is because for a callable bond, when you look at a callable bond at a low interest rate, the issuer may likely call the bond, and so the price does not respond so well. And so a putable bond at a high interest rate, the investor may likely put the bond, and so the price does not also respond so well in that area. So overall, when you put it together, you see that if a bond has embedded option, this responsiveness, the degree of responsiveness, now I'm looking like somebody who's talking about elasticity, the degree of responsiveness is lower, and that is how it is. Just to make sure that I'm going with my people. All right, so let's move on. So the next thing I want to talk about is the area of I want us to look at this area, and let's start by looking at the area of fixed income securities defining elements. So now it's like we have started proper. So I'm going to categorize the readings. So I'm taking reading 49 to 50 all together, and I call them the defining the elements. So it is going to be talking about these things that you see. However, I have this slide where I just summarize some of these things before we go looking at the questions. So the way we go is that when I finish this high-level summary, I'll bring out the questions, give you a second or two to answer, and then I'll provide the answer, and then we move. We'll cover some questions, not everything. So one, we are saying, in this area, I want you to master maturity, master what the bond features are. These 5 bond features are compulsorily present in every bond: maturity, coupon type, par, seniority, and security, and currency. These are in all bonds. And then the importance of this is that these things define some different things that we have in the market. Let me just take one and then talk about maturity. Maturity of the bond, of course, it tells us how long the bond will be alive for. But then maturity of the bond determines, again, one crucial thing that maturity of the bond determines for us is it determines whether an instrument can be called a money market instrument or a capital market instrument. And this is where I will start asking you my own question. Capital market instruments are instruments with maturity of 1 year, more than 1 year. So anything above 1 year is a capital market instrument. And money market instruments are instruments that are lower than 1 year and below. So any instrument with a maturity of 1 year and below, we classify that as a money market instrument. Now, if you have that classification and you understand that classification properly, then I will ask you my question and say that if I have a bond that was issued like 4.5 years ago, it was a 5-year bond issued 4.5 years ago, and then now the bond is having only 6 months to maturity. Will that bond now be classified as money market or capital market? So you can type it in, and I'm following. Money market, capital market, let it come. Sharply. Don't waste my time. Money market is just 6 months to maturity now. Is it money market, capital market, right? Money market, capital market, money market, capital market. So good. Thank you for participating. Thank you for coming in. So the idea is that as long as the name, what defines whether an instrument is money market or capital market is the maturity at issuance. Please note this. It is about maturity at issuance, right? It's maturity at issuance. So when you start at the beginning and you say this is a capital market instrument, it remains in capital market forever. When they give you your name, they don't want you to change your name. They just, when you answer that name, answer it and go with it. Up to the grade level, it will just be the same name. So that's what they are saying. that, so it is actually going to be classified as a capital market instrument as long as there is there is a classification from the beginning at issuance, then it remains a capital market instrument. So those kind of things, we'll just do one or two questions and then hopefully it will clear something. So that is the importance of all these things that you are seeing: coupon type, par value, seniority, currency. You know, we talked about so much in this area. Around currency, let me ask you.
Musa, we can't hear you. Please hold on. I believe it's network issue. We'll be back soon.
What happened? Did I miss my people or my people missed me? Are we back? Can you see my screen?
Yes.
All right. Yes. So we're back. Thank you. So let's go on. So I was saying that I just wanted to add something around the currency. I'm still looking at my time. So on the currency, I'm saying if Nigeria issued a bond and then the bond is in US dollar and then the Central Bank of Nigeria is increasing interest rate, will the impact reduce? So increase in interest rate, will it reduce the price of the bond? So just type your answer, yes or no. Yes or no? Just type your answer, yes or no. Just type your answer, yes or no. Just type your answer, yes or no. Will it increase? So CBN, Nigeria issued a dollar bond. CBN is increasing interest rate. Is the price of the bond going to be lower? It's as in, the higher the price, is it, interest rate up, the price of the bond goes down. If Nigeria is increasing the interest rate, it's not going to be affecting the. I see that some people don't have confidence. When you don't have confidence, even to take decision will be a problem. You will just be, whether is it yes or no, and then you see somebody typing yes and no at the same time. That is even somebody who has a bit level of conviction. So, so yes, it will not affect the dollar because it is the currency of issuance, the interest rate of the currency of issuance that affects the bond. So Nigeria or central bank's increasing rate in Nigeria will affect the Naira bond issuances. But then the US dollar bonds will be affected by the dollar rate increased by the Fed or something like that. So that is how we look at these things. Quickly, I want you to also know things around the bond indenture, the legal contract that govern the bond relationship. So I want you to look at it, the trustee, the covenants, the obligation. These are things that I want you to master and be able to talk about. The negative and positive and positive affirmative covenants. These are things that you want to look at and be able to know. Just know that affirmative covenants are covenants that are just administrative in nature. Negative covenants are those ones that are more restrictive. So just look at these things and make sure you have a good grasp on. Embedded option, call and put option. Yes, we have discussed this. Cash flow structure, bullet versus amortizing, very important. When you have a amortizing bond, what amortizing is doing is that it reduces the credit risk, but the investment risk is higher because you are getting more money at the beginning, and then of course, usually you have money to invest and you are investing it at a lower rate. Deferred coupon, step of inverse floater, we need to know this. Then we have what we call the internal versus external credit enhancements. What are they? And then you need to say why they are necessary. So let's start looking at the questions. I'll just bring out a question, give you like this one now. I will give you 1 second or two so that you attempt it, and then we move on. Make sure you put it. Don't. What's the answer? Just keep answering. Yeah, keep answering. Keep answering. Yes. So, yes. Yes. Which type of fixed income security is most likely to have coupon payment that resets periodically? And then you see how CFA, how easy CFA is. Some people will just be enjoying and they will say, yeah, CFA. So this is truly how the thing is. You go to the whole, you see question, you answer, and you move. Please, when you start seeing these kind of questions that are coming, and if they are cheap questions for you and you are happy, please be thanking God from the beginning. Otherwise, when you get to a level where the difficult one will come and start looking at you, will not have the grace to be able to solve it. So when you see them coming, when you see the first one come like this, don't frown your face and pretend as if it's difficult. Just answer it and move on. And then God will continue to bless you and bless you continuously. Like I said, I'm having representative questions, so it's not every question that I'm going to give you, but then some of the questions that I selected are good for you. So this one now, number 6. You know, it will get to a level where when you get to the hall, you'll be hearing my voice. I will be telling you some of these things that you remember. And it will just be telling you, yeah, this man said I should go ahead, I should go on. All right, good. So you see how good you are. At the end of the day, just be taking note of all those good things that you have been doing. Which type of bond is most likely to be preferred by the investor in a falling interest rate environment? If interest rate is going down, that is what they are saying, in a falling interest rate environment. What it means is that I will want to float the floating. So floating is responding as interest rate is moving, it is moving with it. So when you have a floating rate note, it means that it has put a floor beyond which your coupon will not go beyond. So it's a benefit that you need to be aware of. Number 7. Number 7. You see, my people are just hitting it. Again, don't forget to be thanking God. Don't forget to be thanking God as you are hitting it and hitting it. Which of the following is least likely to be a form of internal credit enhancement associated with? So it's saying a form of internal. Debt subordination will be internal, debt over collateralization will be internal. So letter of credit is external. Another external credit, external one will be the guarantee that you get from a bank. All those ones will be external enhancements, external enhancement. So this is how it is. So just keep going and then keep thanking God that you are having them you are scoring plenty. Which one is this? Compared to a bullet bond. So this is how we move. Compared to a bullet bond, an otherwise identical amortizing bond will most likely have what? Lower credit risks, lower reinvestment risks, lower near-term cash flows. What is the answer? Keep it coming. Keep it coming. Keep it coming. Don't worry, you can always change your mind. You can always change your mind. Sometimes you want to put B and then you go A and then you can change your mind. I'm seeing you. Yeah. Good. Kelea. Yes, Precious, Teniola, Ahmed. All right, so I know that we are good. The answer is A, and so that's most likely will have a lower credit risk. Lower credit risk because for bullet, you have to wait to the end to collect. For amortizing bond, you are collecting something, it's reducing the debt as it moves in towards maturity. Larger periodic payments, however, will now increase reinvestment risks. That is what you have. It will now be increasing reinvestment risks for you. Let me give you another one. And this, I will use this question to, yes, I think I will use this question to also explain some things around that. So a bond issued by a South African company denominated in British pounds sold exclusively to investors who are legally domiciled in the United Kingdom would most likely be classified as what? Is it a foreign bond? Is it a domestic bond? Or is it a Euro bond? Pam, pam, your time starts now. All right. So this one is like, so this is a foreign bond, right? How do I know that it is a foreign bond? So the way I look at it is that I will just ask some questions. Is the issuer local or foreign? Which market is the bond issued in? What currency is used? Is it issued in one market or multiple markets simultaneously? Those questions that I asked now, you remember the questions? Is the issuer local or foreign? Issuer. Is the issuer local or foreign? That is one question I'm asking. The second question is, which market is the bond issued in? Which market? Which market is the bond issued in? The next question I'm asking, what is the currency? What is the currency of issue? The next question I'm asking, is it issued in one market or multiple market? One or multiple market? I want to ask, is it issued in one market or multiple market? Then the last, and when I say that question I'm asking is it issued in one market or multiple market simultaneously at the same time? That is what I'm asking in this one. So maybe I should just write simultaneously so that it will make some difference. Now, then the way we look at it, you now say, okay, if we have a local issuer plus a local market, local issuer plus a local market, right? If you have a local issuer plus a local market plus a local currency, then what I have automatically is a domestic bond. If I have a foreign issuer in a local market, in a local currency, then I have a foreign bond. Like in this case, this is a foreign bond. If I have that, then if the issue is I talk about local, so I said local foreign issuer. I talk about foreign issuer, local market, and local currency, right? So that is a foreign. If the bond is issued outside any single country's market, also in a foreign currency, then it is Euro bond. If the bond is issued outside any single country's market, so we'll call it a Euro bond market, outside any single country's market, plus the currency, it is in a foreign currency, then we call it a Euro bond. If we have the same Euro bond offered at the same time in multiple markets, the same bond, but it's offered in multiple markets, then you now have what we call the global bond. So this is definitional. This is just for you to just have a good grasp around the definition of terms when it comes, and you remember to put it down. So let's move on. This I wanted to do, but then this one does not have. I'm just okay. I think I know why this is here. So this is here just because we need to know how to use your calculator to get this using the amortization table. So second function amortization. But before then, you need to input the PV. So calculate the periodic payment and interest and principal components of the first payment for a fully amortizing bond based on the following. So you have a loan amount, you have interest, you have annual interest rate 2.75. You have again, you have loan amount 10 semi-annual period, so the 5-year. So in this case, you need to put 10 million in your as present value. You need your IY. You need to put IY will be 2.75 divided by 2, right? And your N here will be 10. And then what you are doing is you are computing the payment. So you compute payment first. So when you compute payment, it will give it to you. Now, to know which part of the payment is interest, which part of the payment, you now go to another function where you take your P1, P2, and then you'll be changing those things as they move. Unfortunately, I may not do that here, but then I am telling you that it's just to show you that it is something the calculator can actually do for you. So we can take it up. So you can actually be able to get the payments from the calculator. Yeah. All right. So let's move to the next one. Just ensure. I think I will just move so that I don't waste so much of your time, because so you can see that I actually have so many questions. Please be able to find time to look at them and be able to solve them. They are good questions. They are carefully selected. We say, as we usually say, they are carefully selected. Okay, let's do this. Let's do this. Question 11. What's the answer? An analyst is reviewing a corporate bond with the following structure. So look at the structure. Which type of bond is this? Okay. Ahmad Ayode. I also have I have Precious Olutumiri. Okay, Ahmed is changing his mind because I mentioned his name. He's changing his mind. Patience, you want to change your mind. If you don't change your mind, it's still okay. All right, guys. So that is fine. That is fine. This is an example of an inverse floater. This is an example of an inverse floater. An inverse floater are floating rate notes that have coupon rates that vary inversely to a reference rate. The coupon rates, they vary inversely to a reference rate. The coupon formula is usually like saying the coupon will be is designed in such a way that when interest rate goes up, the coupon rate at the end of the day will go down. That is how it is designed to be. When interest rate increase, when the reference rate is high, the coupon rate is low, and that is why it is inverse. All right. Yeah. Okay. So let's go to another section. We have tried in that area. You'll see that we spent 1 hour, but a very good 1 hour, trying to give us a summary of all the discussions. So now it's just questions that we're answering. Now we look at the second area. I classify them as a block, reading 51 to 53. It is about fixed income issuance and trading. It is about market for corporate issuers and also market for government issuers. So I block all this, and these are the questions that we're going to be looking at. What is important for me in this for you, please make sure you have a good grasp around money market and capital market. Also domestic versus foreign versus Eurobond. We have done this, and we have explained this, and it's tested repeatedly. So please be able to say, I have a good grasp on this. Then we have primary and secondary market differences, and then versus equity. Just make sure you understand that. But especially, again, please, the repo mechanics is very important. Differentiate between repo and reverse repo, and looking at the perspective, and also talk to us about the reason why, what is driving the repo margin and repo rate, right? Now, the rule that I will say here is that anything that increases the transaction, so please get this as a general rule, so that sometimes if you get confused, you just use the general rules to help you. Anything that increases the risk of the transaction will increase the repo margin, and it will increase the repo rate. So those factors that increase the risk of the transaction, for example, we say when the tenure of the transaction is longer, the repo margin will also be higher. So that is how this thing is. when the transaction is collateralized by special securities, so those securities that are in high demand, when it's collateralized by those kind of securities that are in high demand, you see that the repo margin will be lower, or the repo rate will be lower. So you can see how generally, if I just take it and just say that when the risk of the transaction is reduced, it reduces the repo margin. When the risk of the transaction is increased, it increases the repo margin. The same thing is also affecting some of the factors will also affect repo rate as well. Be able to talk to us about shelf registration versus private placement versus underwritten offering, all those discussions. And then liquidity concepts, the on the run, off the run. If I have a bond that is issued on the run sovereigns are those ones that are issued now. Then off the run, they are seasoned. They are the ones that have stayed for some time. You know, they have seen their own seasons. Like, you remember, even me, that you are seeing me here now. Before, I used to be on the run, right? Before, I used to be on the run. You just you see me and you see on the run, but of course, now I become off the run. And you now, it's your time now, you are on the run. And then you on time, we're praying for you that you too will one day become what? Off the run. You'll now be reigning. Other people will be reigning, and then you'll be seeing them and then following. So when you are on the run, because everybody wants to catch the on the run, everybody wants to move towards on the run, the yields are tighter, the spreads are tighter. That is how it works. However, when when it is however, when it is seasoned, when it has stayed a long time, it has seen so many things, right? Nobody wants to be associated with that, and so the spread becomes wider, and that is how I want you to remember this on the run and off the run question. So let's hit the market. Let's hit the market. And pick, let's hit the market and so just pick one or two and see how you'll be able to answer. New issuers for which investors are likely to require collateral due to more volatile operating cash flows are best categorized as what? This kind of questions, by looking at it, you know the answer. But then it's a CFA question. Some of them, because you have prayed so hard, God will just give it to you so that you take it and praise Him the more. Like I said, the more you praise, the more you get. All right. So let's not waste time. It is the high yield issuers. High yield issuers include new issuers. These are the ones that investors are more likely to require collateral due to less stable operating cash flows. So they need to give them collateral to augment that. If you talk about investment grade issuers, these are people whose credit quality are that of top notch. So they don't look at that. But then investment grade issuers that are falling, that now have their credit rating deteriorate, it's what comes down to become falling angels. You know, that is like a rich man that becomes poor. That is what falling angels mean. You see, there are two things. I pity that if I have two people, then to pity, I have two people. One is a rich, one is somebody who is very rich and becomes poor, and the other one is a poor man that from the original state has been in that particular state. I'll pity the rich man more, because coming down, experiencing that thing, and then coming down to experience what we are experiencing this other side, it's not easy. So that is why fallen angels are things that we pity more than the non-investment grade, those ones that are already there and waiting. So this is just for you to just keep some things in mind. Again, I'm just looking for a question that can give us something. Yes, can we attempt this? ABL Limited is an Australian company that has financed a joint venture project in Singapore using a 15-year fixed rate bond, paying semi-annual coupons that are denominated in Singapore dollars. It's an Australian company that has financed this, issued a bond denominated in Singaporean dollar. the bond's par value to be paid at maturity is denominated in US dollar. This bond is an example of which bond, which type of bond now? No, I said it's a revision class. So we are reviewing, and we are seeing you. We are seeing you. Okay. Good. I actually like the participation. I actually like it that you're participating. You know, if you don't get it right, it's fine. It's just saying that this is an opportunity. You are now knowing how not to get it wrong, right? How not to get it wrong. So if you are getting it, just try it, attempt it, be bold. After all, this is the good thing about virtual class. So we don't even know you. So put it there. Don't worry. Just put it there. Let's go. Okay, so this is an example of dual a dual currency bond. This is an example of a dual currency bond because a currency option bond would have given you the option of which currency to pay the coupon, the cash flow from. So you get to make a choice. When you hear option, then there will be an opportunity for the investor to make the choice. But in this case, there's no option here. So you get. So that is the idea. All right. Let me pick another one. Yeah. The bond issue trading at the highest bid offer spread is most likely the bond issue trading at the which of these bonds? Let's just leave English. Which of these one would trade at the highest bid offer spread? All right. That is what this thing is saying. So we are saying which of these will trade at the highest bid offer spread. So I want to see after our discussion on the falling angel and all those discussions that we did there. The one that will be the highest. Yeah. So you see the answer is coming like everybody is aware. A seasoned investment grade corporate bond, recently issued sovereign bond, that will be on the run, so a tighter spread. Recently issued investment grade corporate bond, that will be good. That will also be tighter. And so what you have is the seasoned investment grade corporate bond. This is the kind of question that you see them giving just to enable you to get something. You know, this one that when you enter the exam hall, you know, you can enter the exam hall and then the examiner will give you something so that when you come home and they ask you, you say, yes, I've gotten something. You know, it's different from saying the result is 0. What's the answer to this one? The level of repo margin is higher because we discussed it. So I just want to confirm if you actually understood what we said there. Yeah. 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 Yes. C is the answer. No folding of my hand, nothing. C is the answer. Correct. So anything that increases the risks will increase the repo margin. That's good. That's good. That's good. Yes. So let me see. Let's do which one now? Okay. No. Let's do this. Let's do this. A transaction where a hedge fund enters into a repo by taking a short position in a security with a view that its price will decline relative to the price of another security held is best described as, you know, if it's in the class, I will not be asking you how. Explain. When you just say this, I will say, okay, explain. But you are not in the class, so you can just pick. These people say maybe what they would have done is to put one option that's a repo. Instead of just reverse repo, they would have repo and then they have another one, reverse repo. But you are all correct. You are all correct. We are viewing this from the perspective of the person who is going short. To short a security, you know, the hedge fund must obtain the security first, right? So they will obtain the security first, they will sell it, and then later buy it back. So we're saying that buying a security with an agreement to resell it later is what we call a reverse repo. So this is a classical example. Buying a security with an agreement that is how we get that. So when you shorten a bond, it's reverse repo. Financing a long bond position, it is repo. So when you short, I just want to say so that it will just be a rule for you. When you say it's shorting, that would be a reverse repo. Financing a long transaction would be a long bond transaction, a long bond position. Financing a long bond position will be a repo. All right. If you're collecting money, if it's the cash you are collecting, is repo. We have done this. We have done repo. Okay, let's do this one sharply. Let's just do this. Don't worry. What's the answer? Keep it coming. Z Bank has entered into a contract with Lowly Corporation in which Z agrees to buy a 2.5% US Treasury bond maturing in 10 years and promises to sell it back next month at an agreed on price. From Z's perspective now, this contract is best described as what? From Z's perspective. Z agrees to buy a US Treasury. So buying the US Treasury just means they are holding security, and this transaction will be, let me see what my people are saying before I say the answer. We have confusion. I don't know where to go to. The question you ask is, at the end of the day, what is Z going to be holding? Is Z going to be holding cash or going to be holding security? If Z is going to be holding cash, then they are doing repo. If Z is going to be holding security, then they are doing reverse repo. And in this case, it's like Z is going to be holding the 2.5% US Treasury. So they are going to be holding security. And so reverse repo is the answer. Thank you for trying. Let's move on. I hope you are enjoying your time, just as I'm enjoying my own. If you are not enjoying, then you are on your own. We are moving on. All right. So here we have we have another area to go. This is introduction to fixed income valuation. My people, this is one area that I said, if you don't master this side, you have not started. So you see, we have done so many things. So, but I'm saying if you don't master this area, so you can see the learning outcomes, right? Fixed income bond valuation, prices, and yield. So I'm taking here again, reading 54 to 57 as introduction to fixed income valuation. And here you have all these learning outcomes that we need to grab. But I'm saying, like as usual, for me, I said this is where you have your highest return on investment, right? This is where you have your highest return on investment in this your fixed income side. It is an absolute must master area. You don't have a choice. You have to master this area properly. And then the good thing is that they are repetitive. There are areas that will just be giving you marks anyhow. Even me, I will just be wondering, why are you getting those marks anyhow? But it's because you put your mind in what we are doing. Bond price yield, price and yield inverse relationship is discussed here majorly. Current yield versus yield to maturity versus money market yield, discount, premium, pull to par logic. We discussed some of these things in the rules. Also spot rates, par rates, forward rates, minimal data rules, 2-year, 7-year spot. So if I want to, this is just saying, usually the exam will not give you a long period, so many periods for you to calculate the forward rate. They will give you some spot rates and then ask you to do a forward rate between a certain period. So if you have a 2-year and a 7-year spot, you can have 5-year forward in 2 years. And then that can be calculated with this. Also, in terms of metrics pricing, another way of calculating finding the price of a bond, especially when it is thinly traded or is not even trading at all. How do we know the price of the bond when the bond is thinly traded or when the bond is not even trading in the market at all? Now, the learning outcome statement on metrics pricing did not say we should calculate, even though the discussion has calculations so that people will look at. But it's important to also be remembering what you need to know about the learning outcome statement. They count and accrued interest, dirty price, clean price. This is the good thing about this one. is that the calculator will do all these things, so you don't need any formula to do this. Or most of the things that you have in this area, there are things that calculator can do for you. And this is part of the reason why you bought that calculator in the first place. I wanted to show you something around what I mentioned. I said in metrics pricing, the learning outcome is saying describe metric pricing, and that is what we expect, that at the end of the day, you should be able to give a good description of what metrics pricing is. Now, let's look at this. Now we are in the area where we'll be using our calculator to bring out things. Now, here, a bonds Apex Corporation have a par value of 10,000. Each par value of $10,000. Sorry, the bonds of Apex corporations have a par value of $10,000 each, and an interest annual required rate of return of 10%. The bonds they make quarterly coupon payments at an annual rate of 6% and have 2 years remaining until maturity. Good, just 2 years. The current market price of the bond is closest to what? This is a simple one for you to just give it to me. Just give it to me straightforward. Don't waste your time. Payment 150. Usually, before you start your calculation, please always remember second function, clear time value of money before you start. Future value is 10,000. Don't forget, before you start any of these things, clear your time value of money. Payment is 150. IY is 10 by 4. Which is 2.5, right? IY is 2.5, N is, you are solving, it's not me that is solving this one. I'm saying I'm solving, instead of to be putting answer, you follow me to look at the screen. What you are doing is compute EV. You are putting your own. Me, I don't do my own. You have to do your own. All right. Yeah. So you see, this is simple. It's simple because it is telling us to do the calculation. So we can actually the same thing do this calculation. You can use it to calculate the payment. You can use it to calculate the IY. You can use it to calculate the PV like we did now. So the price is 9282.986 if you are using my kind of calculator. All right. Yes. All right. So you see now that most of you can price a bond. So let's go. I hope you are keeping how many questions you are able to answer. So this is another area that, again, I want you to please be using your calculator to get this. So a 10-year 6% semi-annual coupon bond is priced at 98.31 per 100 of par value. The yield to maturity of this bond on a semi-annual bond basis is 6.23%. So semi-annual, 2 times a year. The yield to maturity of the bond, assuming monthly periodicity. So now I have the yield to maturity on a two periodicity, the periodicity of 2. Now I want to have it on a monthly periodicity, the periodicity of 12. How do I go about this? Again, I give you some time to do it, but then I will use the iConvert function. iConvert with my calculator is 2. So second function 2. iConvert is second function 2, right? Yes, second function 2. So good. So it's second function 2. So what we do is you now change it. You use your iConvert. You impute the necessary things. So nominal value, when you get to nominal value, the nominal value 6.23 is what you do and enter. Then you CY is 2. Then you compute effective. Compute effective. Then when you compute, you'll be using the arrow down, right? When you compute the effective, you go again, and when you compute effective, you go again and change CY and make CY 12. And then you compute the nominal, right? So second function, so you do 6, so it is 6.15. Ordinarily, you can just pick 6.06 and say that is the answer. Like I saw in here, a lot of people just did was to go straight. So are we okay with it? Just using your iConvert. So just use your iConvert function and be able to get this. $6.23 is the nominal. So you have to enter it first. And then when you enter it, then please try and change the CY to 2 because it's semi-annual. So if it says it's TY to 2, you now calculate effective. When you compute the effective will be giving you 6.327. You know, effective is like 1 year compounding, one annual compounding. That's effective. So you now go back. Now that I have annual compounding, I want 12 periodicity. So I'll just go again and compute the nominal. And so the nominal will give me 6.15. And so it's 6.15 is the answer, and I move. So you can do this for anyone you want to use. All right. Okay, this is another area that people sometimes struggle with. So the 12-month spot rate is 4%. The 4-year spot rate is, so 1 year spot rate is given, 4-year spot rate is 6%. Which of the following is closest to the 3-year forward rate to start in 12 months? All rates are annual rates stated for periodicity of 2. That is just on a semi-annual basis. So given this rate, given that the rates are stated on a semi-annual basis, you have to convert these rates into a 6-monthly rate to calculate the forward rate. And then when you finish calculating the forward rate, you re-annualize the rate. So if I take this and everything is given to me, it is 1.03 raised to power 8. You are doing it. You are just 1.03. You know, you are breaking, this is like 6 divided by 2. So like I said, what you do is convert this rate to the 6-monthly rate. So it's this 6 divided by 2, 4 you divide by 2. So that's what we are seeing. And then when we finish, we now come back and reannualize it. So this is equal to 1.02 squared times 1.1 plus r. 1 plus r raised to power 6, right? Somebody told me that, and me too, I'm telling you that this plus this should always equal to this when you set your equations properly. So when you do this and you bring it out, what will be your r? Yes, somebody has started providing the answer. So when you do this, let me see. So 1 plus r, 1 plus, what will be your f? B is equals to 1.0336. So you have 6.67%. Yeah. So when you annualize, so convert to semi-annual, solve, annualize, and then you have your final figure. 3.336, you have to multiply that. You have to multiply that by 2. All right. Sometimes, like somebody said that, so the C is the answer. Somebody said sometimes what it does is just to see one number that multiplies or divides, and then he'll pick and just move. I said, don't do that, or you'll be hitting yourself sometimes, especially when the answer is a simple one. Are we good? Are we together? Please, we have to be together. Are you understanding what we are doing? I hope it's not too much. So let's move. Let's get another set of questions that we want to look at. Aha. So this question is another kind of question that I usually would prefer to just leave it for you to do. When we go to class. So if you are not giving periodicity, you assume it's annual. However, for bonds, generally what we say is that when they are talking about bonds, generally we assume 2 semi-annual periodicity. But for this kind of question, if it's not stated, you assume it's annual. But usually for bonds, if they give you a bond and they didn't state whether the bond is annual or semi-annual, use semi-annual is safer. All right. Stella, are you good? All right. So here, I'm waiting for you to start solving. I want to, first of all, which kind of bond is this? Yes, the answer will be different. But the difference will not be so much, actually, because in this case, the periods are not too far apart. Yeah, correct. So this is deferred coupon bond, yes. So can you solve the question? Can you solve can you solve this now? So if I say give me the answer, can you give me the answer? Can you give me the answer? What's the answer to this question? So can somebody just say, just type something and tell me how you got C? Just something small to tell me how you got C. So this is one question that will not require you to do any calculation, right? This is one question that will not require you to do any calculation. But somebody said C. So how do you get C? You didn't, I don't know. So you misuse it. Okay, so say there's rule 2. So this is what is this is it, right? If you look at it, this is coupon. Of course, with the calculator, I can use the cash flow function, and then I will get this. I can use the calculator, I can use the cash flow function, and I will get it. Good. So the idea is about trading. You see, this bond is 8%. This bond is a deferred coupon. Deferred coupon just means that even the fact that it's deferred, the coupon is deferred, it will be it's expected that when it comes, it will be at high coupon. That is what it means. Deferred coupons will push the yield to maturity to be above the stated coupon. That is how it is. A deferred coupon will push yield to maturity to be above. So if the price is far below par, like we are seeing, if the price is far below par, this is what we are seeing, then it will eliminate some answers now that are the coupons that are lower than the answers that are lower than the coupon, because it will eliminate this and it will eliminate this just by looking at it. Because if you as you see it, it is already trading at discount. So discount, when you see the discount, it is 87, and then the coupon rate is 8%. Because it is deferred, the expected yield, the expected what do you call it? The yield to maturity will be pushed to go above the stated coupon. That's how it is. And so when you see it in that case, the bond is priced at 87, which is well below the par. At 87 is well below the par, and then coupon are deferred. which increases the yield to maturity. And so you will see that at the end of the day, it eliminates some of those things and then give you one answer that is straight. The yield to maturity must be greater than the coupon rate. That is what it means here. 6% will be too low. 8% cannot be because it's not priced at par. So the other is, but then another way to do it, which I can do, another way to do it is just to use your the yield to maturity is above so that's it. So another thing to do, I can if I want to do a calculation, I can just go to the cash flow functions, and then in your cash flow function, just you remember when you open your cash flow function, when you open your cash flow function, you'll see CFO 0, all those ones. You just put the price here as a negative, and then you go down, and then for this period, CO1, you will not put anything. It will be 0 up to then FO1 is where you are now going to be putting. The first FO1 will be 4 years of non-payment. So the coupon was not paid for those period of time. And that is how you go that way. All right. So let's move on. Okay, this is another question that I want you to try. This is another question that I want you to try. Please try this one. A bond has a settlement date of 30th 2013, 6% semi-annual coupon payment made on 30th and September 30th. In addition, the bond matures on September 30th, 2018 and uses the 30-360-day convention, assuming a yield to maturity of 5%. It's calculated full price. You see, somebody has already given us the answer while you are still trying to read the question. So you just use your calculator again during those periods. These are the kind of periods that you want to be using your calculator. So here you just use your calculator. So you say which second function? Bond, right? Second function bond, that is 9. So you see where you have to add that. So second function bond, use the bond function. Bond is second function 9. And so enter all the details in the function, and then your answer is out. So I saw that we have A already, and then we have C. So this means that it's necessary to calculate. So second function, so the settlement date is June 30th. June 30th, June 30th, 06, sorry. Dot 3013. You know how to enter it, right? So you do 06 dot, then you do 30 the day, depending on your day count. Then you do 13. That will enter then you enter. That will be for settlement. Then you arrow down and you see coupon. The coupon is 6% here, so I do 6 and it's annual, so enter. And then when I do arrow down, I will see, coupon is 6. Then I see RDT. RDT is redemption. So redemption, it matures 30th. So again, I will do 9 dot 9.3018, and I enter. All right, I'll do my 9.3018. I will enter. and then I do arrow down, value 100, yes. So I'll go down. Actual is not actual. What I have is actual, so I have to change this second function set. I have to change it to 360. So second function set will give you 360. Will give you 360. Arrow down. IY is 1, is annual. So I do arrow down. I have my yield, and yield here is assuming the yield to maturity of 5%. So I enter 5 as my yield. I enter 5 as my yield. And so if I do arrow down, what I will have, I have 104.4919. And then that is the price. But the accrued interest is given to me as 4.5. So if I go back and then add the accrued interest plus 4.5, I will have my, am I getting the right thing? I'm just doing it. Yes. Yeah. So you see what do you mean? What do you have? What is the full price? What is the flat price? The quoted price is usually the flat price. The full price is the quoted. The full price is the dirty price. That is the price that includes accrued interest in it. So that is the bigger one, because the accrued interest is in the price. And if you want to know what is the dirty price in this kind of question, all I need to do is, if I do a calculation and I got 106.06 in my calculation, all I need to do is to remove the accrued interest, and I will get the flat price. Sorry, it's like, why am I getting a different figure here? Is it my calculation or? Aha. Because I'm getting, it's when I imputed the semi-annual, I got, so it's, yes. So you need to change it to semi-annual. Yes, compute. Yes. All right. So it's semi-annual compounding. So if we do semi-annual compounding, so the accrued interest is different. So let me just check. Is it the calculator that is giving me some confusion? Semi-annual compound. Oh. So let me put off this first. It's because it's yield. I've put my yield. My calculator is confused. My yield is yield to maturity is 5%. Yes. Okay, this is 2. IY is 2. Enter. Yeah. Okay. But my accrued interest is different. It's not changing. My IY is not changing. That's why. So it's okay. Now it's good. All right. So now we are good. Yes. So now we are good. Okay. Now I am good. Accrued interest is 1.5. Now I'm good. 1.5. All right. So now we can continue because I'm good. 4919. Yes. You know, if the driver is confused, then you too, you have an issue now. You cannot claim that you are not confused. So let's go. Let's go on. Let's go on. Yes. Yes. So let's go on. This is another one. This is another one. This is just a quick one. So please just quickly, just answer this. Consider a 100 par value bond with a 7%. Yeah, so just consider that. Give me your answer. We'll move on. This is a quick one. I want to move to the next one, please. So I'll move. So here the answer is, of course, it will first of all decrease and then increase over the remaining life of the bond. What is most likely? If a discount rate increases to 7.5 from 6.5%, the price of the bond decreases, right? At a discount rate of 7.5%, the bond will sell at a discount to face value. So as discount bond approaches maturity, it will increase in price over time until it reaches par value. Remember the idea of pool to par. One of the rules, pool to par. Yeah. So let's just move, because I have another area I want us to go to. This is 17. This one, can you give me an answer to this now? Just sharply by looking at this, 37. This is the first one as well. There are 3 bonds. So which one has when we say experience the largest percentage price change in price, if the market discount rate for all the 3 bonds increased by 150 basis points? With this, it's not saying you should calculate anything. It's one of the rules that is just trying to specify. You can go by elimination and then you do it exactly. So I already have answers coming in. So you go by elimination. Low coupon bonds are more sensitive to changes in discount rate than high coupon bonds. So this leads leads us to eliminate the bond B. And then when we are looking at bond A and C, we can now also eliminate we can eliminate one and say the one with the highest impact will be the C bond. All right. So let's go to this area, understanding fixed income risks and return. This is where I want to take some of the time so that we may just end it in this side. So in this area, this is another very critical area where you want to gain some marks. This is an area that may put you above your peers if you understand what is happening here. And this is the area around understanding the fixed income risks and return. So there are some learning outcome statements that you need to understand and keep them straight. This is where candidates either pick up or lose easy marks. That is the truth. The core concept tested here is usually mostly qualitative. Mostly, you don't see question on, it's not majorly about calculation. Not about calculation, you see quantitative. So just look at them. So determinants of duration. When you look at the determinants of duration, maturity up, duration high. Coupon, the same thing we gave the other place. That is what you are finding here. Coupon low. Remember, I always say, remember your LLL with maturity, coupon, and yield. So that will always help you to talk about this duration thing. Macaulay also be able to distinguish Macaulay duration and be able to distinguish Macaulay modified and effective. And just know that in this area, Macaulay duration, modified duration are all yield duration measures, and effective duration is a curve duration measure. Curve. So only effective duration can be used for bonds with embedded option. If there's an embedded option or the cash flow of a bond is not known with certainty, then it is only effective duration that can be used. So we'll work on that area. Macaulay, you can get Macaulay duration from modified, or you can also estimate your modified duration from Macaulay duration. Callable bonds, we already said they have negative convexity region at the low interest rate side. Effective duration for bonds with embedded option, we have mentioned it, is lower than for option-free bond. Portfolio duration, if you ask me to calculate portfolio duration, it is a weighted average of the duration of the individual portfolio securities in the portfolio. That is the most practical approach, even though the most theoretical approach is the cash weighted, cash flow yield weight measure of duration. But this is okay by using the weighted average methodology. Then convexity adjustment is needed in terms of calculation of the price impact, and that is why this formula minus duration times change in yield plus half convexity times change in yield squared is a must know for you. This first part is what we call the duration effect. And this second part is what we call the convexity effect. So I used to tell my students that if you see a question where they give you all these variables, so they give you duration, they give you convexity, they give you percentage change in, so they give you change in yield. All these variables are there, but you don't know what the examiner wants you to do. Please apply this formula and you'll see that the answer will be there. Pick it and move on. Yes, we can use, I see a question from Olayinka Yusuf. Yes, we can use the bond function to calculate modified duration. And then, yes, you can use the bond function to get modified, and then modified duration can now be converted to Macaulay duration. That's true. But that is for professionals. That is for those who are using professional. So let's see if we can have a representative question, one or two to use. Okay. Okay, but this, so this, we can use a calculator to do. About Macaulay duration, you can use a calculator to do. Currency price at this, the bonds Macaulay duration, 3 year. So if they give you, no, I'm leaving this. Also, this I can use the calculator to do, but there are no options, so I'm leaving it open. But please, just use your bond function, and then you get to, just like we just calculated accrued interest, right? Just go to the end, and what you get at the end is what you get at the end will be the modified duration. What you get at the end is modified duration. So modified, if you have a modified duration, you can convert. Modified duration is Macaulay duration 1 plus R, right? So and this don't forget, is adjusted for periodicity depending on the period. Now, if I want to get Macaulay duration, then it means I can do modified duration times 1 plus R, right? So just be aware that we can use our calculator, the bond function in the calculator, bond function, and then use that to calculate the duration. Yeah. And what of this one? I know we have just some few minutes, but I know we have gotten some good things. Which question? Go back to that question. Which question is that one? That one you may look at it later. Yes, you can be asked to calculate. You calculate Macaulay duration. Yes, I didn't answer that. You can be asked to calculate Macaulay duration. You can use a calculator to calculate it, but then usually in the exam they will not give you. You are not, and don't go doing the nested formula for Macaulay duration. Even if they will give you maybe not more than 3 years at max. So be able to set up your table and solve using the table. Just solve that table that will say period, cash flow, PV of cash flow, right? What weight times time, and then Macaulay duration is the summation of all that. So don't forget that will be the one that you use. So for this one, am I getting answers here? Anybody? What are we getting? C, A, B, everything, D, C. I'm saying C. So here we're saying an investor with an investment horizon of 6 years buys a bond with a modified duration of 6. The investment has zero duration gap, positive duration gap. Remember the duration gap, right? Duration gap is Macaulay duration minus investment horizon. This is the duration gap. If they are equal, we say the duration gap is 0. If it's positive, meaning if Macaulay duration is higher, we said that you have a positive duration gap. If it's negative, meaning that Macaulay duration is lower, we say you have negative duration gap. So you don't know the investor with an investment horizon of 6 years buys a bond of 6. So you cannot easily just say that because the 6 years a modified duration is 6 is no duration gap. No, you need to convert the modified duration to Macaulay duration. Because you are not going to be using modified duration for duration gap, you have to use modified duration. And so Macaulay duration will be equals to modified duration divided by 1 plus the yield to maturity, 1 plus R. So meaning that Macaulay duration is greater than the modified duration. That's what it means. And if Macaulay duration is greater than the modified duration is 6. Macaulay duration is greater than 6. And so 6, something greater than 6 will give us a positive number. And so the answer is going to be a positive duration gap. And so just to add that if you have a positive duration gap, you'll be facing the price risks. Yeah. I used to tell my students, it is fee for fee. Positive for positive. So price, positive duration gap, price risk. So this is the only thing I need to hold. I say positive duration gap, price risk. That's the only thing I need to hold. Any other one I can interpret. If it is equal, no duration gap. If it is negative, then I know it's reinvestment risk. And that is how it's easy to hold it in that way. And that way you cannot forget it. All right. So let's go on. There's another representative question I want us to do. Still looking at the time so that I don't chop into. This one is easy, but it's just for you to look, to just say it. And if it's to calculate, please, you know how to do duration. I don't want to do this. We can't be doing this because this is given to you. If you decide not to be able to do this, price when yield goes up. If you decide not, in fact, let me just leave this one. If you decide not to know how to do this one, you're on your own. Just apply the duration. Just apply the duration to, and then you are good. All right. The questions I have here, all these on one head. Yeah, so the one head, everything went. I don't only this one. Some are even coming. This is just the first one. This is just the first one. So the Macaulay duration of a bond, the interest rate increases by 50% immediately after buying the bond. The investor faces which kind of risk? So this is negative. If it's which kind of risk, this you should be able to also to answer. I think this will be fine. I don't want us to just leave. There are good questions here that you need to look at. Let's do this one. Which of the following most accurately describe the relationship between liquidity and yield spread relative to benchmark government bonds rates? All else equal, bonds with all right. They said they are giving me notice. 5 minutes to go. All right. So let me find a good way to land my 5 minutes. It's still 5 minutes. Yes. So the answer is C. C is correct. Yeah. The less liquidity a bond has, the higher its yield spread relative to its benchmark. This is because investors require higher yield compensation. We have done this in the rules, so that's why I'm bringing it here for us to do. In terms of fundamentals of credit tricks, credit, which question is good in the credit side? Just do credit, and then you're good. Credit, what the exam actually wants, credit risk components, probability of default, loss given default, ratings, opinions are not guaranteed. Credit spread narrows in expansion, widens in contraction, seniority, waterfall in bankruptcy, and then some kind of ratios. So you are good here as well. The last part is the securitization, asset-backed securities, MBS. Just to know why securitization exists, the two benefits to issuer and benefit to investors, and also differentiate between time tranching and credit tranching, and how those things relate. What is time tranching? What is credit tranching? It also differentiate between extension and the contraction risks. What if interest rate is low? Is it extension risk that is coming, or is it contraction risk? All those things. Then you talk about covered bonds in relation to asset-backed securities. Just know that covered bond has two recourses. With ABS, the recourse is with the other. It's only one recourse to the underlying asset. With covered bonds, you have recourse to both the underlying asset and also to the issuer. So this question now, let's answer this one so that it will be on record that we answered one. In securitization, the time tranching provides investors with the ability to what? Extension or contraction risk, right? Time tranching is about extension or contraction. So it's about the ability to choose between extension and contraction, and that is what the time tranching is all about. Yeah. And then the creation of bond classes with a waterfall structure for sharing losses is referred to as what? Credit. This is now credit tranching. So I've given you a way of knowing the time tranching and then the credit tranching, and that is what is important here. Ladies and gentlemen, I'm not saying we are finished. Don't worry. So I'm not saying we are finished. I'm saying that I have some few minutes to end, but I want to end well by telling you that if there's one area that you need to master, that you can master and you can master it very well, it is fixed income. The questions are repetitive. If you know the principle, that's why I started with the rules. I gave you those 12 rules. Please hold them, have them hooked on, and then review those things again. Get these slides. I've sent the slides to the administrators. Get the slides, have all the questions, and solve them. We can link on LinkedIn on so many areas, and I think they are even going to be distributing the facilitators' contacts. So whatever, if you have a problem, let us know how we can help you, and we'll come in. Ladies and gentlemen, I want to thank you for being here. I have a good time, and I hope you also had a good time too. I wish you the very best in your exam. Take my advice that I did at the beginning of the class seriously, and that will be sufficient for you by God's grace. May God see us through and lead us to success at the end of the day. Thank you.
Sir, I would like to ask. Hello,
thank you
can
so
you see
very
me,
much,
sir?
Musa. Bia, your floor.
Yeah, thank you very much, Musa. Thank you, Yemi. Tosin wanted to ask a question. Tosin, we're with you. Though we don't allow it all that much, so as not to cause you understand, a disruption. But please go ahead, just in case it's something Musa has to respond to. Tosin.
Hello, can you hear me
Okay.
now?
Yes, we can.
I wanted to confirm if this slide will be shared to our mail.
Yes, the slides will be shared to you via email. We would also be asking for your feedback after the whole sessions. So please feel free to give us your feedback, and the slides will be shared to you as long as we get them from the facilitators. I assure you that it will be distributed to everybody from the society office. While we wait for the second facilitator. Kindly be patient, as I have said in the opening. Please let us know exactly where you're joining us from. Let's know what state, what country you're with us. And also feel free to check our website, the CFA Society Nigeria website, particularly the partnership page. You would find information that would be useful to you as candidates. Feel free to look at them and also click on the links that you find very attractive to you, so you can get assistance and help as much as you need. The recordings for all our revision boot camps are on our YouTube page. Feel free to engage with us on our social media network. Our YouTube page is also available. You can see as far back as last year, 2 years ago, 3 years ago, revision boot camps. Each topics, each courses are also outlined there. So please, if you miss anything here, go to the YouTube page, CFA Society Nigeria, then you find them there. We're also on Spotify. We have a radio session that we do every Monday on Spotify. You would find our Money Talks radio show. Feel free to also engage with us there. As many as want to engage, please feel free. We are on Instagram, we're on Facebook, we're on Twitter, which is X, and we are very, very functional on the LinkedIn page. Please hold on for our next facilitator. He will join us soon. Thank you. Musa, thank you so much.
My pleasure. Thank you.
I'm here already. Can you hear me, please? If it's okay to start.
All right. Thank you very much, Olabode. He will be taking us on our next course right now. I would make you a host, and then the class can start. Also note that by 1 o'clock, we'll be going on a 15 minutes break so that everybody can stretch their legs, and then we'll come back at 1:15 for the next class after this. So quantitative method is over to you, Olabode. Thank you, and have a educative session.
Thank you. Good morning, everyone. Just give me a moment to share my slide. And can you let me know if you can see my screen, if you can see my slide?
Olabode, we can see your screen visible.
All right. Thank you very much. Okay. So now that we're very close to the exams, as much as possible, I'll just to think that I think if you go to the exam all with them, they would give you some form of yes.
Olabode, sorry for
Yes.
cutting you short. You sound far from your speaker. Please kindly check it. You sound a little bit far from your speaker, so you're not that audible.
Okay.
If you are speaking, we can't hear you.
Okay. Is it better now? Can you hear me?
Much more better.
Okay, thank you. So let me just reshare my screen. So as much as possible, I'll stick to the basics that I think we need to just get familiar with as we go into the exams. Broadly, there are three things I would like you to focus on going into the exam. Number one is your ability to recognize the questions you're being asked. When you see a question, you want to be able to determine what am I being asked? Is it an hypothesis testing question? Is it a probability question? Is it a time value of money question? And within those topics as well, You want to be able to identify if it's time value of money. You want to say, is he under fixed income? Is he under a discount instrument, for example? If it's under hypothesis testing, you want to know, okay, am I being asked a test of a single mean or a test of a variance? So your ability to identify is the first thing. The second thing you need to be very familiar with are the tools. I call formula tools. In level 1, the questions, especially the calculation questions, are not the very difficult ones. You just need to get some tools handy. That is some formulas that are not too technical. So I will go over some of them as we go through. So some of the formulas that we go through here, it would be very good if you can at least remember or master them as you go into the exam hall. The third thing is, in level 1, relationship is the focus. They want you to know the relationship. So when they're talking about mean, for example, they want you to know the characteristics. They want you to know the behavior. They want you to know the link of mean, maybe to geometric mean, arithmetic mean. What is the linkage, and all of that? What is the relationship? So those are the 3 areas. So you often find questions that might have calculation, might have numbers, but you do not require calculations for. So it's important that you get very familiar with understanding, being able to identify. Second, some basic tools, that is formulas. And then thirdly, understand the relationship. You will see enough questions that they are not tough at all. You just need to remember the formulas, plug in the numbers you need. As much as possible, they will give you the numbers you need, and then you will be able to solve them. Holding period return. This is a simple one that typically comes up. I mean, that might come up. Let me say might come up. Just get familiar with calculating holding period return, especially knowing the formula breakdown. The end of period value minus the opening period value, that is your capital appreciation or loss. Then you add your interest or dividend to that, and then all over your opening period. So for this question, for example, an investor purchased 100 shares of stock for 34 per share at the beginning of the quarter. Now, you have to be thinking about it from a value point of view, because there are dividends involved as well. So you want to convert that to 100 multiplied by 34 to get the opening value. If the investor sold the shares at 330.50 USD, so you'd also then convert that, because there are still 100 shares. Now, the difference of that will give you your capital gain or capital loss. In holding period questions, you might either be asked the holding period, or you might be asked capital gain or capital loss. Just only capital gain or capital loss. Now, if you're asked capital gain or capital loss, then you do not need to include the dividend. Just do the opening balance, the opening value, and the difference between the opening value and the closing value. Now, remember to always factor in the dividend properly. Now, per share after receiving a dividend payment of 55. Now, this 55 is not per share. While the stock prices are per share, the 55 is not per share. So it's important to remember that. So this 55 is an absolute amount that you just need to add to what you've calculated and all over the opening period, and you should be able to get the answer. So the point here is, remember how to calculate your holding period. Remember when you're asked either holding period or you are being asked to calculate just capital gain or loss. Sometimes you might be given a dividend yield. Rather than give you an absolute dividend, they might give you a dividend yield. Remember that dividend yield is the absolute dividend divided by the current price, right? And so, which means if you're given a dividend yield, you can use that to find out what current price is. Now, sometimes you get questions around the relationship between arithmetic mean, geometric mean, or harmonic mean. So let's look at this question, for example. Which of the following statements regarding arithmetic and geometric mean is correct? This is really testing your understanding, or checking your understanding of the relationship, like I mentioned earlier. So you can see to the left, I have put some numbers there. Now, if all of the returns are the same, in the first instance, 5% each year, for example, it tells you that both geometric and arithmetic mean will be the same. So are there instances in which arithmetic and geometric mean will be the same? Yes. If the return, there's no deviation in return. So in the first instance where you have 5 or 2, there's no deviation in the return. So arithmetic and geometric mean will be the same. Now, what determines the gap between arithmetic mean and geometric mean? What determines the gap is the variance. For example, if you look at the second instance where we have 4695, if you look at it, you see that the return varies from 4% at the lower end to 9% at the upper end, right? Now that tells you that there's going to be a difference between arithmetic and geometric mean. That difference is magnified if there are changes in signs. So if you look at the third instance, you see that not only do they differ across board, but now there are also changes in sign. You see -1, you see -5, you see +6. So it means that when you have changes in sign, you still have variance in that in those variance present. It means that the gap between arithmetic mean and geometric mean will be wider. So really, what this is checking is, do you have all of those understandings? So if you look at the options, the geometric mean will exceed arithmetic mean for a series with non-zero variance. What do we mean non-zero variance? That first instance of 555 is non-zero variance because the variance in this instance is 0. Now, will it exceed? It will not exceed. In fact, it will be the same, right? And that's why I put that there. Now, the geometric mean measure an investment compounded rate of growth over multiple periods. Now, you do remember that in geometric mean, you actually compound. So hopefully this is correct, but we won't stay there. And I'll encourage you that when you look at options in exam, don't stay with one option. Go through all of the options before you conclude that your answer is the answer, because it might look like it's the answer, but always go through all of the options. The arithmetic mean measures an investment terminal value over multiple periods. Is that what it does? Not necessarily, because you know that arithmetic mean it actually takes each of the periods value and then finds an average of it. So just looking at the options and what we have explained, you'll be able to tell which of the answer is correct by that. But the reason why I brought it up is that this question is actually testing if you understand the relationship between arithmetic mean, geometric mean, and harmonic mean. Money weighted return, something you need to be familiar with. It accounts for money invested and provides the investor with information on actual return she has earned. And the calculation is similar to IRR, or bond yield to maturity. And so amount invested and cash outflows, that's how to begin to look at it. And so money weighted looks at cash flows, both outflows and inflows, and all of that. And so in money weighted return, what matters is really money. Okay, the money invested matters. Now, one more point here to make is these questions on money weighted or time weighted might not be given in numbers. They might just be given in statements. They might be given in statements to check what does it measure. Okay, it measures in terms of money. They might throw in some things that gives you an indication of what you are talking about. If they throw in an IRR there or YTM there, it tells you that they're talking about money returns. When they begin to talk about cash flow as well, you know that they're talking about money weighted returns. If you get a money weighted return question, how do you treat it? Number one is determine cash flows. And in cash flows, any money that leaves the client is an outflow, which means it takes a negative sign. So you take the starting point as the client. Any money that leaves the client is an outflow, as an outflow from the client. So it will take a negative sign. Any money that returns to the client takes a positive sign. Initial investment leaves the client, so it's treated as an outflow with a negative sign. We always assume that portfolio balance goes back to the client at the end of the period, so that would be an inflow. Any withdrawal from the portfolio to the client, therefore, will be an inflow because it's going to be positive. Take special consideration of interest and dividends that are not reinvested. When they are not reinvested, it means that they are paid to the client, which means they are inflow to the client. And then dividend reinvested should be ignored because they are still in the portfolio. Now, determine cash flow period, which is the second step. That is indexing of cash flow is typically the second challenging thing that you need to be able to figure out. Initial investments are always indexed to T0, right? And if you receive any cash flow at the beginning of the period, you index it one period back. So if you say, oh, the portfolio received the inflow at the beginning of the year or in January, you index it back to the last year. Now, any inflow received at the end of the year stays within that year. So if you receive an inflow or cash flow occurs at the end of the year, it stays within that year. But if it happens at the beginning of the following year, it's you index it one step back. Then you set up your IRR and then you interpolate. Because you have to interpolate with IRR here, Do not expect such too much a difficult question. It's going to be simple. What you need to be able to do is to identify the cash flows, put the right signs, and index them accordingly. Now, if you do get a cash flow, if you do get a question here, you will get 3 options. Pick the middle option. So if you get 6%, 7%, and 8%, pick 7%. Solve your IRR with 7% and determine if the number is bigger or smaller than 0. If the number is bigger than 0, it means you have to go higher, right? Because a higher rate will give you a lower value. If you get a smaller number than 0, it means you need to go higher in this case. So therefore, if you start with 7, if you get a higher number than 0, right, it means that 8 is the answer. If you get a lower number than 0, it means that 6 is the answer. So really, that's just how to deal with IRR in its simplified format. Time-weighted return, an investment measure that is not sensitive to additions and withdrawals. So questions on money-weighted and time-weighted, they will want to check for understanding of, which one, what did they really measure? And it's very important that you, going into example, you know that the key difference between time-weighted and money-weighted is that time-weighted is not sensitive to additions or withdrawal. And so what it does is that it finds the compound growth of an assumed one US dollar over a period of time. In terms of preference, time-weighted is preferred, and the reason why it's preferred is because it neutralizes the effect of cash and withdrawal. And that is important because fund managers really do not have control over withdrawals and addition of funds. And because of that, if they do not have control over it, it's not really right for you to penalize them for it from a performance point of view. So the most preferred return to use is time-weighted return. So in this case, time is all that matters. How do you deal with a time-weighted return question? Value the portfolio prior to addition or withdrawal. That is, when they set up the question, just before the addition or withdrawal of fund, find the value of the portfolio. I want to believe your question will probably just give you some numbers or some guide that helps. So look for that number, then calculate holding period for each of the sub-period you have. Now, that period when there's an addition helps you to determine where your sub-periods are. And so you use that to calculate return for the sub-periods, and then you chain link them. Chain link them, you can use the geometric mean formula to chain link them, and you get your answer for time with return. Let's just an example just to understand. Now, remember that for time-weighted calculation, even though they might have number in them, they just want you to understand the relationship. So let's look at this question. At the beginning of year 1, a fund has 10 million under management. It earns a return of 14% for the year. The fund attracts another 100 million. That is, in year 2, there was an addition of 100 million at the start of year 2 and earns 8% for that year. The money-weighted rate of return of the fund is most likely to be. Now, you see, rather than ask you for a number, they then ask you if it's less than or greater than or is the same as the money-weighted. So here's the thing. Time-weighted is not sensitive to addition or withdrawal of funds. So that's the baseline. Time-weighted return is not sensitive to any of this. But you can see in this question, there is addition of funds. Now, which then means that money-weighted will be sensitive to it. But what is the sensitivity of money-weighted on withdrawal and addition? Here is how it works. Money-weighted will be higher if higher investment amount at higher return, and vice versa. That is, if you have a higher investment amount when you have a higher return, the money-weighted will be higher than time-weighted. But if you have higher investment amount when you have lower return, then money-weighted will be lower than time-weighted return. So in this case, let's see what has happened. In year 1, they have 10 million, and the return was higher. So you have low amount and higher return. Low investment, higher return. In year 2, higher investment, lower return. 100 million in year 2 with a total of about the 100 million plus the 10 million plus the return on the 10 million at 8%. So you have higher amount in year 2, but the return was lower in year 2. Now, this should tell you that your money-weighted will most likely be biased downward, that is, it will be lower than time-weighted return because you have higher investment when you had lower return. And so the answer to this should be that it should be less, which will be A. So you see, even though there is calculation and you can calculate this, but to save you all of the time, if you know the relationship in terms of how it works, it really helps. What to remember, time weighted is not sensitive to addition or withdrawal of funds. And the reason why that is because fund managers can control it. Money weighted is sensitive, but the sensitivity is determined by when higher return is achieved. Is it achieved when you have more money, or do you achieve it when you had low money? If you made withdrawal from the fund, for example, it means that the investment amount is lower in that period. So if you then had higher return in that period, that means that money weighted will be biased downwards. So it's important that you get very familiar with that relationship. Real return and risk premium. It's important that you be able to go to the exam hall and know the relationship between nominal and real return. And this formula is very handy, and I suggest you you know this formula going into exam hall. It's very useful because you can move it around to solve a number of questions as well. That same formula at the top is also the same formula that we have translated for you to be able to compute real return, for example. So if you're given real return and you're asked nominal return, you can use the first formula, because nominal risk-free rate is 1 plus real risk-free rate multiplied by 1 plus inflation premium. But if the question is asking you for real rate, that is real rate, you take the nominal rate, which will be given, over 1 plus the inflation rate, which will be given, but always remember to do -1 at the end, because if you look at the formula, it's 1 plus. So you have to always take that 1 out at the end of the formula. So this upper part helps you to calculate nominal risk rate and also real rate. So this formula is very handy, and you should remember it. The same thing if they ask you for risk premium. The formula for risk premium is 1 plus real return. 1 plus real return equal to 1 plus risk-free rate and 1 plus risk premium. How do you know that you have been asked risk premium? The question would specifically say risk premium. Now, in risk premium, in real rate, what you're using is inflation. And that's how you know you are dealing with real rate or nominal rate, inflation. When you're talking of premium, you're going to be talking about risk premium. So that's the second difference you will see. Now, if you're being asked to calculate risk premium, again, you can translate that formula the way we did for the upper part, where you then take 1 plus the risk-free rate over 1 plus the risk premium. But remember to do -1 at the end. So when you have these two formulas handy, in terms of the structure, you can actually translate it to be able to calculate risk premium. Okay. Now, analyzing return. Now, you can get a question in which you're asked to analyze return. When you're asked to analyze return, which means they will give you return for a number of periods, and then they ask you for what the annualized rate is. The formula or the tool to remember is that annualized return is 1 plus the periodic return raised to power C, and what -1. And what is the C? The C simply means the period in the relevant base over the given period. What do I mean by period in relevant base? If you're given period in days, then the relevant base is in days. If you're given period in week, the relevant base is in week. If you're given period in month, the relevant base is month. So if you're given period in days, for example, it means the base for days, that is number of days in a year, is 365. So you will use 365 at the top, divided by the given period. The given period is what you're given in the question. So if I'm to treat question 1 here, where you have 125 days, I would say that the base period is this. So that will be 365 over 125, and that is your C. Your periodic return has been given, in this case, is the 4.2. So you will say 1 plus 4.2 raised to power 365 over 125. Then remember to do the -1 at the end. If you're given in weeks, as in the second question, how many weeks are in a year? 54 or 56? 54 or 56, thereabout. So it means you will do 54 over 8. That is the period in relevant base. In this case, the base is weeks, so it will be 54 weeks. And because there are 54 weeks in a year, 54 over 8 weeks, given period. and you put it. If you're given a month, that would be 12 months, right, in a year. So 12 months over 16. Even if you have periods that are more than a year, this formula doesn't change. If you look at question 3, for example, the formula doesn't change because there are 16 months and there are only 12 months in a year. But to use the formula, it still works. That is, it will still, C will still be 12 over 16. And when you calculate that, it still works as well. So if you get a question on analyzing, that is a way to treat it. Just to also mention continuous compounding. Continuous compounding is just for you to remember these two. If you get a question on continuous compounding, just remember these two. Just know that current over the return, the current period over the previous period, but you find the in-log of that. The in-log is on your calculator. All you need to do is to put the period, the latest period over the previous period, and then you just find the in-log on your calculator. So compounding, continuous compounding is, one of those topics that is just out there, but really the question they will ask you here, or they might ask you here, are not as difficult. So if you remember these two going into the exam hall, I think it will help. And also let's talk about levered return. And let's talk about levered return from a relationship point of view. Just give me a moment. Just give me 1 minute. 1 minute. All right, so let's look at levered return. The idea of levered returns really comes from the fact that sometimes investors do borrow to do investments. And so when they borrow to do investments, how does that really affect the investment? Let's look at these two questions. An investment manager gross return is, now when it comes to gross return, the difference between what they are really checking when they ask for gross return is if you know what is included in gross return and what is not included in the gross return. So there are 3 options. An after-tax nominal risk-adjusted return. No, you don't. You get to nominal and tax later, and we'll see that very shortly. The return earned by the manager prior to deduction of trading expenses. Now, trading expenses are typically implicit in gross return. Now, think about if you buy stocks, for example, or sell stocks, for example, and you ask the stockbroker to credit your account. Before they credit your account, they will deduct the trading expenses. In fact, whatever money you get is going to be net of that. So it's already implicit. So the idea here is that you do not take out trading expenses out of gross return. And often use measure of investment manager skills because it does not include expenses related to management or administration. And so this will be the correct answer, and this is what they want to check if they ask you this kind of question. Trading expenses, do not ignore it, but management and administration fee should be taken out of gross return to get what we call net return. Now, in terms of leverage, the test here is to, if you understand the relationship between when you use leverage between levered return and unlevered return. Let's look at this question. The strategy of using leverage to enhance investment returns amplifies gain but not losses, doubles the net return if half of the invested capital is borrowed, increase total return, investment return only if the return earned exceeds the borrowing cost. Now, what I would like you to do is to remember this formula. Now, return on the portfolio, that is your levered return, over the value of the debt, or the value of your equity, in bracket, return of the portfolio minus the cost of borrowing. that which is your RD. If you remember this relationship, you can use it to answer so many questions when it comes to liver. Now, here's it. Let's take, for example, that RP is 10%. If RP is 10%, which means RP inside this bracket would also be 10%, right? If RD is 5%, then it means that the difference in this bracket will be 5, will be positive, which means by the time you multiply by VB over VE, you still have a positive number, which might be small. When you add it to your RP, it means your RL will be larger, right? What if your RP is the 5 and your RD is 10, which means the difference between that bracket, in that bracket will be a negative number, right? By the time you multiply by the VB and the VE, you still have a negative number. And which means eventually you have to deduct that number, no matter how small it is, from RP, which makes it lower than your RL, which makes it lower, which makes your RL lower. Now, the point here is, what they want you to know is the size of the amount, the cost of borrowing in relation to the portfolio return is important. If the borrowed return is larger than the portfolio return, you will always get a lower number for RL. If it is smaller, you will always get a bigger number for RL. So even though numbers are not given, you can still answer this question. If you go to the option A again, it says amplify gains but not losses. If you made a loss in this case, let's say your RP is -10, which means RP in this bracket is -10. Your RD is already -5. So -10 minus 5 will give you -15. Therefore, is amplifying your loss as well, because you're going to end up with a higher negative number at the end of the day. So option A is not correct because it amplifies both loss and both gains and loss. Doubles the net return if half of the invested capital is borrowed. Now, not necessarily. This translates the translation here. VB over VE can be 50%, but what determines the impact is still the difference between RP and RD here. So you cannot just simply say that it's going to translate directly to half, because you're still going to deduct RD in this case. Increase total return only if the return end exceed the borrowing cost. And that is what we've explained before. If RP is greater than RD, it means that number, and you find the fraction with VB and VE, you will still have a small positive number that you add to RP, which will be larger. So essentially, for leverage questions, they want you to understand the relationship between all of these. So if you can remember this formula and the relationship between this formula, when one is bigger than the other, when one is lower than the other, how it translates to RP and RL, it helps. And so I would say that this formula is one formula you should try as much as possible to get familiar with going into the exam hall as well. Now, candidates often get confused in terms of what is the right sequence from gross return and all of that. This is the right sequence. This is the sequence you should follow. Gross return, when you deduct fund expenses, gives you net return. Now, remember that you always ignore trading expenses because they're implicit in gross return. Then when you adjust for debt, which is the levered return, when you adjust the net return for debt, that gives you the levered return. When you adjust it for tax, it gives you the after-tax return. And then when you adjust for inflation, it gives you the real return. Now, an acronym or something that I've coined that might help you remember the sequence is gross or net, levered taxes are real. Gross or net, levered taxes are real. So you move from gross to net to levered to taxes then to real return. That is how the sequence is. So think about gross or net, levered taxes are real. It's just something I coined to help you, remember. This is an example of how you can apply it. For example, now this question says at the beginning of the year, an investor holds £10,000 in a hedge fund. The investor borrowed 25% of the purchase price, which means it used them, and then 2,500 at an annual interest rate of 6%, right? That is the borrowing rate, and expected to pay 30% in taxes. It has gross return, it has trading expenses, it has managerial and administrative expenses. So You might get question in which some numbers are given, but you don't necessarily have to use all the numbers. So here you already know that trading expenses are to be ignored. So you are not going to use that 1.1 that you're given. So to get your net return, you use your gross return and your managerial expenses. Where you get the difference, then you can then that is your net return. Then you can then apply the delivered. Delivered is what you do first. After that, you apply the tax, and then after that, you find the real return. This does not require you finding the real return because there's no inflation number given. So after tax return is where you will stop. But all the numbers you're given, all the numbers you need are given here. So this is just an example to showcase that. Let's think a bit about risk premium on the time value of money, I believe. Which of the following risk premium is most relevant in explaining the difference in yields between 30-year bond US issued by the US Treasury and 30-year bond issued by a small private issuer? Now it says inflation, maturity, and liquidity. Let's start with maturity. Since they both mature the same period, they should have the same maturity premium. Inflation as well, because they are the same period, they should have the same inflation premium. Because when you're looking at investment, you look at the inflation, expected inflation over that investment period, and this investment period for this is 30 for both of them. So you're going to be looking at expected inflation over 30 years. So that should be the same. But from a liquidity point of view, it's not very clear if you look at it ab initio, if the difference is coming from liquidity, but they have given a small clue in the question to say small private investor. Private means it is not a publicly listed company, which means it might not be known. Small also means that it's not a very large organization. These two put together means that the size of the issue will be small. If the size of the issue is small, it means it's most likely to be illiquid, because one of the factors that helps with liquidity is size of the issue. The reason why federal government bonds in the Nigerian context is liquid is because the size of the issue, compared to maybe a bond raised by a corporate entity, right? Corporate bond. Corporate bonds are not as liquid because the size is typically small, right? But treasury issues are typically larger. And so in this question, the correct answer will have to be liquidity being the challenge here between the two. Now think about time value of money. It's important that you go into an exam with some of these very basic formulas or tools to be able to handle time value of money. Some of these formulas, when you remember them, you can actually use them in so many other different scenarios within the exam. But here's what to remember when you're dealing with time value of money. We can add amounts of money only if they're indexed at the same point in time. What do we mean indexed? If they're indexed to year one, every cash flow index to year one can be added. Either it's positive or negative, they can be added. So if I have negative 30 and positive 40 and positive 50 in the same year, I can simply just add all of that number and use one or the answer as my number for that period. So numbers that are indexed to the same period can be added. For a given interest rate, the future value increases with the number of periods. Here, talking about relationships. So if you look at the formula given in blue at the top, you will see for a given interest rate R, the future value increases with the number of periods. That is, if N increases, FV increases given R. So if R is 5%, for example, and N is 10, you get a number. If N increases to 20, then the future value increases as well. What this means is that you can get a question in which they increase N, they will still give you numbers, but you might think, oh, I need to calculate. You don't need to calculate. If you understand the relationship between N and future value, then you can answer the question. If N increases, the future value increases as well. If R also increases, the future value increases. If PV increases, the future value increases. They all have an increasing relationship with FVN, or future value in this case. For a given number of period, the future value increases with interest rates as well. So if R increases, the future value also increases. So you get a question in which you're given an initial R or an initial N, and then they give you another scenario in which the R or the N has increased. Just know that your FV should be a bigger number. You might not need to calculate. So that's the point here. Let's look at this question. This question: you are a lucky winner of your state lottery of 5 million taxes. You invest the winning in a 5-year certificate of deposit. The state promises 7%. How much will you have at the end of 5 years if your money remain invested at 7% for 5 years with no withdrawal? This question is just a classic future value, and all the pieces you need, the present value, the R, and the number of period in which it's invested, they are all given. So the point I try to use this to establish is you can get this type of question if you do not remember the tool, which is this simple formula. You will, then that's when you struggle. So it's always important to arm yourself with this tool. The questions might not be difficult. You might be able to actually pick the pieces you need, but if you forget the tools, it becomes a challenge. So I strongly encourage that, this formula is one that you should this is another formula with future value. Always look out for when the future period is moved to a time. In this question, for example, rather than 0, they moved the starting time from to year 5. A pension fund manager estimates that his corporate sponsor will make 10 million contribution 5 years from now. So that contribution is not today. The contribution is in 5 years to come. So the PV is in 5 years. So what this question would eventually do is calculate your PV using your formula, this formula, from 5 years, which means you start from 5 years to the end of the period. Then if the question asks you present value today, you can then discount that number back to today. So just be careful when you're dealing with present value that is not starting in year 0. That's the point I try to make here. Always remember that sometimes compounding might be done more than once in a year, which we call non-annual compounding. For time value of money questions, these are some of the minor complexity that they might put in. So if compounding is done more than a year, more than once in a year, then it means you need to divide your R and also multiply your N. That's the simple change that you need to make in your formula. The formula you still realize is still the same, is 1 plus R, but in this case, you divide your R by M, and then you also multiply your Rn by M as well. So that's why I said it's very important for you to at least go handy, get this formula handy. You can sit in an exam scenario to solve your question. Same thing here. I'll just skip this. You might get a question in which you have what we call continuous compounding. Continuous compounding, you only need to remember a formula, and the formula is that rather than PV into bracket 1 plus R raised to power N, or the 1 plus R is simplified into just E. E is an exponential number that is available in your calculator. So you can see that the formula is still the same, but they have replaced the 1 plus R with E in this case. So look out for that if you're being asked a continuously compounded question. What if you're doing with, what is the relationship or the effect of non-annual compounding? And this is something that can be tested as well. The more frequent you're compounding, or the more the frequency of your compounding, the higher the future value. So if you check, when you compound annually, which means you compound just once, annually means you do it, your future value is 1.08. Well, when you compound semi-annually twice, you see it goes to 1.083. And when you go to continuous will always give you the highest, it's even more frequent than daily. And that gives you the highest rate. You might be given a question in which you're told that the compounding is daily, that the compounding changes maybe to a daily or a monthly. And then what is the value? Just go and look for a higher value, because you know that with higher the more the frequency of compounding, the higher the future value will be. So clearly, the new future value will be higher than the old future value when you had less frequency in compounding. So really, that's just what this tries to show. Stated and effective annual rate. This is also something to look out for. When investment pays interest more than once, stated rate is different from effective rate. Sorry, the font I used here is somehow. So when it pays interest more than once, then stated rate is clearly different from an effective rate. So how do you calculate effective rate? If you can remember this formula, it helps. How do you know what the periodic interest rate is? The periodic interest rate is the stated annual rate, which will be given to you in the question. Your M is the compounding period per year, compounding period per year. If it's months, if it's in months, then it's 12. If it's weekly, it's 54. If it's, depending on the frequency of compounding. So really, and if it's continuous compounding, for effective rate for continuous compounding, just replace the 1 plus R with your EA as explained earlier. So good. Single cash flow, still the same formula, but always what is an annuity is a finite set of level sequential cash flow. Now, two things to remember here: an annuity is the same amount of money, because that's why we say level, which means the amount you get in year 1 is the amount you get in year 2, is the amount you get in year 3, and it's always very finite. That is, it has an ending date. That's what makes it an annuity. There are 2 types of annuity, which is annuity, ordinary annuity. It has its first cash flow occur 1 year period from now. That is the normal one we all used to, because if someone gives you money to invest now, the first cash flow or the first return will be at the end of 1 year. But we also we have what we call an annuity deal that receives its first cash flow immediately, which is indexed to 0. There is also what we call perpetuity. Perpetuity is different from annuity, and the difference is that it's a perpetual annuity. That is, when you get that amount of money for the rest of, for life, technically, that's called a perpetuity. An annuity has a finite time. A perpetuity does not. What if you're calculating? So this is looking at an ordinary annuity. Now, in an exam situation, you might be given what we call the future value of an annuity. So you might be given the annuity and then the future value of an annuity. Now, if you remember this full formula, which I may argue that a lot of candidates might find difficult really internalizing and carrying into the exam. If you can, fine. But in an exam scenario, you might just be given what we call the future value of an annuity. That future value of an annuity already breaks down that bracket into one number. So all you need to do is just to multiply that number by the annuity figure that you have, and then you can work out your answer in that instance. The annuity factor for each year would for period would differ, because the end would differ. So that's one thing to look out for. If you get an annuity question, check if you're given the future value of an annuity. If you're given, just multiply it directly with your A, and you can use that number. Skip this. Future value of uneven cash flow. Uneven cash flow, you have to work uneven cash flow separately. There is no formula for calculating future value for uneven cash flow. How do you know you are dealing with uneven cash flow? Uneven cash flow means that the cash flow for year 1 is different from the cash flow from year 2, is different from cash flow from year 3. Either because you're increasing it at the same amount or a different amount or whatever, but it's just different. So if you get that, always calculate your future value differently. So which means you calculate the future value for 1,000. If for time 1 differently, you get 1.2. Calculate for time 3 differently, 4,000, you get 4,000 for 110. You calculate for year 5 differently, 6,000, you get 6,000. And then you add everything together to get your final future value. So if you're dealing with unequal cash flow, you then have to do each of the calculations separately and then add it at the end of the year. There's no formula that you can use to calculate all of the calculators at once. So it's important to mention that. A saver deposits the following amount in an account paying a stated annual rate of 4% compounded semi-annually. So this is the deposit, end of year deposit, end of year deposit. At the end of year 4, the value of the account is close to, so here is this is an uneven cash flow. So what this is asking you is to use the formula for uneven cash flow, but you will notice that they have added a bit of complexity. And in level 1, you can get a question that is straightforward, or they might add 1 or 2 steps of complexity to it. This is a question in which they've added 1 step of complexity. Now, this is in identifying the question. This is time value of money of uneven cash flow. Just looking at the different cash flow for each year. But the complexity they've introduced here is to say you compound semi-annually. And that's why it's always important to know, how do you adjust when you have to compound, more often. In this case, you divide your R by 2, and then you also multiply your N by 2 just to get for each of the calculations that you're doing. So just to highlight that, this is the future value of a lump sum. So let's leave time value of money and just move on to measure of central tendency. Measure of central tendency includes measure of central tendency, but also include other measures. Measure of location rather. Now, when we say location could be at the center, could be at the upper end or the lower end. So measure of central tendency is also a measure of location. So you get a question in which is asking you measure of location, and then you get a mean. Mean is a measure of central tendency, but it's also a measure of location because the mean is measuring the middle. The middle is also a location. Mode is a measure of central tendency, but it's also a measure of location. But there are other measure of locations that we know, quintile, quantile, and all the rest. They measure different location on your spectrum. But the measure of central tendency only just measures the middle. And there are 3 of them: the mean, median, and the mode. What's important for you to note going into exam is really the calculation of mean is typically very simple, like we knew from uni or you knew from secondary school is the same. Do not expect that because it's CFA, then the calculation of mean is a bit more technical. No. But remember that if you're dealing with sample mean, you then need to maybe do an n-1, or you do divided by n. But generally, the formula is sum up all of the numbers and just divide it by total number, which is your n, and leave it there. But for the purpose of exam, the characteristics of mean are, I would say, perhaps much more testable. Now, arithmetic mean is sensitive to extreme values, which means if you have an outlier on extreme value, it can bias your mean, because the mean uses all of the observation. So let's say you have 2, 6, 9,000, and 24,000. The mean will use all of those numbers. What will your mean be? Your mean will be in thousands, which is very far from 2 and 9. So that's what we call an outlier. And mean is very sensitive to extreme value. Arithmetic mean can be pulled sharply upward or downward by extreme large numbers, which is what I've explained. So if you have an extreme large number, for example, your mean will be pulled towards that number. If you have an extreme small number, the mean will be pulled down towards that number. So when you have that issue, the common approach is to report the median or maybe the mode, as the case may be. We also have the median. Now, in terms of the median, knowing the formula is important. So if it's odd number, it's easy. n+1 divided by 2. And if it's even numbered, then you have 2. You do n divided by 2 and n+2 divided by 2, then you find the average of those 2 numbers. That's from the calculation point of view. But you can also be tested, maybe not calculation, just for you to understand the characteristics of the relationship. And you might just get a question like in a statement form. A distribution has only one median. So let's remember that a distribution will only have one median. Outlier does not affect median. Why? The median does not use all of the observation. It uses the middle observation. So the median does not use all the information about the size. It focuses on only the relative position, which is the middle. But calculating the median can be complex, might be more complex than the mean, because if you're dealing with even numbered observation, that additional step of calculating can be a bit tedious. So those are the disadvantages. Understanding frequency table. Absolute frequency is the absolute number of occurrence. Now, first, it's important to understand what we call bin. Bin is like buckets, right? But those buckets are of the same size. Those buckets are of the same size. So bin are always of the same size. So if you see -4, -5 to -4, the difference is the same as minus 4 to minus 3 is the same as minus 3 to minus 2. So the size of bins are always the same. The total number of observation in the bin is called the absolute frequency. So think about it as a basket. So if in one basket I have 2 and in another basket I have 7. So it means that the absolute frequency in basket 1 is 2 and the absolute frequency in basket 2 is 7. That's what this shows. So if you look at absolute frequency here, you see that being 0.0 to 1.0 has the highest absolute frequency with 555 observation. Relative frequency takes the absolute frequency and divide it by the total number of observation, right? So in this case, the total number of observation is 1258. And so when you take 1 over 1258, it gives you 0.08. That is relative frequency. So you take the absolute frequency over the total frequency. Cumulative absolute frequency adds up all the absolute frequency up until that point. So I tell you, the cumulative frequency is very particular about the location at which you're calculating it. So if I'm calculating cumulative frequency, or if I'm asked to calculate cumulative absolute frequency at being 2.0 to 1.0, then I'm going to add up all of the absolute frequency up to that point, which will be 1.8 in this case. And then cumulative relative frequency takes the cumulative absolute frequency over the total frequency as well. Now, here's what to note, which is testable. The highest absolute frequency equals highest relative frequency. Your highest absolute frequency will give you the highest relative frequency. And if you check, the highest relative frequency is 44.12, and it corresponds to your highest absolute frequency. Number 2 things to note here is highest cumulative frequency will occur in the last bin with at least an observation. The last bin with at least an observation. So if you check, the last bin here is bin 4.0 to 5.0. Does it have an observation? The answer is yes, it has one observation. It means that is where you find the highest cumulative frequency of 100. Now, let's imagine that this 4.0 and 5 to 4.0 has no absolute frequency. Let's say it's 0. It means that you will have gotten 100 at this point, which the point where you have 9.92, you will have 100 there. And you also have 100 in the second one, where you have 4.50, which means your highest cumulative frequency would occur earlier because you do not have an observation in the last bin. So always remember this. If you're asked, where are you going to find your highest cumulative frequency? It is in the last bin that has at least one observation. So now what do you do with outliers? Dealing with outliers, you can do nothing, or you use the data without adjustment. You can delete all the outliers. When you delete the outliers, you call it a trimmed mean. Now, typically how you deal with trimmed mean is that you will snipe it at the top and at the bottom. So let's say that I have observation of 1, 2 to 10, and I consider 10 to be an outlier. What I will do is I will cut off 10. I will also cut off 1. Because in trimming, you must cut off from both ends. Because what makes 10 an outlier also then makes 1 an outlier. How are we sure that it's not 1 that is the outlier? Because how will something be taking a value of 10 and you are taking a value of 1? So the same explanation or the argument we can have for 10 being an outlier, we can have it for 1 being an outlier as well. So when you're trimming, you cut off from the top and you also cut off from the bottom. Now you can replace the outliers with another value. If you do that, you're winsorizing. That's called winsorized mean. Winsorized mean does not take off, it replaces. So for example, in the example I gave, rather than take out 10, we can then replace 10 with maybe 9. And rather than take out 1, we can then replace 1 with 2, which means you would then have 2, 2, 3, 4, 5, then you get to 9, you have 9, 9, rather than have 9, 10. So that would be winsorized mean. So the difference between winsorized and trimmed is that trim removes, winsorized replaces. So that's one thing to think about. Now, what are the other measures of location that you would typically that you might be asked? You have what we call quartiles. Quartiles divide the distribution into quarters. And for some of us, we're familiar with quarter 1, quarter 2. So if you apply that to a year, quarter 1, quarter 2, it means that the year is divided into quartiles. Q1, Q2 is quartiles. Quintals is into fifths, which means it's in 20s, right? That is quintals. We have decimals. Decimals is in tenths, which means you have 10, 20, it counts in 10, 10, 20, 30, 40. Then we have percentile. Percentile counts in 100, but essentially it counts in 1. Because it's in percentile, you can have 1%, 2%, 3%, upward to 100%. That's percentile. Then we have what we call the interquartile range. In interquartile range, you take the quartile, you take the top quartile and you deduct the first quartile. That is, you take the lowest number in the first quartile and you deduct that from the highest number in the third quartile. Now, if you look at the box here, now the box here circles the interquartile range. All this range is the interquartile range. Now, how do you then find what the interquartile range is? You take 460, which is the highest number in the top quartile, and the lowest number, which is minus 0.29 in the first quartile. And so you do that difference. That difference gives you what we call the interquartile range. Well, you can get a question in which you're asked to find the 10th percentile corresponds to observation in which P. When we say 10th percentile, because you're counting in percentage, therefore it will have the beginning and the ending. So what is 10 percentile? 10 percentile has a beginning and an ending. Where is the first beginning of 10 percentile is 1%. Where is the ending of 10 percentile is 10%. So everything from 1 to 10 is in 10 percentile. So in this case, the answer to this first question, because we're talking of the percentile, is being 2, which is both 5 and 10. You look at the cumulative, and that's where we have 10 as well. 5 and 10, those two being 1 and being 2 will be your answer. However, when you say second quintile, what is quintile? You remember that quintile is in 20s, in fifth, right? Now, it has a beginning and an end. The beginning of the second quintile is where it starts, and then the end is where it stops. It is different from percentile, where you start from the beginning of the data to where that point is. The reason why it's counted like that in percentile is that really the beginning of a percent, if you say 100%, the beginning of 100% is 1. The end of 100% is 100. If you say 10%, the beginning of 10% is 1. The end of 10% is 10. But in quintile, the beginning is the beginning of that quintile, not the beginning, not 1. So in this question, for example, it says the second quintile is, because we know that the second quintile divides into 2020, it means the second quintile will be between from 20 to, that is after 20 to 40, which will be being 5, being 6, being 7, and being 8. Now, this is different from the first question in which we took it from the beginning, right? And that's why I'm taking time to explain this. When we say the fourth quartile, again, fourth quarter has a beginning and an ending, right? Fourth quarter will be from 75 because quarter divides into quarters. That will be from 75 to 100. So that will be between 15, 16, 17, and 18. So that's how to look at it. Interquartile range, like we explained earlier, look for the highest number. In this case will be 58.3, and the lowest number, which is 34.72. The difference gives you your interquartile range. Now, it's important that you go into the exam hall knowing how to interpret the box and whisker plot. You might just be given a box and whisker and they will ask you a question about it. So it's important you are able to interpret it. Now, what interpretation do you need? In a box and whisker, there will be the green field. There will be a line that crosses the field. There will be a star on the field, and there will be some points, some lines, both at the top or at the bottom of the field. The line is the median. Now, notice the line necessarily does not cut exactly the mid half of the field, but that doesn't matter. That line is the median. Whatever number is quoted on that line, that is the median. The X is your arithmetic mean. Your X is your arithmetic mean. The upper bound of the green field is the upper boundary of your Q3. And the number given there is your upper bound of the Q3. The lower bound is the lowest bound of your Q2, which translates to the upper bound of your Q1. And so those two numbers are what you use to calculate your interquartile range. So if those numbers are given and you are asked to do interquartile range, those are the two numbers you would use. They might extend this question, adding a bit level of complexity for you to calculate what we call the upper fence and the lower fence. If you are to calculate the upper fence, then start by calculating your interquartile range, multiply by a constant number of 1.5, then you add your Q3, which will be given in your box and whisker to it. If you ask for the lower fence, start with a negative IQR. So whatever interquartile range you calculate, put a negative minus before it, multiply by the constant 1.5, then do a minus Q1, or the Q2 you're given here is the same number you're looking for. Then do that as well. What does the upper fence and the lower fence measure? You know, we have houses. When you build your house, you put fence. Anybody within the fence legitimately is, belongs to the house. Anybody outside the fence, that's not your house. Now, what this fence also establishes is outliers. So they can ask you this question to determine outliers. What that means is once you calculate your fence, any number or any observation outside of that fence is an outlier. Any number within that fence is not an outlier. So you can use fence to determine if a number or an observation is an outlier or not. So if you have a question in which it asks you, is this number an outlier? Then calculate your fence and use that to determine. That is the way to determine if the number is an outlier. Still just going with a measure of location. Here the question says the bin containing the median return is this. All of these are frequency table. Frequency table shows you the number of observations. So the way to interpret it is in the bin minus 32 to minus 37, the number of observations here is 1. So all of this is the number of observations. So where is the median? The median is like the middle number. So what you do is starting from the first bin, you add up until you get to the middle of the distribution, and then you find out where that is. And I think if you do that, you find out that this is 1 plus 1 plus 1 plus 1, that is 4, plus this is 4, that is 8. And if you continue like that, you get to where the middle, is. And when you get where the middle is, you identify what bin that relates to. So the reason why I'm bringing this up is you might get a question that is in a bin format like this, but you can still be asked a median question on it. So don't always expect that they will give you 2 numbers or they give you actual numbers and they will tell you, oh, calculate the mean. You can actually be asked to calculate a mean given a frequency distribution table. Now, measure of dispersion. There are a number of measures of dispersion that were discussed in the curriculum. Sorry, can you put your device?
Did you connect to my existing?
Can you put your device on mute, please? Can you mute your device? Right. So we have what we call range. Range simply is just the difference between the highest observation and the lowest observation. But you also have what we call the mean absolute deviation. What are the calculations to all of this? But I think going into the example, it's important to arm yourself with characteristics and relationships. MAD is superior to range as a measure of dispersion. Why is it superior to range? Because it uses all of the observation. The range only uses the lowest and the highest observation. Then MAD is difficult to manipulate mathematically. So when you're calculating MAD, mathematically manipulating it is difficult. The next is your variance and standard deviation, which is, do not go into the example without getting very familiar with calculating variances, standard deviation. You will need that to understand, interpret, answer so many questions in the example. But what I would say about variance and standard deviation is, always note that the variance is that you multiply an observation with itself. The variance of an observation with itself, that gives you variance. And how do you know that? You can see that it's raised to power 2. Now, observation minus the mean based on that observation, then you multiply it by 2. That is the square. All right, that's what your variance is. So standard deviation, you find the square root of that. That gives you the standard deviation. There are much more sophisticated way. I mean, you may not get a question that is just straight to the point like that, but I want to trust that you taking some time to look at how to calculate, piece together your variance, and because you need it for so many things in QM. Then the coefficient of variation takes your standard deviation over your mean. All of these variance and standard deviation are called absolute dispersion. Coefficient of variation is relative dispersion. So you can get a question in which you're asked to differentiate between absolute dispersion and relative dispersion. Relative dispersion because it's related to something. You will see that for coefficient of variation, standard deviation is relative to mean. So it's called relative dispersion. But your variance or standard deviation, they are an absolute number. It doesn't really mean anything on itself because you're not really comparing it to anything. But coefficient of variation is a relative measure. The other thing is coefficient of variation also permits direct comparison across different databases or data sets. Because it's relative, you can easily measure. You can use it as a measuring tool. The same way where, you cannot use absolute stock prices, for example, to measure difference. For example, you can't say because one stock is selling at 6,000 and another stock is selling at 14 naira, it means that 6,000 stock is much more valuable than 40. That's what your absolute dispersion kind of do. But when you do PE, for example, you can then compare. So if one PE is 10 and one PE is 5, you can then use that PE as a basis to say, oh, maybe one is undervalued, the value of one is higher value, or one has lower value. That is what relative does to you. You remember that P is a relative measure. So that's the point. Now, coefficient of variation is also scale-free. That is, it has no unit of measurement. And that is the reason why you can actually apply it across board. Now, downside deviation. Just speak a little bit of downside deviation. I want to believe again that you have taken some time to look at how to calculate standard deviation. But you might then get a question on target or downside deviation. And the essence of downside deviation is deviation measures all of the variance, both good or bad. And the example I like to give is someone promises to give you 30 naira and then gives you 10 naira. Then your expectation is affected negatively. What if the person then decides to say, oh, I'll give you 60 naira instead? Then the person did above your expectation. Now, risk is measured in the sense that as long as what you get is not what is promised, you say that there is a risk to it. So therefore, even the 60 has a risk to it, the 10 has a risk to it. So all of those calculations go into your variance, actually. But are you really concerned about the 60 risk? If someone gives you more than expected, are you bothered about that? You should. That's not a worry. It's a risk, yes, but it's a good risk. Everyone likes that risk. Even me, I like that kind of risk, right? So the point here is sometimes the concern might be the downside risk. That is the risk of it not doing up to your expectation. When that is the question, how you will know they are asking you for downside deviation is that they will give you a target instead of they can give you a mean, but they will give you a target. Once they give you a target, all you need to do in your calculation is to replace that target with the mean. Replace the mean with the target, and then do your calculation and find your deviation. So if you look at the table to the left, because the target is the deviation, right? Observation minus 3. It's 2. The difference is, and so you do not calculate square deviation on the basis of 2. So that's what it means. So anything that is above your target, you ignore it. Anything that is below your target, that is why it's called downside. Anything that is below your target, then that is the one you calculate deviation on. So for example, -1, when you say -3, it will give you -4, which is below your target. Therefore, you find the square. You square that and it gives you 16. And so really that's how to deal with downside deviation question. So always note that all you need to do is to replace the mean with the downside deviation. However, if the target is higher, it means there will be more deviation below target. So square deviation would be higher. What do I mean? If you set a higher target, it means that the observation that will not meet up at the end of the day, your sum is lower. It means you will have more observation that will scale it, that you will ignore, and therefore will not read into your squared deviation. So you might be tested in such a way that higher deviation, higher target and lower target, which will give a higher downside deviation. A higher target will give a higher standard downside deviation. Because when you set the target higher, the total number of observations that will not meet up with that observation will be higher, and all of those ones you will calculate squared deviation score. So it's important to know. The other thing that is important to know here from a relationship point of view is total deviation would always be higher than target deviation. Remember that when we calculated the total deviation, we calculate both the total deviation from the upside and the downside. But now that we are focusing on the downside, we're only focusing on one part of some part of the deviation, which means technically it's not going to be as big as your total deviation. So your target deviation will always be smaller than your total deviation. So those are the relationships that you should get familiar with getting into the exam. You may not be asked questions. You may not be given. You may not need to do calculation, but understanding the relationship helps. This is a question that is asking based on coefficient of variation, and just using the formula, you can always find that. Do not think that this question is out of ordinary. You can as well get this type of question in an exam hall. So what's important here is that you remember these two. And let's look a little bit at dispersion. Measure of dispersion when we look at normal distribution. What are the characteristics of normal distribution? The mean and the median and the mode are equal, which means mean, median, and mode are equal in a standard deviation. What this means is that if I'm given a mode in a question and it's a standard distribution, I know what the mean is because the mean is equal to the mode. So, for example, you're given a question in which you need to use the mean, and you're not given the mean explicitly. If you're told that the distribution is a normal distribution, you can take your mode as mean because the mode will be equal to your mean and will be equal to your median. It is completely described by two parameters, which is the mean and the variance. So your normal distribution is completely described by two parameters, mean and variance. Now you can have what we call positively skewed and negatively skewed. Positively skewed and negatively skewed they can be asked in statement form. And so when they're asked in statement form, how do you interpret and get it correctly? So here is the way to think about it. When you see any distribution, let's say you're given this chart. Number one is, where is the tail? The tail is not the top part. The tail is the spreading out. So you can see where the tail is, the spreading out. In this normal distribution, the spreading out to the left and the spreading out to the right are the tails, because there are two tails. The peak, that top of the peak is not the tail. That top of the peak is measuring frequency. So where you see a high peak, means that there is high frequency. High frequency. When you see a low, where the green is low, that is low frequency. High frequency is where it is high, low frequency is where it's low. Now, the tail, how do you tell if it's positive or negative? How do you tell if it is positive or negative? Now, a simple way to know positive and negative and to measure its magnitude is, assume, let's say you do not know if this is positively skewed, right? Assume that your mean is 0. If your mean is 0, what does that mean? How do you interpret this? It means that you have negative, which is losses, because minus is losses, right? But the minus is high. You have high frequency for the negative, which means the losses are frequent. You have losses that are frequent, but those losses are not very large, because if you think about where mean is to where the end of that chart is, it's not so far, right? Now, it means that you have frequent losses, but those losses are not large. The losses are frequent, but they are not large. Now, let's go to the right side. The right side of the mean, they are positive numbers. The mean is 0. You find out that the frequency is not high. Which farther, The farther it's spread, the bigger the number, because the farther you add to 0, the bigger the number it is, which means you have less frequent but big gains. And that is how to know positive skewed and negative skewed, because they might just ask you this question from an explanatory point of view alone. Now let's look at it. A distribution with positive skew has frequent small losses. The losses are small. Look at the side of the mean. After the negative side, the losses are small because it's not so spread out, but it is frequent. That's what we mean by frequent small losses and few extreme gains. Why do we say few? The frequency is small, but the gains are extreme because it is spread out. That is how you know positive skew. Positive skew, frequent small losses and few extreme gains. Negative skewed, frequent small gains. You can see where the gains are. To the side of the mean, to the positive side of the mean, if you assume the mean is 0 again, you will see that the frequency is higher, but the positive number is not big because it's not very spread out. So that's what we mean by negative skew has frequent small gains and a few extreme losses. The losses are few, but they are extreme. So that is how to differentiate between positive skew and negative skew. Now, the shape of the tail also is measured, that's the measure of kurtosis. The kurtosis is the measure of the combined weight of the tail. Again, the tail is not the protrusion. For example, if you look at this chart, the tail is not this upper part of the green. It's not the upper part of the blue. It's not how right it is. It's how spread out. The tail is how spread out it is. So if you look at the green chart and the dotted blue chart, you will then realize that the dotted blue chart is more spread out. What that means is that the dotted blue chart has a fatter tail, because when you combine the tail of both ends, the absolute number is bigger than the absolute number when you combine the tail number of the green one. That's how we measure fatter tail. Fatter tail than normal distribution is called leptocortic. Thinner tail than normal distribution is called platcortic. Normal distribution is called mesocortic. How do you know if it's fatter tail, normal tail in numbers? If kurtosis is above 3, then you have a fat tail. If kurtosis is below 3, you have a thin tail. If it's equal to 3, then you have a normal distribution. You can be given a table in which just the kurtosis number is given. So all you need to do is it 3? Is it above 3? Is it below 3? And then you can use that to make your decision. Measure of relationship. Let's look at correlation. Correlation is covariance over standard deviation of X and Y. It's important that you remember this particular formula going into the exam, but it's important to also know the properties of correlation and interpretation of correlation. Correlation ranges from -1 to +1. -1 to +1. Correlation of 0 means there are no correlation. That's how to interpret it. Now, what that means is absence of linear relationship. Now, correlation of 0 does not mean that there is no relationship. So you get a question in which they say, oh, the correlation is 0. It means that there is no relationship. No, that's not correct. There might be relationship, but what we're saying is there is no linear relationship, because correlation only measures linear relationship. A positive correlation close to +1 indicates strong positive linear relationship. Close to a correlation of 1 indicates perfect linear relationship. That is a 1-to-1 relationship. Negative correlation close to 1 means strong negative linear relationship. Now, what this means is it's important that how you interpret correlation. If it's close to 1, either positive or negative is strong. Now, the sign just tells relationship or positive relationship. But if it's close to 1, is strong. If it's close to 0, then it's weak, right? Now, limitation of correlation. Correlation only measures linear association. It does not measure non-linear association. Now, it can be unreliable when outliers. And so sometimes there's a correlation. It doesn't mean that there's still a relationship. It's like saying that there is a correlation between lizard and Ikoyi, for example. There is no reason why you would expect that there will be more lizard in Ikoyi. It can happen as you can actually measure it and find more lizard. But that does not mean that there is something That does not mean that it is scientifically, it means anything scientifically or economically. It might just have happened randomly, and that's what we see here. Now, let's look at probability, which is another area where candidates also find a bit challenging, especially with the notation and all of that. Now, what are the type of questions you can get here? You can get a question in which you are asked to calculate expected value. Remember that the expected value is also your mean, actually. So know that expected value is also mean. So what this means is you can calculate mean using probability, or you can calculate mean the way you already know how to calculate it. So if you're given this and you're asked to calculate expected value, you're asked to calculate mean. But the way to calculate here is simply multiply the probability of each occurrence by the outcome and then sum it up. But before you do that, check that your probability sums up to 1, because your probability must always sum up to 1. Then when you are using probability, do not divide. You know, when you're finding mean, you have to divide by n. But when you're using probability, you do not need to divide by n anymore. The reason why you divide by n is n actually assumes that it's the same probability across. But here you've been given the probability and they are different. So use the actual probability instead. Then you can then be asked to find the variance of a random variable. Now, if you're asked to find variance, you know, when you're asked to find mean, you can also be asked to find variance. How do you deal this? In dealing this, the first thing you need to do is to calculate your expected value, which the first formula gives, which means you calculate 0.15 multiplied by 2.6 plus 0.45 multiplied by 2.45. You get that calculation. Once you get that calculation, then you then do your observation minus that mean. For example, it will be 2.6 minus the mean I calculated. Then I will then multiply that by 0.5 for that. I'll also then go to 2.5 minus the mean I calculated. I will multiply it by the 0.45 and go through it like that. Then I will add everything together because there's a sigma in front. You add everything together to get your variance. So that's how to approach it. Do not think that, oh, because of the notation, it is hard. Look at what you've been given. First step, calculate your expected value, which is your probability multiplied by the outcome. The second step is calculate your variance. Take each of the observations, deduct your, then add it back together. Mutually exclusive and exhaustive scenario, we're talking about the total probability rule. What this means is mutually exclusive and exhaustive is that all of the likelihood, all of the scenarios are covered. For example, if I want to calculate the probability that it rains today, what are all the scenarios? All the scenarios is that it can either rain or it might not rain. So there are two scenarios. I must cover. Now I would then say, what's the probability that it will rain? I'll get that. What's the probability that it will not rain? I'll get that. That is what I will work with. So it must be mutually exclusive and exhaustive. All the complete what I call a probability tree. This is a probability tree. Now, in this probability tree, there are what we call probability of the scenario, right? Probability of the scenario. Then we have the scenario. Then we have the outcome. Then we also have what we call the joint probability. How do we arrive at joint probability? You multiply the probability of the scenario. So, for example, 0.60 multiplied by 0.25 gives you the joint probability of 0.15. 0.260 multiplied by 0.75 gives you this joint probability of 0.45. So that is how the joint probabilities are calculated. Now, here is what the question you might get. So you get something like this is an exam in which it's not filled. How do you do it? Now, remember that the joint probability is, in this case, 0.8 multiplied by 0.5 gives you that joint probability. Now, the question asks you for operating cost. Now, the operating cost, you've been given a formula to calculate it. So, for example, you're given branch as 125. You plug that branch into X, because that your branch is X, and then you calculate this as Y. And because your operating cost, this is the model, your operating cost is Y, and that's how you get it. So in this case, you will say 1.25 plus 0.65 multiplied by 125. That will give you the operating cost for this scenario. And with the probability tree, you can then get the expected cost at the end of the day. So just telling you how you can use that. Then we'll talk about the base formula. The use of the base formula is a rational method for adjusting our viewpoint when we are faced with new information. Now, there are two things you can do with this formula, and there are testable, two ways in which you can be tested here. The first is that they can ask you to calculate the probability of an event, Then the second way is that given a set of prior probability, they ask you to update your probability because new information has been given. How do you deal with this? If the question says calculate the probability of an event, the formula to remember is this formula. And please, it's important that you go into the exam hall with this particular formula handy as well, especially for probability. Now, if you have the formula handy, you're only looking for three things. Look for the probability of the scenario, then look for the probability of the outcome given that scenario, and look for the probability of the outcome. Now, a lot of candidates find it overwhelming. How do I know which of this is? Here is the systematic way to think about it. Start by looking for the probability of the scenario, that is, identify the scenario. Now, let's look at this. In a typical year, 5% of all CEOs are fired for performance reason. Assume that CEO performance is judged according to stock performance, and that 50% of stock have above average rating or good performance. Now, this here is the scenario. How do we know? When you evaluate a stock, it can either be good or not good. So anything that gives you those two or three possible outcomes, that is your scenario. That is how you pinpoint your scenario. It says above good. Now, if this is good, what is the probability of that scenario? It says it's 50%, above scenario. That is how to identify the probability of the scenario. The next thing you want to then find an outcome that is tied to that scenario. So if you read further, it says, empirically, 30% of all CEOs who were fired had good performance, which means this particular outcome is tied to this particular scenario. So that is the second thing you need. And then the last thing you need is the probability of the outcome. Now, what is the outcome? CEO being fired. And that we have at the beginning of it, which is 5% of all CEOs are fired. Those are the three things you always need. When you have those three things, then this is what you do. Put the probability of the scenario at the bottom and the other probability of the outcome at the top. Probability of the scenario at the bottom, probability of the outcome at the top. Do your calculation. Because that is what this formula is. The probability of B is the probability of the scenario, which is at the denominator. The other two are at the top. Probability of outcome given scenario and the probability of outcome. So you can just think about it that the probability of outcomes are at the top, the probability of the scenario is in the bottom. And you do that calculation, you get your answer. Let's look at another question, just to test if following this this process, if it works at all. Now, an analyst estimates that 20% of high-risk bonds will fail. If she applies a Brancom's prediction model, she finds that 70% of the bond will receive good rating. Again, if the bond does not receive good rating, then it will receive a bad rating. That shows you where your scenario is. And therefore, what is the probability of that scenario? 70%. 70% of the bond will receive good rating. Imply that at least less will fail. Of the bond that failed, only 50% had good rating. So you will notice that this 50% is tied to that scenario. This 50% outcome is tied to that scenario. So this 50% is the probability of the outcome given that scenario. Then the third thing you need is the probability of the outcome, which is the first thing you're given. 20% of high-risk bond will fail. That is the outcome. And so you have all the pieces you need. Remember that the scenario is at the bottom, the outcomes is at the top. Do your multiplication and you'll get your answer. Now, the other way in which base formula can be used is to update probability given new information. So now, if the new information is available, the question can then ask you to update your probability because of given that new information. This question really is not very difficult because you'll be given everything you will need. The first thing you should look out for that you'll be given is you'll be given what we call prior probabilities. Prior probabilities are the probabilities of those events that exist now. They will give it to you. The second thing they will give to you is based on the likelihood of that new information. So that means that the different likelihoods of that new information. They are called conditional probabilities. you use conditional probabilities to calculate unconditional probabilities. And how do you do that? Based on the new information that will be likely, multiply each of the likelihoods by the probability of those likelihoods. So, for example, the probability of the likelihood of DriveNet expand and EPS exceeds consensus is 0.75. I will multiply that by the probability of exceed consensus, which is 0.45, plus 0.2 multiplied by 0.3, plus 0.5 multiplied by 0.25. When I add all of that together, that gives me my probability, the unconditional probability of the new information. Then you have all the pieces to answer your question. Because the only thing you then need now is still using that same formula we had earlier. If you can remember, that formula is actually still technically the same. The question would then ask you to adjust probability for one of the scenarios. So if, for example, they ask you to adjust probability of exceed consensus, then it's fine. What you then need to do is go to the likelihood, pick the likelihood of exceed consensus, which is 0.75, put it at the top, and then the probability of the information which we calculated earlier, put it at the bottom, which is the probability of the scenario, and then the prior probability of exceed consensus, which is 0.45. That is the prior probability of the event, and then you work it out. Again, if you're asked to adjust any probability, go to the likelihood, pick it. That's what's on the top. The bottom is the unconditional probability you calculated earlier by taking each of the previous probability and multiplying it by the likelihoods and then adding it together. You then multiply that by the prior probability of the particular one they ask you to adjust. Whatever answer you get is what we call the posterior probability. And that's how to work with that. Now, you must also be very familiar with how to calculate portfolio return by weight. So if you have a portfolio in which are different weights and different returns, simply multiply the weight by the return and add it together. It's always important to know that. Also important to know how to calculate, your covariance. What is covariance? Apart from the formula, what is testable really is some of the characteristics of covariance, right? So for any given number of assets, variance is equal to n, and number of covariance is n multiplied by n minus n. I think it's important if you remember that is covariance, but distinct covariance is n into bracket n minus 1 over 2. You can get a question in which you get all those numbers and it just asks you what number of distinct covariance are you going to get. So having this formula handy helps. As the relationship you should be familiar with going into the exam, as the number of coding period increases, covariance become increasingly important, or less equal. Covariance capture co-movement, and covariance of return is negative if when one move above, covariance of return is negative if when the return on one asset is above the expected value, the return of the other asset tends to be below its expected value. Let me leave this for the next slide. I think the next slide explains it better. So the covariance of a random variable with itself is called the variance. So this last bit I think is important. We've been talking about variance. What does variance really mean? Variance is variance of an asset with itself, covariance of an asset with itself. So if you multiply the covariance of x with the covariance of s, you get a variance of x. But when you multiply the covariance of s with that of y, you get something else. And so really that's what that says. Okay, so this chart just tells you how increasingly beneficial covariance can be. The diversification benefit increases with decreasing covariance. So when covariance decreases, diversification benefit increases because you can get a better return for a lower variance. You can get a better return for a lower variance. That's why that statement is important. Diversification effect benefit increases with decreasing covariance. I thought I had this. So let me revisit this. I thought I had it. How do you interpret covariance? So when you see a negative covariance, what does it mean? Negative covariance means they move together but in different directions. They move together but in different directions. Which means if I have a covariance of -1, for example, or minus any number, it means that when A is going up, B tends to be going down. When I have a positive covariance, it means that they are moving in the same direction. It does not necessarily mean that they are moving up. They might be moving down. That is, they might be coming down, but they are coming down together. So interpreting covariance. The sign of correlation determines covariance. No, the sign of covariance determines the sign of correlation. So I think what I meant to say is the sign of correlation is determined by the sign of covariance. And the reason for this is standard deviation would always be a positive number. Why? Variance will always be a positive number. You only square variance. So if you square variance, you're always going to end up with a positive number. So the only time you get a negative correlation is if the covariance is negative. So what I mean to say here is the sign of the covariance actually drives the sign of correlation. Then you can also get something like this. If you get something like this, you should be able to piece out the information you need to calculate covariance, standard deviation, and all of that. For example, correlation is given as this, but you then know that correlation is covariance over standard deviation of x and standard deviation of y. Now you're already given standard deviation of x and standard deviation of y. So based on this chart, for example, this table, you can actually calculate what covariance is. So it's important that you get this formula handy as well. The formula for correlation and the relationship with covariance and standard deviation. Safety first rule. I'll just go over the steps to calculate safety first rule. It's a question that might come up. The first thing you need to do is to calculate each portfolio SF ratio. Now that is your safety first ratio, right? When you calculate that, then choose the portfolio with the highest SF ratio. The portfolio with the highest FS ratio is what you're looking for. The formula for SF ratio that I mentioned is what is given here. That is the return on the portfolio minus the target return over the standard deviation of the portfolio. And so that is how to approach that. It might be important for you to at least get familiar with this formula as well. Log normal distribution. What should you know about log normal distribution? It is bounded below by 0, and it's also skewed to the right. We talked about right positively skewed earlier. And so if you look at this, you can see that this is a positively skewed distribution. Why? You can see where the tail is. The other thing is it's bounded by 0, which means it cannot take non-negative. Log normal distribution is best applied to prices, asset prices. Why? Asset prices do not take negative values. You will never see the price of an asset that is minus in the market. That's why the best distribution to apply for asset prices is not log normal distribution. It's also the best distribution to apply to options, because option is also non-negative. Because the worst that can happen is that you lose your premium, and so it's always non-negative. So that is important. Normal distribution is better applied to returns, while log normal distribution is better applied to asset prices. So it's analyze volatility and continuously analyze volatility. This formula, how to derive it, try and go over it as well. Bootstrapping, jackknife, bootstrapping. when you resample from a population and then you sample from that population, what you're really doing is bootstrapping. The essence of bootstrapping is it still offers some fairly, representation of statistical feature, and it also provides, estimates of statistics, provide only statistical estimates, not exact results, but it's also called a model-free resampling. And bootstrapping jackknife is that in jackknife you do not replace. So think about the fact that you have, say, 20 balls in 20 different colored balls in a bucket. If you pick one, or if you pick 5 randomly, right, and then you replace them, right, or you pick 5 randomly and you don't replace them. If you do not replace them, if you replace them, you can sample infinitely. You can continue to sample. But if you do not replace them, you can't sample infinitely. It means that you will soon run out of what to sample, because once you take out from there, you do not replace. So I think the most important thing going into the exam hall is that for jackknife, replacement is what is the major difference. Estimation and inference, when you talk about sampling, always remember convenience and judgmental sampling. They are not scientific. So when you begin to see a statement being laid out in which the process is not scientific, what it means is that the process is not repeatable scientifically. Just know that that is a non-probability sampling. Just convenience means that the analyst is using what is easy to relate with, easy to get. Let's say you're looking for inflation numbers and then you go to Ebano and you go to Pick and Pay and all of that, all within Lekki, and then you say, oh, the price of Gary is X amount. That is convenience sampling, because you only went to supermarket that are close to you. If you really want to do that analysis, you should go to a partner, go to Una, and get the prices of Gary, because they are going to vary. Judgmental sampling means is when you already have some sense of an idea of a particular, let's say, particular information or data or observation before then, and you're applying it to your sampling. Now, there are 4 different types of sampling that is discussed. Simple random sampling is the one we're all very familiar with, where you pick randomly and everybody has an equal chance of being picked. Systematic sampling, you pick an nth or kth item. So if you say, oh, we'll pick the 5th, or pick the 5th, that is systematic. Then we have the stratified sampling. The stratified sampling, you break into subdivision called strata, and then you pick from that subdivision. You do not need to pick an equal number from the subdivision, but you must pick from all of the subdivision. Cluster sampling, you still spread it into clusters, but you can then select a whole cluster as your sample, or you can then sample from cluster. What you will then find that in cluster sampling is you do not necessarily pick from all of the clusters. In stratified sampling, you pick from all of the stratas. So those are some of the differences that you need to be familiar with. Why do we sample? To save time and money. Central limit theorem. Central limit theorem really is that theorem that enables us to lay a foundation for hypothesis testing, in the sense that if central limit theorem holds, then you are able to make probability statements about a population based on the parameters of the sample, right? So, for example, if we say the population of Nigeria is, let's say, 240, the reason why I can make that statement is because central limit theorem holds, which means I will take samples, and based on that sample, I would make a statement that the population of Nigeria is this, based on my sample. Nobody has actually done the actual calculation of the population of Nigeria. Nobody can. You don't have the money or the resources or the time to do it. But how do we know that it's 245? We use samples. And when we use samples, because central limit theorem holds, we will then make that probability statement that is correct. And so that's the rule of central limit theorem. It is important to remember in central limit theorem that The population can be described by any probability distribution. There is no limit, or there is no assumption, there is no limitation in terms of the probability distribution of population. Only the sample population must be normal. Then there has to be a finite variance, right? There has to be a finite variance. That is, the variance is not moving from period to period. And then lastly, the size has to be large enough. We say the size is large enough when it is 30. When n is 30, we say it's large enough. So it's important that you get familiar with that. The difference between standard deviation and standard error. Standard deviation measures dispersion of data from the mean, whereas standard error measures how much inaccuracy a population parameter estimates come from something, which means standard error comes in as a result of sampling. Standard deviation is deviation around the mean. And you can see the difference in the formula of both. So while standard deviation is the square root of your variance, your standard error, you then still divide that standard deviation by the square root of n. Now, as you increase sample size, standard error reduces. So this is a relationship that's important for you to be very cognizant with. As you increase your sample size, your standard error increases. So one way to reduce your standard error is to increase your sample size. Hypothesis testing has 6 steps, but most important thing is really for you to know 3 things. Number 1, what type of test am I doing? Number 2, what tools do I apply when I'm doing the test? And then number 3, how do I make decisions based on the test? But before you go into that, there are bits and pieces that which are also testable that you should be very familiar with. The null hypothesis and the alternative hypothesis are stated in terms of population parameter, and they must be mutually exclusive and collectively exhaustive. It means it must cover all of the scenarios possible. And if it is A, it cannot be B at the same time. And so your null hypothesis does not take an equal sign. Your null hypothesis is currently accepted value of a parameter. And because it's a currently acceptable value of a parameter, it only takes an equal sign. That is equal to, greater than, or equal to, or less than or equal to. It does not take an unequal sign. And that is why what you say is fail to reject or reject. You do not use accept for null hypothesis. So if you get a question which you state it, okay, accept the null hypothesis, do not accept the null hypothesis. You do not use accept or not accept hypothesis because it's technically wrong. Why? Your null hypothesis is what is originally correct. If something is originally correct, you can't say you're accepting it. You can only reject or not reject it. It's the same way when we say, oh, someone is not guilty, is innocent until found guilty. So you can't just pick someone on the road and say, oh, this person is guilty and start beating them up. You try them through a process. And you then find out that they're indeed guilty. You can then pronounce them guilty. That's why you can't just take someone and then strip them of their rights because they are still assumed to be innocent until they go through that process. It's the same thing with your null hypothesis. Your alternative hypothesis is the position you want to accept. So when you read your question, what is the position you want to accept? What do you suspect to be true? What is it? What is the claim that you want to test? If any part of your your question that align with this position you want to accept, suspect there is true or claim to be tested, structure that as your alternative hypothesis. Then the opposite side of it, whatever is not included in that, structure it as your null hypothesis. That's the way to approach it. So, and this is really how it is. How do you know you are dealing with a two-sided? If your null hypothesis takes an equal sign, then you are dealing with a two-sided hypothesis. In a one-sided hypothesis, H1 points to the rejection zone. In a one-sided hypothesis, H1 points to the rejection. That is, the shape of the H1 points you to where the rejection zone will be. There are different types of tests that were covered in your curriculum. Test of a single mean, differences in mean, and all of that. How do you know the type of test you were doing? Look at your question. In a test of a single mean, you will be asked, you will be given one hypothesized mean. In test of differences in mean, you'll be given 2 means. Some will state if there is a difference between them or not. Now, if there is no difference between them, it means it's 0, right? So work with that. Test of a mean of difference, it means that there are 2 means. We find the difference of the mean, and it is that difference that we are dealing with. It will always give you one mean as well, but that mean will be a difference, a mean derived from difference between two means. You can be asked test of a single variance. So if you're given one variance and you're asked to test, you're doing a test of a single variance, differences in variance, they will give you two variants before and after, and then they will tell you which one, they will ask you which one. Just a point to make between difference in mean and means of difference. Difference in mean can only be done under condition of independence. Because if those two means come from independent, came independent, that is from independent samples, dependent population parameters, right? Then that is where you can do test of a difference in mean. But if it is not independent, then you can only do the test of a mean of difference. So look at your question. Your question they will try as much as possible to put into that question if there is independence or not. If there is independence, then you can do test of a difference in mean. If there is no independence, then you can't do test of a difference in mean. You have to do test of a mean of difference. I'd always advise that you go to the exam hall with this grid. This grid on how to make decisions. If you remember this grid in an exam, it really helps you to answer questions on type 1 error and type 2 error. There are two decisions you can make. You can either fail to reject null hypothesis or reject null hypothesis. And if you do, there are two outcomes that can happen, because your null hypothesis can either be true or your null hypothesis can be false. Now, if you fail to reject your null hypothesis and your null hypothesis is true, you've made the right decision. But if you fail to reject your null hypothesis and your null hypothesis is false, then you make what we call a type 2 error. So, but this might not be given straightforward. They might give it in a statement. So, in a statement form, when you fail to reject the null hypothesis, when the null hypothesis is false, then that's your type 2 error. That is the way to state it in a statement. Or when you reject the null hypothesis, when the null hypothesis is actually true, then that will be your type 1 error. That is, you reject a true null hypothesis. Confidence level and level of significance. Level of significance are always set, and in every question that requires calculation and you require level of confidence, you will be given. That numbers would always be given. Then the opposite of your level of significance, which is the mirror image, is your level of confidence. So if you're given level of significance of 5, then your level of confidence is clearly 95. Then the power of the test is also 1 minus beta as well. The power of the test is your ability to make the right decision. And what is the right decision? You know, what you really want to do there's an alternative hypothesis that you want to get to. Now, if you get to that alternative hypothesis and you're not wrong, then you have made the right decision. How often you make that decision is called your power of the test, and that is measured by your 1 minus b. There is a trade-off between type 1 error and type 2 error. When type 1 error goes up, your type 2 error comes down. When type 1 error goes down, your type 1 error goes up. That is, if you increase your level of significance, for example, your type 2 error comes down. If you reduce your level of significance, your type 1 error also comes down. But however, both type 1 error and type 2 error can be reduced if you increase your n. Candidates often get it mixed up thinking that type 1 error is a mirror image of type 2 error. I have about 2 minutes. That type 1 error is a mirror image of type 2 error. They are not. Yes, there is a trade-off, but they are not. So if you say your type 1 error is 95, it does not mean your type 2 error is 95. No, even though there is a trade-off, but it is not a mirror image. So in case you get that kind of, there are 3 ways in which you can make decisions. You can use critical value, you can use your p-value, you can use your confidence interval. If you're using critical value, compare it to your calculated t-test. If you're using your p-value, compare it to your LOS. And if you're using your confidence interval, compare it to your hypothesized value of the mean. Non-parametric tests, when do we use non-parametric tests? When your data do not meet distribution assumptions, and when you have outliers, or when you use ordinal scale, like rank, first position, second position, third position, you can't find the mean of that. So that is when you should use non-parametric tests, and when the relevant hypothesis do not concern a parameter. We did talk about parameters. Parameter is your mean and your variance. Anything that is not mean or variance is not parametric. For example, regression is not parametric. Correlation is not parametric. They are tests of relationship, not tests. They are not parametric tests. And so it's important to know that simple regression Perhaps I think my time is up. Let me just end with this particular slide. Simple regression. Again, simple regression is called simple regression because there's one dependent variable and one independent variable. Multiple regression is when you have more than one independent variable, right? So simple regression has one dependent and one independent variable. It measures linear relationships. So linear relationship assume a linear regression assume linear relationship between dependent and independent variables. So it assumes that this relationship is a linear one. And so the goal of linear regression is to fit the observation so that you minimize the squared deviation. To minimize the squared deviation, that is the goal. And this particular statement or format or model, when you get a question, typically it doesn't come in this form. I think it comes in more of this format. And so it's important that you know that sum of total squares, right, is the combination of sum of square regression and the sum of square error. Your sum of square regression is the part of the observation that can be explained by the independent variable. So when you're given that is your R square, for example, when you're given your R square, that is the portion of the observation that can be explained by the independent variable, right? When you add that to your sum of square errors, that gives you the total sum of square total. That is sum of the total difference in observation that can be that we have seen. The one that can be explained by your independent variable, and the rest that is not going to be explained by your independent variable. I guess I wish you the best of luck in your exam. I think my time is up. Thank you very much, everyone. I wish you all the best in your exams.
Thank you very much, Olabode. We really appreciate it. To our participants, the slides will be sent to you as we've stated earlier on. We're going to be having a 14 minutes, it's supposed to be 15, but it's now 14 minutes break. By 1:15, we'll come back here. Please let's go and stretch our legs, stand up from our seats, relax a little. Then by 1:15, we are back for alternative investments. That's going to be a 1-hour class. And after that, we are going to have FAS, another 2 hours class. Those will be the last 2 classes we'll be having for today. We look forward to seeing you at 1:15 again. Thank you, and have a blessed day.
We are professionals. We are impact driven. We are CFA Society Nigeria, a member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holder's commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietynг.org for more details. CFA Society Nigeria, making finance a force for good.
If you've made a decision to aim for a long-term and successful finance career, taking the Chartered Financial Analyst CFA exam and studying the curriculum is an excellent way to ensure you have finance a force for good. If you've made a decision to aim for a long-term, societyng.org. CFA Society Nigeria, making finance a force for good.
We are professionals. We are impact driven. We are CFA Society Nigeria, a member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holders' commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietyng.org for more details. CFA Society Nigeria, making finance a force for good.
Good afternoon, everyone. So Oriofel Olamoye going to be taking us on alternative investment from now up until 2:15 p.m. Oriofel, you have the floor.
Yeah, thank you very much. Please confirm you can hear me, Buki. Good afternoon.
I can hear you loud and clear.
All right, great. Yeah, good afternoon, everybody, and welcome to the CFA Society Nigeria revision for the May 2026 exam window. I'm excited to be here, and I'll be taking you on alternative investments, right? And I want to believe that it's a revision, right? And to that end, I was given 1 hour. And you know that the exam weighting for alternative investment is about between the range of 7 to 10%, right? So I will just quickly run over it. I want to believe that, and I know that we have read, but it's just to brush up some things together and to see gray areas, and then we can move on from there. Just give me a moment. Let me share my screen, and then we'll run through the class for the revision session together. Just give me a moment. I'm going to be sharing my screen soon. Okay. So please confirm that you can see my screen also. All right. Okay, thank you. Yeah, I got that feedback. Okay, so I'll be taking us on alternative investment, and very quickly I'll be running us through, right? And you know, alternative investment is just what the investment that is different from the traditional asset class. And the traditional asset class we are talking about here is the public equities and the public bond, right? We have 7 modules, and then I'll run through all the 7 modules together. And in the 7 modules, we're going to look at the alternative investment futures method and structure, right? Alternative investment performance and return. Then we go into investment in private capital vis-a-vis the equity and debt, right? In private capital, and then we'll look at the real estate and infrastructure. Then we'll go to natural resources. Then we look at hedge funds, and we go through digital assets, right? So I will start off with from learning module 1, and when we are looking at learning module 1, we are looking at, okay, alternative investment, what are the futures, the methods, and what is the structure, right? When we talk about the futures, one thing that makes alternative investments quite distinct is the fact that is illiquid, right? And the time horizon is usually longer um, than a traditional asset class in a way, right? And moving on, we have three categories, right? According to the CFA curriculum, there are three categories of alternative investments we have. And one is that we have private capital. Under private capital, we have the private equity and private debt. And under that, we have the leverage buyout, right? Leverage buyout is talking about the fact that you use debt, what's the financing option of that acquisition or investment is largely um, a borrowed capital, or is financed heavily by borrowed fund. Albeit there is some element of equity that could be there, but it's largely more of borrowed fund. And leverage buyout can come in the form of management buyout. Management buyout in the sense that is the current management of the company that are investing in the company, right? They are investing and they are taking over the ownership. And I just want to put this out there. The management is different from the owners of the business, the shareholders. So a management buyout means that the current management of the company are investing or are acquiring shares of the owners. And management buying is in the case whereby there is a strategic investment, but a new management is coming in to take place, right? So, like I mentioned, we have the private capital, right? And it covers private equity, private debt, leverage buyout, venture capital, direct lending, and mezzanine debt. And we have the real assets. Under the real assets is where we have the real estate, infrastructure, the natural resources, and other long-lived assets that are capital intensive and essential public service. That's still under infrastructure. And under real assets is where we have commodity, right? Which we are still going to talk about in some other slides, right? That the last category of the alternative investment as per the curriculum is hedge funds, right? So hedge funds, yes, some hedge fund has strategy to invest in public equity, public debt, but the reason why it is an alternative investment is really based on their strategy. And there are three things that defines, or three things that is quite significant and the futures of hedge fund. One is the use of leverage, right? Leverage, short selling. Short selling is also part of the hedge fund, and the use of derivatives, right? This one really is because there is not so much regulation as to what public equities and in the public market, public equities and the fixed income, right? And the futures is that there is need for specialized knowledge, right? I've mentioned talking about illiquidity in the sense that you need to hold it for long term. And typically, right, the futures of alternative investments is that they have low correlation, right? A low correlation with traditional asset class. But one thing that you should note is that although, right, in the period where there is crisis, right, the correlation increases in the situation where there is crisis. So just note that and know what the question is asking so you answer it appropriately. Another thing is that alternative return, right? There is a saying that the higher the risk, the higher the return. So because of the fact that this is alternative investment, one of the features is that there is alternative, there is higher return, there is alpha seeking, and there is an additional risk premium because of these features that we've talked about, right? Moving on to what are the investment methods for alternative investment? One is fund investment, co-investment, and direct investment. And these are the advantage Fund investment means that, or fund investment means that you are investing through a fund manager. The fund manager in this case is what is known as the general partner, the GP, right? It has advantages and disadvantages, and you can see that on the screen. One of the advantage of fund investing is that, you know, there is a specialized professional management from the fund manager, the GP in this case, right? And there is diversified exposure, right? There is also lower minimum investment compared to other forms of investment method for alternative investment. The challenge is that there is less control, there is doubled layer fee, and there is blind pool risks. That is, you don't know what they are investing in, right? So there is that blind pool risk, right? In under this under co-investment, right? Yes, you still invest in the fund, but as a company, you also, or as an investor, you also invest directly into the project. Well, it has lower fee compared to that of fund. You are exposed directly to the deal, and in that case, you sort of align with GP interest. It also has the disadvantage and challenges that come with co-investment, where there could be adverse selection of risks because you don't have that capability, you don't have that specialized knowledge to be able to invest. So they could be that case. And the third investment method is direct investing, right? In this case, what happens is that an investor invests directly into projects um, or into portfolio company. In this case, the company has full control, or the investor has full control. There is no management fee, and it has the highest potential return. And the challenges that that we face here is that there is a need for required expertise, you know, and because it has the highest risk, there is also need for high capital needs. But in this case, right, it's a lot of DFIs and also sovereign wealth funds that can do a lot of this direct investment. You will not really see that in the fund from the point of view of an individual investor, but direct investment really is more of sovereign wealth fund and big multilateral organizations. So you could be posed with questions around what is the best investment method for this. So you need to understand that, okay, do they have the required skill set? Do they have the fund? So you could be able to choose appropriately what is correct. So if you are able to assess they have the right in-house specialized expertise, and they also have the capital base. So therefore you could recommend or choose that, okay, direct investment or direct investing is the best for method for the alternative investment of that sovereign wealth fund or whatever investor they are trying to pitch to you. So looking at the investment ownership and compensation structure, in this case, we have the general partner, and I mentioned here that the general partner is also the same thing as the fund manager, right? The fund manager. And you can see here that we have the limited partner, right? The limited partner is also the same thing as the investors, right? The reason why we call them limited partner is because that the whatever happens is only limited to the fund they've committed or their investment, right? But the general partner has unlimited risk in a way compared to that of the limited partner. But the GP manages the fund and makes investment decision, right? But the LP provide capital in return for fractional partnership, right? And going into the fee structure really, you will see we have typically there is a management fee, and it ranges from 1% to 2% per annum. That's the way the fee structure in most alternative investment structure is. And there is performance fee, or you could see it as incentive fee or carried interest, right? And then which is circa around the 20% mark. And then we have hurdle rate. You know, in this case, they want you to earn a minimum return above a certain rate, then there is an order rate. Okay. Moving on to the learning module 2, and this talks about the alternative investment performance and return. Alternative investment performance and return. In this case, there is a problem, or let me say there is a question here to say that why is it difficult for alternative investment? Because if you look at in the point of view of the traditional asset class, we know, right? If you want to know what is the price of this equity today, the thing is that, okay, just look at the stock exchange. You can say that this is the price. But the performance of alternative investments is very, very difficult. And for this reason that is on the slide, one is the fact that there is asymmetric, I don't know, is anybody saying anything? Okay, I thought I had a sound. Okay, why appraisal is difficult, right? And then it's because there is asymmetric risks and return. What do I mean by that? Because you are not able to capture the volatility because the data, there is paucity of data. So we are not able to know what is the variance, what is the standard deviation, because it's not tradable. We don't know what is the volatility of that asset. So under alternative investment, the reason why appraisal is difficult is one, there is asymmetric risks and return. There is limited transparency. The portfolio holding is not fully disclosed, right? And it's illiquid, like I mentioned earlier, and there's product complexity. There's a lot of bespoke terms. There's a lot of structures that are put in place for alternative investment. And lastly, why appraisal is difficult for alternative investment is that there is complex fee structure, right? There's some performance fee and the like, so it makes it a little bit difficult for you to measure. Unlike the traditional asset class, equity, we know, okay, everybody knows how much stockbroker is going to charge and the like. So, but again, it's just straightforward for the traditional asset class compared to that of the alternative investment. And then looking at now, when you want to appraise, right, alternative investment, right, there are 3 methods that the curriculum puts to us and there are 3 methods. One is the internal rate of return, right? But one of the drawbacks of this internal rate of return is the fact that it does not take into consideration unrealized cash flows, right? It does not take into consideration that. So unrealized cash flow, it does not take that into consideration, right? And well, a lot of private equity firms use that, but to solve the issue of IRR, internal rate of return, then we have the MOI, talking about the multiple on investment capital, right? There is a formula to that, and it's in the curriculum, and you need to also pay attention to that. That talks about the total value return divided by the total capital invested. I want to speak on something here. So the total capital invested, note that it should be net of the fees. Right? So what do I mean? Let's say that an investor gives a GP, a general partner, in other words, the fund manager, gave him 100,000, right? And the management fee of the fund manager is 2%, right? The total capital invested is going to be 98,000, right? Not the 100,000. So you should note that when you are calculating your multiple on invested capital, take note that the total capital invested from the point of view of the limited partner should capture its net of the fees when you are doing that. So take note. And when you get to real estate, there's something we call the cap rate, right? Capitalization rate, which we have here. So this, to get this cap rate, right, is just talking about the net operating income of the property, net operating income of the property for a particular given year divided by the property value. So we're looking at the key performance metrics. So the capitalization rate, this is solely for real estate, right? It's just sort of want to measure the income return on the real estate, right? The measures the income return on real estate, right? And if it's higher, that means it's more attractive, right? Okay. And then moving on to, there are a lot of customized fee arrangement or custom fee arrangements, right? Because in alternative investments, you have a lot of them, right? And one of the customized fee is what we call the fees on liquidity term, right? What this means is that, and I know people that do piggy vest and all these save lock and the likes understand it, right? If are going to be able to relate with it, right? So one of the custom fee in alternative investment space is that there is fee on liquidity term. So there is higher fee for you if you have shorter lockup period, and a lower if you have a long commitment. So if you say, okay, the fee we are going to charge for you if you are holding this for 2 years is going to be lower than if you want your liquidity term to be 90 days, So those are custom fee arrangement that you need to be aware of, and you need to read this up and just to brushing up your knowledge on that. Another custom fee arrangement is what we call the founder share class. This founder share class is a discount fee for early investor who committed for at a fund launch. So early investors, they are compensated with a discounted fee, right? So those are founder share class. And another form that we have is what we call the either or fee, right? Typically we have the we have the management fee, and then if the fund manager or the general partner performs very well, then is going to be paid a performance fee, right? But in this case, the custom fee arrangement says that you either pick one of the two, right? You are not picking the two. It's either you pick the management fee, right? In the instance where you did not perform very well, or you take only the performance fee in the instance where you performed well, but not both. So if a question is given to you to say that what is part of what's giving you a list, and okay, this is a custom fee. Is this a custom fee arrangement? I'm just giving that as an analogy. You know that either or fee is a custom fee arrangement. In this case, the either or is talking about the management fee or the performance fee, and not both, right? One is the fourth one under the custom fee arrangement is the asset size tiers, right? So this one is talking about the fact that the higher your asset base, the higher the fund you commit to invest, the lower your fee, right? So that's what the asset size tier is saying. So you could see that these are different custom fee arrangements that we have. So on this same thing, right, under the calculation and biases, for hedge funds, there are two biases that are posed for hedge funds, right? And one of it is the fact that there is survivorship bias, right? It means that, okay, poor performing funds, that are closed are excluded from the index, from the index fund, because okay, take for instance, this fund was there in 2019, right? But because of COVID, 2022, the fund is no more performing. The fund passed away, right? So we are in 2026 today, and you want to do the performance measurement. You want to do what's the performance from 2019 to 2026. You excluded those funds that are poor performing because the fund packed or was not in existence again in 2022. So you did not include it from 2019 to 2022. So in that case, is what we term the survivorship bias. And what survivorship bias does, the result is here, it overstates return. Because when we do not include the fund that will drag down the returns, right? Because they don't end up surviving, then the resultant effect of the fact that we have survivorship bias is that there's going to be overstated return. So note that the result of survivorship bias, or the outcome, let me put it that way, is going to lead to an overstated return, right? Another case in point is the fact that we have backfill bias, right? And a lot of us, I think, we sort of want to want to be in this category, right? Now it's just a slight opposite of survivorship bias. So now in this case, we are in 2026 and we are adding a new fund to it. But because we saw that a fund performed well previous year, then we now include it into the historical return because of this new addition to the fund did very well. So funds that are added to an index fund can backfill historical returns, right? And in this case, what is happening, the bias is that is only successful periods that are reported. In this case, it inflates the track record. So we must note that the survivorship bias and the backfill bias, right? When we are measuring performance during the calculation, and also the biases that are around hedge funds, right? So I'll move into the third learning module, where we have the investment in private capital, equity, and debt, right? If you recall that I mentioned that we have three categories of alternative investment as outlined by curriculum. One is the fact that we have private capital, we have real asset, and then we have hedge funds, right? And I will get there, but just to also note that digital asset is under real asset. So take note of that. Digital asset is under real asset, right? So when we talk about private capital, I'll first talk about the private equity. And herein we are looking at what are the features and characteristics of private equity. For short, without going further, private equity is equity that is not public equity, or investment that is not in public equity. That's one. And two, private equity it could be an investment in public equity, but they have an intention to go private. The word go private, they have an intention to take that company that they invest in public, they have that intention to make that company go private. So these are private equity. And under here, we have like three different buckets of private equity. One is the leverage buyout. I think I've mentioned this earlier. So in this case, and there's a lot of example and real life case study. And one of the case study you would have there, and even in the curriculum, is Blackstone investment in the Hilton hotel case and Hilton chain, right? So you can take note of that, right? So we have the leverage buyout, for short LBO. In this case, is the acquisition of matured company but using significant debt financing, right? And what is the target? The target is that, okay, this company seems not to be maximizing its potential. Let's buy it. And when we buy it, we want to tend to restructure it. And when the target, they need stable cash flow, then they'll use it to service, the company is going to use it to service the debt, right? We have venture capital. Venture capital is for early stage financing for startup, right? And one of the characteristics and features you need to know of this private equity firm, which is venture capital, is that it is high risk, right? And it also has high return profile. Remember, high risk and high return, right? So in this case, there can be multiple funding rounds from pre-seed, um, from seed, Series A, Series B, and Series C. Yeah. So I will draw your attention. You can read this aspect of the curriculum or refresh it. I want to believe that you've read it first instance, but there are things you need to know here. The pre-seed, or when the founder is bootstrapping, then who are the people that are coming in the seed round, right? You see angel investor and the like. So you need to know that. Another form of private equity is growth capital. It's different from venture capital. Venture capital is solely for startup, early stage, right? That's the right word. Early stage financing for startup, right? And in this growth capital phase, is, you get minority stake in mature company that are seeking expansion, right? So at the venture capital stage, which is the early stage financing, the company, they are still doing proof of concept, they are testing, but they are yet to go into the commercial production. That's where the growth capital comes in, right? And they provide that sort of capital for companies seeking expansion. And in this case, one thing we should know that it has less leverage than LBO, right? And it provides capital without full buyout. In other words, there might not be a change of management, or you are not sacking anybody, it's just a minority stake for gross capital, right? For private equity, for every private equity investor, they have in mind what at some point they are going to exit, right? And one thing that you should take note of is that what are the exit strategies, right? And this is one thing you should also know. What are the advantage and disadvantage of the exit strategies, right? One of the strategies is trade sale, right? And I'll talk about this later, but I want you to know there's a difference between trade sale, right, and secondary sale. So take note of that. When I talk about trade sale, it means that the private equity investor, right, is selling to a strategic buyer, right, or to another competitor, that is the business. So take, for instance, I'm a private equity investor. I invest in a company that is doing soap, right? So you are selling to the competitor, or you are selling to another investor, right? So that's what we call the trade sale. And in this instance, the trade sale is the most common exit route, right? The trade sale is the most common exit route. The other exit strategy is IPO, right? It also has its benefits and it also has its disadvantage, right? IPO, initial public offering. For initial public offering, one of the advantages is that it has the highest valuation potential. But that highest valuation potential, it requires favorable market. That's initial public offering. That means you are listing that company in the flow of the exchange. So some private equity company use that as their exit point, and we have a case of that in Nigeria. We've seen private equity firm coming to the market and exiting their position. Another one is still relating to the IPO, but we call that SPAC merger. SPAC means special acquisition company, special purpose acquisition company, right? SPAC. And we have a scenario of that with the Virgin Erratic, right? Right. There was a SPAC like that, a special purpose acquisition company. So in this case, the promoter of the SPAC goes to incorporate a company, a shell company, and list it, right? And do an IPO for that company. But the sole aim of that shell company is that we want to acquire a company in this social sector. They don't know the target company yet, but they have a purpose that, okay, we want to acquire a company in this sector in the next, say, 18 to 24 months. Really, they don't know the name of the company yet, right? And you could see that when they finish the acquisition of that company, then they merge that company with the shell company. That's why it's called a SPAC merger, right? The shell company, which is the special purpose acquisition company, list on the exchange as an IPO, right? You list the shell company, right? And then the shell company raise money from the market or from investment savvy investors, right? Get money from them, but you already tell them the purpose. You want to acquire a company in this manufacturing sector or biotech, and when they have timeline in the next 18 to 24 months, when you acquire them, then they merge with that shell company that is already listed on the exchange, right? Another exit strategy is the secondary sale. Secondary sale is different from trade sale. Secondary sale, you are selling to another PE firm, right? And this provides liquidity without the public market. So secondary sale, you are selling it, but they are selling to another PE firm. Yeah, let me wrong. So let's quickly look at private debt and what are the diversification benefits of private debt. In this case, we are looking at what we should explain the futures of private debt and also describe the diversification benefits. In this case, we have categories of private debt, right? The first category is direct lending. In this case, the private investor is giving they are giving debt directly to that mid-market company. Definitely, this one, there is no bank intermediary. This direct lending is for companies that are in the mid-market, right? Because definitely a blue chip company is going to go to the public market because they are going to get it for a cheaper rate. Yeah, they can go to they can definitely go to the private market to raise money, but more often than not, direct lending speaks to mid-market company, and this is without bank intermediary. And it's floating rate, it will be floating rate, and also senior secured. We also have mezzanine debt. Mezzanine debt is subordinated debt, right? But it has some equity warrants. Well, it has higher risks and return than the senior debt, and more often than not is bridge to equity, right? So maybe a company is expecting to receive equity, but what they would just want to do is that, okay, let's get this loan for the meantime, right? And then we use it to get our equity. Next is the venture debt. When we talk about venture debt, just like venture capital, venture debt is loans to VC-backed companies, right? What do I mean by that? They are still in their startup phase, And because the VC that is backing this company don't want their shares to be diluted, so they hold the startup company to go and get additional loan, right? Without having to dilute their shares. And that's what I noted earlier. And then we have distressed debt. In this distressed debt case, in this case, a company, more often than not, is going to be a mature company that has is debt that trading on the financial market, but we could see that is a distressed debt because maybe there is already indications of bankruptcy, right? In this case, a distressed debt is a debt that is trading at a significant discount. You know, people that are in the market knows there are debts that trade significant discounts. I've seen in this market debts that are trading about 40% that have traded, right? I'm not talking about now. And people in the market will know. And the case in point would be the Ghana Eurobond. Okay. A distressed debt has a potential for equity-like return via restructuring. And if you look at this, you will see that if everything turns out well, then there is an upside for that private debt category, which is distressed debt. And looking at what is the diversification benefit, the diversification benefit is moderate, right? Versus the public stock and bond. One diversification benefit you also note is what we call the vintage year, right? And vintage year is talking about the fact that, and I want you to note this, vintage year is talking about the first year, or the first year the GP deploys the fund. So you need to note. So let's say that a GP received commitment of 500 million in 2025, but it deployed the money the first time. So I'm not saying when it deployed the whole 500 million. Let's say that it deployed 10 million out of this 500 million, right, in 2026, and that's the first time it's deploying out of this 500 million. 2026 is going to be the vintage year, right, for this fund. So a GP can have many funds, right, but different funds has different vintage year, right? Okay. Okay, yeah, I think I saw Shola typing. Yeah, Cardinal Stone. Yeah, that is secondary sale. Yeah. Okay, moving on. So that's what we talk about the vintage year. And then there is low correlation with traditional asset class, particularly private debt and equity. You know, that's one of the diversification benefits. Right. Okay. Okay, let's quickly look at module 4, right? Real estate and infrastructure. Yeah, we are going to look at what is the futures, the characteristics and investment forms of real estate. We have equity part of real estate, which is public. Here we have the public equity. And in this case we have REIT, right? REIT is liquid, is diversified, but it has higher correlation with equity. REIT, that is real estate investment trust, right? It has higher correlation with equity because it's listed on the exchange and it's traded there. So it tends to behave, right, more like it tends to behave more like equity, right? And then we have private equity for real estate. In this case, there is direct ownership. Well, it's illiquid, right? There's control over the assets and core, value added, and opportunistic, when we come to real estate. And also looking at the two-dimension classification for real estate, we also the debt angle, where we have public debt. Public debt, the MBS is the mortgage-backed security, whereby, okay, a bank pull a lot of mortgage-backed security and sort of issue it to the public or to investment-savvy individuals. So those are a form of public debt. It's tradable. We also have commercial mortgage-backed security, right? And under private debt is the mortgage that we know about, right? Your mortgage is not tradable, that they give to you yourself, right? But it's not tradable, right? Okay. And in this case, we have the direct mortgage lending that we all know. And the unique features of real estate is that one is heterogeneity, right? Every property is unique. There is no two assets that are identical. Market fragmentation. There is no central estate where you want to say that, okay, come and buy this land, because the price of any land or any real estate is dependent on the location. So it's decentralized. It's not, there's market fragmentation, no central exchange, just like we have S&P, we have the NASDAQ, we have the FST, we have the Nigerian exchange, right? The NGX. There is a centralized exchange. There we could get, okay, this is the price discovery. But in this case, there's price discovery challenge. And because it's not tradable real time, it gives birth to costly transaction costs, where there is high transaction cost, there's long time horizon to buy and sell. The unique features of real estate is the income plus appreciation, right? And the return from lease income vis-a-vis rent looks like bond-like, but the capital appreciation of land of the land or the real estate is equity-like. And like I mentioned, real estate, aside from REIT, has low correlation with other asset class, and the diversification benefit is also there for real estate. Now, let me quickly talk about infrastructure, right? And I really love this because that's the space where I play. When we talk about infrastructure, what are the features and the investment characteristic? One thing you should know that we have about 3 different investment phase. One phase is the greenfield stage, and in this greenfield stage, we're talking about it's a development stage, right? It's a new asset or a new infrastructure project that they have done, that is being done, right? Take, for instance, a new toll road, right? A new toll road, or a new power grid project. So in this case, the return is going to be the highest and the risk is also the highest. And it's exposed to construction risks and regulatory risks, right? On brownfield projects, right? This stage we could say is the acquisition stage. So in this phase, you're just doing some slight you are doing expansion, but the risk is quite moderate compared to that of the greenfield project. Right? Let's say you are doing expansion, and in this case, you see you are acquiring and upgrading existing assets, partially operating historical available outputs. Like, in that case, like, it's a brownfield project, but you are just doing an upgrade, you are doing an expansion, right? And the last phase is the secondary stage, which is the mature phase. In this case, the return is the lowest and the risk is the lowest, right? So this sort of project, there is no need for any expansion that you are doing at this point. There is no expansion that is being done, right? Nothing of such is being done. So at that instance, then it's at the secondary stage. So I would need to quickly run because of my time. These are the investors' advantage. There is a steady income stream from long-term contract, because typically infrastructure projects, infrastructure investment is always long-term. So, but there is steady income. It's also inflation protected, right? It also is linked to the consumer price index. The income that is going to be generated is inflation protected, and there is potential for capital gain. Infrastructure projects, it has low correlation with traditional assets, and it also matches the long-term stability of pension funds and insurance, right? Let me quickly go through the fifth learning module, the natural resource. Another natural resource is under the real asset, right? And in this case, we have timberland, right? Timberland, we have the farmland, and we have the commodity, right? And when we talk about commodity, we have the soft commodity and the hard commodity. Hard commodity are commodity that you mine, right, or you extract. So oil, crude oil, gas, that is being extracted, mining, coal, copper, these are hard commodities. Soft commodities are things that are grown, right? Timberland, this is going to be logger of wood and the like. So income from sales of trees and the like. So these are timberland. And if you look at the futures, it acts as both the factory, the tree grows, and warehouse. Because timberland, you can say that I want to delay in harvesting, possibly if the pricing of the timber at that point in time is not reflective of how you want to sell it. So in that case, you could see you can delay the harvest, right? Farmland, there is no production flexibility like timberland. Timberland, you can decide to say, I'm not going to cut the tree, the timber, right? But for farmland, once the fruits get ripe, you just need to harvest, right? You just need to harvest. And it also has low correlation with traditional asset class because everybody's going to it. And in terms of commodity, really, aside from all these products that I earlier mentioned, commodity is where a lot of derivative plays in, because people want to avoid the storage and transportation cost of physical ownership. And the return of commodity is driven by price changes, not the income stream, and is highly correlated with inflation over the long term. And it's inflation edge. Commodity is inflation edge because, take for instance, when prices of fossil fuel jump up, right? People just begin to increase transport, increase this and that. So when in terms of commodity, it's edge. So I have this table which you could go and look at. You're going to get this slide subsequently, so I know I've talked about some of the things here, what the correlation, the return drivers and the like, so you could look at it, and it's also taken from your curriculum, right? Let me quickly talk about hedge funds. Like I mentioned that hedge funds, it's sort of a private investment, right? Hedge fund is a private investment, an alternative investment. Yeah, their strategy was involved that they invest in public equity and the likes, right? But what we're looking at here is that what is their all their strategy like? And I mentioned that their strategy really, they use shorting, they short sell, right? They use derivative and they use leverage because they have fewer legal regulatory constraints, right? And in this case, we have about 5 different team and strategy, right? One is the equity long and short. For equity long and short, the long, and when I mean long, I mean they buy on their value stocks and they sell over value stock, right? It could be net long, short or neutral position, right? There is global macro. In this case, They bet on currency, the rate, commodity, equity across countries. There is also the event. We also have the event-driven fund strategy, whereby mergers and acquisition, restructuring, bankruptcy, and they tend to do merger arbitrage and distress, right? The relative value and the multi strategy. These are strategy under hedge funds that you just need to know. I know that I've mentioned the hedge fund investment forms and risks and return. And one of the investment form is the direct investment fund, right? And in this case, for institution, they invest through the hedge fund. The GP manage it, and it's the most common structure, right? And fund of funds, this is pretty much more for the smaller or retail investor, because the barrier to enter or to the minimum investment for an hedge fund is usually high for retail investors. So they bypass that to invest in funds of funds. So those fund of funds try to aggregate investment from retail investor, and they now invest it in the hedge funds, and they allocate it into multiple hedge funds. But this is double fee layer, but again, it gives room for the small and retail investor. And we have fund of one and the separately managed portfolio, right? SMEs, the separately managed portfolio, right? This is for large institution, and fund of one is that, okay, this fund is created for only this large institution. No other person is investing into the fund. It's only for that institution, and they invest into what they want and the asset that they want to invest in. And it has dedicated mandates with custom terms, full transparency, and it has higher minimum entry, because the risks and return and divestment for hedge fund is there is alpha, right? And they have market neutral strategy, which is zero, beta, right? And the diversification is moderate. Well, historically, correlation is low, but correlation spike during market strength. And this is just my last slide, the last module. I'll quickly run through that. Introduction to the digital asset, learning module 7. We have the DLT for short, which is the distributed ledger technology. This is talking about the fintech world, right? And the DLT is a database shared across computers node, entity in a network, and there is no central authority that is validating transactions. So in this transaction happen, there is a public information, but there is a public data network and a public data database. But any private transaction that happens, there is always sort of a private key that help them to encrypt it, and they use cryptography to be able to conceal, to be able to retrieve information out of that. And then we have the proof of work. These are consensus protocol, the proof of stake, and the proof of work is used by Bitcoin. The proof of stake is used by Ethereum. So we could look at that. And when we talk about digital asset, a lot of people just think Bitcoin. No, it's not only Bitcoin, right? When we talk about different form of digital assets, we have cryptography and cryptocurrency rather, and we have asset-backed tokens, we have smart contracts, we have the DeFi application, right? And the investment fund largely you see people doing direct ownership. People have crypto wallets, is centralized or decentralized exchange, or indirect exposure. In this case, contrast and the like.
Hi,
So
Oriol,
yep.
the next class starts soon. Thank
Okay,
you.
yeah, I'm done. I'm almost done already. So this, I think this is my last slide. Okay, so it can be done direct ownership and indirect ownership, and I wish you best of luck, right, in your CFA
Thank you
level
so
one
much.
exam. Yeah, thank you.
Thank you so much, Oriol.
Yep.
Okay, so our next facilitator will be coming up soon. That's in person of Ayokunle Olubumi. He will be taking financial statements analysis. He'll be joining us soon.
Okay, good afternoon, everybody. Can you hear me?
Good afternoon. You're audible. Good afternoon.
Okay, fantastic. Okay, let me just share my slides. So can you see my slides now?
We can see your slide.
Fantastic. Okay. Good afternoon, everybody. Like Kola mentioned, my name is Ayokunle Olubumi. And then for the next 2 hours, we'll be taking a deep dive into FSC. And our area of focus, given how large the curriculum is, I'm sure know that it's not possible for us to conclude or to go through all the curriculum, all the topics within 2 hours. So we'll be focusing on 3 specific areas: analyzing cash flow, long-term assets, and also inventories. Those are the 3 core areas that we focusing. I'm sure you also so let's start with cash flow. Please, at any point in time, please feel free to drop your questions. And if you are not shy enough, you can actually even raise up your hand or ask questions on things that are not clear to you. The cash flow is simply I'm sure by you all know that it's a financial statement that shows the inflow and outflow of cash during a financial year. You can think about it as one of the statements that we use to measure performance. But the beauty of the cash flow compared to the income statement is that it's prepared on a cash basis, unlike the income statement that is prepared using an accrual basis. So meaning that it shows whatever is inside the statement of cash flow shows cash that actually comes in, unlike what we have in the income statement, right? That will only be based on the accounting concept. The cash flow statement is divided into 3 major segments: the operating activity segment, the investing activity segment, and then also the financial activities segment. The first one, which arguably is the most important, is the operating segment, where we can also call the cash flow from operating activities. And what you see here are the cash inflow and outflow from the core business activities of the company. And then also, to a lesser extent, what you also see there are the cash inflow and outflow from the acquisition and sale of financial assets classified as fair value through profit or loss. Okay. And then please also note that whenever you're analyzing the financial statement, the focus oftentimes is the CFO or the operating activity segment, given that whatever you are doing, you are looking at the ability of the company to generate cash from its core business. Now, the other side that is also important is the cash flow from investing activities, which focuses on the cash inflow and outflow from the acquisition and disposal of non-current assets. Also included in the cash flow from investing activities are cash inflows and outflow from the sale and the acquisition of financial assets classified as either fair value through OCI and or amortized cost. Now, also note that for non-financial institutions, right, cash receipts and then payments from the issuance of from the issuance of loans, right, those are included in the cash flow from investing activity. Because if you are not a financial institution, typically giving out loans is not your core business. So whatever you give out loans, it will be under investing activities. While for cash flow for financing activities focuses on transactions that affect the capital structure. And I'm sure you know that your capital structure is looking at the should I say this, the volume of your debt and equity that you are using that is being used to finance a particular company. So anything that has to do with either debt acquisition or debt payment, or is that raising of capital from equity shareholders, all those will actually even be from financing activities. Now, the cash flow statement is interlinked with other financial statements. And the beauty of it also is that, look, whatever you see in the other financial statements, you can actually use your cash flow statement to cross-check the veracity of whatever you have in other statements, okay? And also, you can use the other statement. Once you have all the other statements, you can deduce or extract your statement, your cash flow statement, and then for you to construct a cash flow statement. For instance, if you look at your balance sheet, your opening cash balance on the balance sheet, right? And then the ending cash balance on the balance sheet. If you look at the difference will typically just show you whatever happened in the cash flow statement during the year, right? So for instance, whatever you ended last year with and whatever you ended this year with, if you get that difference should actually show the movement in your cash flow statements. Similarly, you see that all the things that you see in your, for instance, if you look at your income statements, what you have there as your revenue, the cash component of your revenue sits in the CFA. This one for the cost of goods sold, the cash element of it, you see it in the CFA. And even your operating expenses, you see it in your what? In your operating, in your CFA. In terms of your interest expense, you either see it in your CFF or your CFO. We'll talk about that one very soon. And even your income taxes, right? You see it in your CFO. For your statement of changes in equity, you notice that either like I mentioned earlier, right? If you have cash inflow from issuance of equity, debt and equity securities, you see it in your CFI, and that will be your statement of changes in equities. These are for your dividends. Your dividend is also reflected in your cash flow statement. So you see that the cash flow statement is interlinked with other financial statements. Now, in computing your cash flow from operating activities or your CFO, recall that I mentioned that this is arguably the most important, right? So when you're looking at all the components of your cash flow statement. And there are two methods of computing your CFO. Okay, you have your direct method and your indirect method. In terms of your direct method, this has to do with you getting the component, each of the components that goes into your CFO, getting the cash element from it. So what do I mean? For instance, getting cash inflow from selling goods to your customer, cash revenue from customer, you see it there. Each item, right, either is an inflow or an outflow, put the line of what you have there, right? That is under the direct method. While for the indirect method, what you have there, simply the reconciliation of your net income to your CFO. Okay, to your CFO. That's what you have in the indirect method. Then under the direct method, recall that I mentioned that you have each line item, either income line item or expense line item, right? So let's talk a bit about how you can compute some of these direct items that you see, all these line items that you see in the cash flow statement using the direct method, because you won't see it directly in the financial statement. You might have to compute it. And I won't surprise it in your exams where you are required to even compute some of them. So for instance, the first one that you see there is the cash received from customers. To get your cash received from the customer, you start with your revenue, right? Then you now deduct changes in account receivables, right? Changes in account receivable. Of course, when you talk about changes in account receivables, we're talking about the closing balance less the opening balance. That will give you the changes in account receivable. So when you adjust your revenue for the changes in account receivables, you get the cash collected from your what? From customers. In terms of cash paid to suppliers, the starting point is your cost of goods sold, right? And then you add changes in inventory. Of course, your changes in inventory is your closing balance of inventory less your what? Opening balance of inventory. Whenever you will add the changes in inventory, your cost of goods sold, you get your purchases. And then you need to adjust your purchases for the changes in account receivables to get cash paid to supplier. So simply put, right, to get your cash paid to suppliers, it's your cost of goods sold plus changes in inventory minus changes in what? Account payables. That will give you cash paid to suppliers. Okay. Yeah. Now, when we're looking at cash paid to employees, right? What you get, the first starting point is to get your wages and salary expenses in your income statement. And then you adjust for changes in prepaid wages and salaries. Now, I have this in a different shade because you won't see it in your curriculum. But in actual time, you know that there's an organization that pay upfront to their staff, right? For those ones, what you see is that those ones we have a prepaid wages in the statement of in the to be an asset element, your current assets segment of the balance sheet. Okay, then they now subtract changes in wages and salaries payables. That will be your current liability segment, and then that will give you your cash paid to. For other operating expenses, right? This one can be your utility bills, insurance payment, other operating expenses. The first thing is to get that line item from the income statement. Then you add changes in prepaid expenses. You get this on your current asset segment of your balance sheet. Then you deduct changes in other accrued liabilities. That will give you cash paid for other operating expenses. Okay. For cash paid for interest, apologies, this should be cash paid to employee. That would be cash paid for interest, right? The first starting point is your interest expense in your balance sheet, sorry, your income statement. Then you adjust for changes then you deduct changes in interest payable. That will give you your cash paid for interest expense. And for income tax expense, it's your income tax expense for cash paid for income taxes, rather. Start from your income tax expense minus changes in income tax payable, okay, on the balance sheet. That will give you cash paid for income taxes. Now, recall that I mentioned earlier that for the indirect method, what you are doing here is to reconcile the net income with the what? With the CFA. And what you see is that for most organizations, you see that this is the method that is being adopted by a lot of them, largely because one, the accounting software that we have, most of the time, it's easier for you to record items using the direct method. It's very difficult for you to get each line item on the cash flow, right? That you have in the cash flow from operating activities based on using the accounting software that we have. Then also you notice that for US GAAP companies, even if you use the direct method, you must include a segment, a schedule that shows a reconciliation of your net income with your CFA, which simply is your indirect method anyway, right? So meaning that if you're a US GAAP company, you are going to do both the direct method and indirect method. So you see that oftentimes most companies adopt the indirect method in preparing their CFA. So now, how do we now the next question is, how do we prepare our CFA using the indirect method? There are 4 major steps that you need to take. The first thing, like I mentioned, is to start from your net income, right? Then you add back non-cash charges. You know, your non-cash charges such as depreciation, amortization, depreciation, impairment, all those non-cash items, right? All those you need to add them back, right? But like, because like the name implies, they are actually expenses, right? However, they have no cash implication. Next, you need to subtract gains from investing and acting, gain on from investing and from items that come from the investing and financing activities, and then you add back losses. So, for instance, if you have gain from disposal of assets, right, what you need to ask to do is what is to subtract it, right? If you have gains from selling the securities, you need to subtract it. However, if you have some losses, if there are losses, you need to add it back. Because recall that these are non-operating activities, so we need to adjust it back, do the opposite of what was done. Then the last step is to adjust for changes in working capital, right? And your working capital, like you recall, is simply your current assets minus your current liability, right? Of course, when we're talking about the current assets, we exclude cash and equivalents for this from this computation. And also, when we're talking about the current liabilities, we will include dividend payable because it's a non-operating activities, right? So now, what do you do how do you now adjust for these changes in working capital? Now, note that for current asset items, right? For every increase in each item, what you have to do is to do the inverse. So what do I mean? So for instance, all the changes in your working capital, you notice that whenever your current asset increases, right, it is either you are using cash to acquire those non-current assets, or they are there because of what? Accounting principle. So what do I mean? For example, if you see your inventory increasing, right, it means that you've expended cash to acquire some inventory, right? Also, if you see your account receivable increasing, what does it mean? It means that you are increasing, you're actually selling on credit. So the impact, when you have increase in assets, all the current asset items, for every increase, what you need to do is to what? To deduct the increase. And if there's a decrease, you add it back. Because simply what you see is that for that reduction in current asset is simply as if you are generating cash. So for instance, if your inventory is reducing, right, what you're saying is that it means that you're selling it and you're actually even getting cash. If your account receivable is reducing, that means that what? You are collecting from your customers. Okay? So for the current asset, you do the inverse. While for current liabilities, what you do is direct. So what meaning that if your current liability increases, what do? You deduct it. And if there's a decrease in your current liability in item, what do? You actually able to deduct it, right? But for increase, you add it back. Now, the next thing for us to look at is how do we move from indirect method to direct method? Because although most companies love using the indirect method, you notice as a financial analyst, the one that is more useful to you is the direct method. So oftentimes you are interested in converting from indirect method to direct method. So the next thing for what you need to do is that look, all the inflows and the outflows, you need to separate them. What are the increase and what are the reduction? Okay, right, from the income statement. Then you now take all the non-operating items, of course, all those gains and losses, you need to adjust for them. And of course, you now need to arrange each item to determine the cash flow from operating activities. Okay, right. So next, let's talk about the cash flow from investing activities. For cash flow from investing activities, what we use is a direct method. Okay. And when you are looking at the cash flow from investing activities, there's a major item that we are focused on in computing. This is your cash received from equipment sale. Okay. For cash received from equipment sale, the formula is very simple. You need to get your historical cost of equipment sold less the accumulated depreciation on equipment sold. That will give you the book value of the equipment sold. So then you need to adjust for gains, right? Add back the gains, right? And then if they lost, of course, you need to deduct it back to get your what? The cash received from what? From equipment sale. Okay. The next question we might be asking ourselves is, how do we get the historical cost of equipment sold? And how do we get the accumulated depreciation on equipment sold? Of course, know that the gains or losses of the equipment sold, you can simply get that one from what? From the income statements. Okay? Right. However, for the historical cost of equipment sold, what you need to do is to get a beginning balance from the balance sheet. Then you now need to add any equipment procured during the year. You need to check the explanatory note of the financial statements, right, to see if there were any equipment purchased during the year. Then you need to deduct the ending balance of the equipment sold. So it's the opening balance plus equipment purchased during the year, less the ending balance for the year. That will give you the historical cost of the equipment sold. In terms of getting the accumulated depreciation on equipment sold, you need to start from the opening balance of the accumulated depreciation on the balance sheet. Then you need to add the depreciation expense during the year. You get that one from the income statement. Then you now deduct the ending balance of accumulated depreciation on the balance sheet. That will give you the accumulated depreciation, the equipment sold. Okay. Now, for the cash flow from financing activities, recall that I mentioned that this has to do with cash inflow and cash outflow that affect the capital structure of the company. And like I mentioned, right, when we're talking about the capital structure, it's simply the mix of debt and equities that are using to fund these activities, right? Of course, the first thing you now want to do is that you want to first check what is the cash received or the cash paid for long-term debt. And this one is very simple. You just do your closing balance of long-term debt less the opening balance of long-term debt. That will give you the cash received from long-term debt. Same thing also for your common equity. If you want to check if there's any cash received from common stock issuance, what you need to do is get your closing balance of your paid-up capital, right, minus your opening balance of your paid-up capital, which now give you the cash received from common equity issuance. However, please, you need to be careful here. For whatever changes that you see here, either in terms of, for whatever you've gotten here, either from cash received or cash paid for long-term debt, or whatever you've gotten from cash received from common stock issuance, you might need to check the notes to the financial statement to be sure that it's actually a cash inflow. So what do I mean? For instance, you might have a long-term debt that is just converted to equity. If you compute this, it will be showing as if, oh, the company paid down some long-term debt, right? However, if you check the notes to the account, you will see there that, look, this company didn't actually issue pay down debt. What they did is to convert it to what? Equities. For instance, if you notice C&I Leasing, they had a convertible debt a few years ago that was converted to equity. Okay. So as when I'm looking at the financial statement during that particular year where the conversion was done, if you don't check the notes to the account, you might think additional debt was actually what? I'm sorry, you can think that debt was actually paid down, not knowing that it was just converted to what? To equity. Same thing also for your equity issuance. A company could have issued equity issuance from the prior year, but it could be that they've not gotten all the necessary approval, right? And of course, because of that, in that prior year, it wasn't included as what? As equity capital. But it could be that the subsequent to the year, which is the new year, is when they got a regulatory approval and they're able to capitalize it. If you don't check to the notes to the account, you would think there is a cash inflow during the year. Because, for instance, if you check some banks, of course, you're familiar with the recapitalization of the bank. Some banks raised some funds in 2024, but they didn't get the approval until what? 2025. If you are computing this and you are only looking at the changes in paid-up capital, you would think that cash came in 2025, not knowing that the cash came in what? In 2024. So you might need to confirm from the explanatory notes to the account. Now, another thing that you might also be interested in the CFA is to get dividend paid. And to get a dividend paid is very simple. You start with your what? Your opening retained earnings plus your operating income from the year. Then you now deduct the closing retained earnings. Whatever you get as the difference will be your what? Your dividend paid. Because if no dividend was paid, you notice that your opening retained earnings plus your net income from the year will ultimately become your what? Your closing retained earnings. But if there's a difference between them, it's actually because of what? The dividend that was paid from the year. Now, in terms of IFRS and US GAAP, there are some differences on the treatment of some items in the cash flow statement, particularly in terms of dividend paid and dividend received, and also interest paid and interest received. Okay, there are differences in how US GAAP and IFRS treats it. For US GAAP, it's very simple. The trick for US GAAP is that any item that is in the income statement, it will automatically be in your what? A CFO item. Okay? So for instance, your interest paid will always be in your income statement. Of course, because of that, it will be your CFO. Interest received or dividend received and dividend received, you see that those ones are in your what? In your income statement. So under US GAAP, it will automatically be your what? Your cash flow from operating activities. This one for your income taxes, right? It will be as a CFO because it's in your what? Your income statement. In terms of your dividend pay, you all know that your dividend pay is not in your income statement. You see it in your statement of changes in what? In equities. Because of that, it is always in the what? In the CFF, when the cash flow for financing activities, right? Under what? US GAAP. However, for IFRS, in terms of dividend paid, right? IFRS is relatively more flexible, right? However, you need to be consistent. Either one that you actually even adopt. For dividend paid, it can either be your CFO or it can be your what? CFF. But you must maintain it. You can't this year put it in your CFO and the following year put it in your cash flow for financing activities. It's not possible. In terms of your interest paid, it can also be your CFO or it can be your what? Your cash flow from financing activities. For interest received and dividend received, that one can be your CFO or your CFI. While for your income tax paid, are largely included where the activity, depending on the activities that is resulting into the taxes. So for instance, although you see that the bulk of your income taxes will be your CFO, because that one is largely from your what? Operating activities. However, let's assume that you sold some stocks, right? Or you stole or even let's assume that you sold some securities, some debt securities, and because of that, there's a tax that you have to pay to the government. Because those what you've sold is actually an investing activities, the associated tax will be your CFI. While assuming it has to do with what? Financing activities, the taxes will also be in your what? In your CFF, right? That's under IFRS. Okay. But note, like I mentioned, under US GAAP, everything is in your what? It's in your CFF. Remember that I mentioned that under US GAAP, right? Even if you use your income your direct method, you need to prepare a reconciliation schedule that actually help us to reconcile the income statement with your what? With the CFO. While under IFRS, you don't have such requirements. Okay. Now, in terms of analyzing your cash flow statement, there are some things that we might need to also look at as when you're analyzing the cash flow statement of the company. The first thing is to first look at what are the major sources and uses of cash flow from either operating, investing, or financing activities. Next, you now need to check for each of those operating activities, the cash flow for financing activities and cash flow from investing activities, right? You need to now take a deep dive into them. What are the things that are driving them, right? And are this cash flow that you are saying, this trend that you are saying, is it sustainable? because you see that either it's sustainable or not. Oftentimes we depend on the stage of the company. So for instance, if you see a company that is in the early stage of its growth, you will say that, look, operating activity, the CFO oftentimes is always negative, right? The cash to fund the business are typically oftentimes from financing activities and to a lesser extent investing activities. But you see that trend will not continue, right? Because if you're analyzing a company, you might be analyzing it in the long run. So you need to look at and even determine what are the things that you expect in the long run. Okay. Now let's talk a bit about your free cash flow. And your free cash flow, like I'm sure you have known now, is simply the cash that is available for you, all right, for you to meet all your obligation, right? After you met all your obligation, what is the cash that is available for a company? After you met all your operating, all the obligation from your core activities and even your capital expenditure. And there are two free cash flow. There is free cash flow to the firm and then the free cash flow to equity. For free cash flow to the firm, that one looks at what is the cash that is available for both the debt holders and the equity holders, while free cash flow to equity focuses on the cash that is available to equity holders. So that means that for free cash flow to the firm is looking at the cash flow that is available for the company before meeting obligations to debt holders or equity holders, right? So after you've met all the other obligations, except those to debt holders and equity holders, what are those that are available for the firm? While for free cash flow to equity, that one is looking at met other obligation, improved that of the debt holders. What are the cash flow that is available to the what? To equity holders. Okay. Now to compute the free cash flow, there are two methods. You can either start from your CFO or you can start from your net income. So if you are starting from your net income, you need to add back non-cash charges. Remember all the non-cash charges that we talked about earlier, depreciation, amortization. Okay, you need to add it back. Then you now need to adjust for your interest expense, right? And then you adjust for you need to add back your interest expense because you've deducted your interest expense to get your net income. Of course, you need to adjust it for taxes. Then, of course, you need to deduct your working capital investment and then also your fixed capital investment. If you are starting from the CFO, you need to add back the interest expense. However, please note, you need to add back for a company that's using IFRS and in which the interest expense was included in your cash flow from financing activities. You don't need to adjust it back, right? It is only when your interest expense was deducted from your CFO that you need to adjust it back. Then, of course, you need to adjust from your capital expenditure. Of course, remember that your working capital investment, you would have adjusted it before you get your CFO. So there's no need for further adjustments. In terms of your free cash flow to equity, remember that I mentioned that this is the cash flow that is available to equity holders alone, right? And the formula is simply your CFO less your capital investment, and then you adjust it for net borrowings. Either it's increased or it reduced. Okay, during the year. Then lastly, let's talk about the cash flow ratios. There are some ratios that we use to check the quality of a company's cash flow. The first one is your cash flow to revenue. The cash flow to revenue shows the proportion of the revenue that is actually cash based. And I'm sure you've learned that under your earnings policy, one of the ways in which you can get the quality of the earnings is to find out what is the proportion of the revenue that is actually cash based. The higher the proportion that is actually cash based, the higher the quality of that particular company's revenue. So your cash flow to revenue is looking at your CFO, the proportion of the revenue that is actually from cash. Next is the cash return on assets, which is looking at the cash that you're able to generate from using those assets, right? And then thirdly, you have the cash return on equity. This one is looking at your CFO as a percentage of your equity. But looking at what is the cash that is able to generate from the equity that the shareholders has provided. In terms of the next one is this cash flow to income, which is your CFO to operating income. This one is looking at the proportion of your operating income that is actually cash. And then the cash flow per share is your CFO minus your preferred dividend divided by the number of what shares outstanding. It's looking at what is the cash flow that each shareholder is simply entitled to. And then the last set of ratios, cash flow ratio that we look at are the coverage ratios. That one is looking at, is measuring the gearing ratios of that particular company. So the first one is the debt coverage ratio, which is your CFO as a percentage of your total debt. So it's looking at, it's basically looking at what is the CFO that you have that is available to cover the debts that you actually will have. While the next one is your interest coverage ratio, which is your CFO plus your interest plus the interest paid, if it has been deducted from the CFO plus cash paid divided by your what? By your interest paid. It's simply looking at how many times can the CFO cover the interest that was paid during the year. Then the reinvestment ratio, look at your CFO divided by the cash paid for long-term asset. It's simply looking at what's the proportion of your the long-term asset acquired during the year that your company paid for itself, that the company use, that the company's CFO can actually recover. Next is your debt recovery repayment ratio, which is your CFO as a percentage of your long-term debt repayment, and then your investing and financing ratio, which is your cash outflow from investing and financing activities. Okay, so I think that was actually a run through on the cash flow statement. I think I have some questions here. Let me look at let me try and see if I can have some question. Okay, changing is yes, please, yes. Now on the cash flow items, changes in inventory, all the changes is simply ending minus beginning. Okay, right. So Dima, please note that one. They actually is actually the same thing account receivable, same thing also, ending minus beginning. Okay. Okay, yes, other what circumstances will the cash flow from financing activities be equals to the free cash flow from financing activities equal to cash flow from free cash flow to equity. Now you have this scenario if simply you don't have any debt, because if you don't have any debt, you don't have debt holders in that particular company. So simply what you have is your what? You simply have your shareholders. You don't have any debts in that particular company. So this is the same thing. Okay. Okay, this when there is no net borrow. Okay, yes, you are right, Fola. Yes, you're actually right. Thank you. Thank you, Fola. Exactly. When there is no borrow. Okay. So is there any other question on cash flow before we move to inventory? Any question? Any question? Okay. Right. So let's quickly do a run through on inventory. Okay. Let's quickly do a run through on inventory. Like we all know, inventories are goods held by a company with the intention of selling it to the customers, right? Either in the current state or the company might actually even plan to process it further before selling it, right? So the one that they want to process further can either be raw materials or what? Or work in progress. And what you see is that for manufacturing company or trading company, that oftentimes we call merchandising companies. You notice that for them, inventory form a significant proportion of their of the asset base, right? In terms of even it will even be dominant in the in the current asset. So it's very important in looking at inventory for a manufacturing company or a trading company. Now, under IFRS, there are 3 methods that are allowed for inventory valuation, right? You can have the specific identification, you can have the first in, first out, or you can have the weighted average method. Okay, I'm sure you all know specific identification means that you can identify each item of the inventory and also identify the cost associated with it. For first in, first out, here the assumption is that is the first it is the first good that entered the company that is sold first. Okay, so that means that is the oldest inventory that we have, that is the first one that we sell first, right? And then for weighted average, you get an average of the goods, of the prices of that particular goods. Now, for US GAAP, there is an additional method that is allowed, which is called last in, first out. Here, so that means, so here the thinking is that is the last item that actually even enter into the factory or the warehouse is the one that goes out first. So that means that under US GAAP, there are 4 methods allowed. There are specific identification, first in, first out, weighted average, and then last in, first out. However, please note that IFRS does not allow last in, first out. Okay, I mentioned earlier, inventory valuation is very important because it affects the total assets, cost of goods sold, and then also the profit of the company. Now, you also need to also note that oftentimes the inventory valuation method determines the profitability of a company or even the size of the what of the closing inventory. Because what you see is that a company, if they are using LIFO, all right, the profit that they will record will be different from the profit that they will have, assuming that they are using first in, first out. If they are using last in, first out, will be different from what if they are using first in, first out, right? Same thing also, if the company is using specific identification, the profit or the closing inventory might actually be different if they are using what? If the company is using the weighted average cost. So meaning that before you are doing comparison of companies, you need to be sure that they are using almost the same inventory valuation method. Okay. I think yeah, okay. Inventory valuation is not that difficult. Although it's a bit technical, but it's not that difficult, right? I can see my comment so that stress your life. Don't worry. It's not that difficult. Okay. Now, the next question is, how do we value inventory? Under IFRS, right? Inventories are valued at the lower of what? Costs or net realizable value. So what is, if you talk about cost, what is cost? Cost simply means all the expenses incurred in bringing that particular inventory to the state where it is now. So that's the cost of the inventory. Then the net realizable value is simply the expected costs, the expected income that we generate from selling that particular, less the associated what? Cost of selling it. So for instance, let's assume that if we sell that particular good in the market, we're going to generate what? 10 naira. But assuming that we need to employ an agent that we pay 1 naira to, right? Our net realizable value is 10 minus 1, which is what? 9. So IFRS says that look, we need to get what? The cost and the net realizable value, right? The lower of it will actually even be the value of the inventory. Now, for under US GAAP, right, it's a bit different, right? So they said that for under IFRS, they said that you can use lower of cost or net realizable value. Okay. However, if you are using LIFO, there is even a third complication to it. There's now what we call the what? Market value. So under US GAAP, if you are using LIFO, you need to get the lower of either costs, net realizable value, or market value. The next question is, what is market value under US GAAP? Now, under US GAAP, what they call the market value, it has a low upper edge and it also has the lower edge. The upper value or the upper limit is simply the what is the net realizable value. Okay, so meaning that they are saying that look, it cannot be higher than the net realizable value. However, the lower limit is simply the what? The net realizable value less the what? The normal profits margin. So meaning that under US GAAP, right, they are simply telling you that look, the value of that inventory should either be the what? The value of the inventory should be the what? The lower of costs or market value. Given at the upper limit of the market value is simply the net realizable value, while the lower limit is what? The net realizable value or less the what? Net realizable value less the normal profit margin. Okay. Now, please note there are some note for every rule. There are also exceptions. Here, in terms of inventory valuation, we have some exceptions. Now, for agricultural products, forestry products, timber, right? Minerals, lands, all those ones, all those items are valued only using what? The net realizable value. Of course, remember we mentioned all the net, what net realizable value, we mentioned it earlier. So for all those agricultural products, forestry products, minerals, right, commodities, we are using what? Net realizable value. Now, the other exception has to do with valuation of gold, or what some people call bullion. For gold, you need to mark it to market. Okay? Because ultimately, when you are holding gold, the reason why you are holding gold is that you want at the end of the day for you to be able to sell it and generate profit. So you need to mark it to market, right? So meaning that the current market price should be the what? The valuation of gold that you have in the what? Inventory. Now, let's talk a bit about inventory write down. Like most asset that you have, you know that you might need to also check if the value has gone down lower than what you actually even have on your balance sheet. Okay, right. So under IFRS, right? You need to under IFRS, you need to check if the value have actually even reduced, right? Whenever the carrying value, whenever the value of an asset has reduced below the carrying value, or in this case, we are talking about inventory. So whatever the value of an inventory has gone below the what? The carrying value, you need to write it down to that carrying you need to write, so whenever you need to write the carrying value down to that particular value. So let me take that again. Whenever the value of an inventory is lower than the carrying value, you need to write down the carrying value to that particular current value of that inventory. So what do I mean? Let's assume that you're carrying the inventory at 100 naira. And assuming that the value of that particular inventory is simply 80. So you need to write it down from 100 to 80 and expend that 20 because you've overstated, quote unquote, that particular inventory, right? And you need to also know that, look, right? You need to know that, look, for your inventory write down impacts your profitability, liquidity, and then what? And solvency of what? Of a particular company. Okay? Right? So definitely company don't like to actually even write down. Right? But of course, you need to check. We'll talk about that one in the next night, right? The next question is, what happens if there is an increase in the value of this inventory? So let's assume that that inventory, right? Like the example I gave earlier, you're carrying it at 100. Now you're looking at the market value, the value of the inventory now is now 80. You've written it down to 80. Let's assume that a year's time, the value has now gone up from 80 to 150. What did you do? Now, please note, under US GAAP, you cannot reverse any write down. Once you've written it down, the written down value will be the carrying value of that inventory. Going forward, it's until you're able to sell that particular inventory. However, under IFRS, you are allowed to reverse the inventory, to reverse that particular write down. However, it is only allowed up to the initial write down. So what do I mean? Remember like an example I gave, the value was initially 100, it went down to 80, wrote it down to 80. Now it has gone back to 150. Like I mentioned, under US GAAP, you can't write it down, the value will remain 80. However, under IFRS, you can't go back to 150, but it can go back to what? 100. Right? So it can't go up to 150, but it can't go exceed 100, which is the present value of that particular, the initial value of that inventory before the write down. That is only allowed under IFRS. Okay. Now, I think I mentioned to you that look, a lot of companies, they don't like to write down inventory because whenever they write down inventory, like I told you earlier, it will impact their profitability negatively, to reduce the total assets. It will even affect their solvency and liquidity ratios. So that means that whenever you're analyzing a company, you might need to check if there is actually even need to write down that the company is trying to even dodge. And it is important for companies that have very high level of obsolescence. When their inventory typically, they find they easily get obsolete. So for instance, if you look at technology companies, if you are the one selling, if I have a company that is selling, let's say mobile phones, you know that for mobile phones, before you know it, a new version is out, or a new version is out, such that will reduce the value of the initial one. So for those ones, you might need to also check the blame. Now, another thing that is also very important that I want you to note is that, note that companies using first in, first out, weighted average, and specific identification are prone to having what? Higher write down compared to somebody that is using last in, first out. It looks as if it's counterintuitive, but let's think about it. For a company that is using first in, first out, you agree with me that the closing value of the inventory will be closer to the what? The market value of the inventory. Even somebody that is using weighted average, and even specific identification, you notice that the carrying value of the inventory will be close to the what? The current value of the inventory in the market, right? Such that if there's anything that happens to the value of that inventory in the market, right? If there's a drop in the value, it will also affect the amount that you can actually realize from selling the inventory. But let's look at somebody that is using last in, first out. Remember that last in, first out, the one in the inventory is the oldest one. And those oldest ones, we also have the cost of the what? The initial cost, which know that normally we are, oftentimes we are in an inflationary environment, although the question is now the level of inflation. So oftentimes you see that their initial cost of those inventory is actually very low, such that if there's a decline in the market price of that inventory, it might not have gotten to what? The historical value of that particular inventory. So meaning that if you see a company using LIFO, weighted average, as specific identification inventory valuation, you might also need to check closely if there is a need for them to write it down compared to somebody that is using LIFO. Okay. Now, please also note, remember how I mentioned to you earlier that profitability, liquidity, and solvency ratio are negatively affected whenever you have a write down. However, please note that there are some activity ratios that might look better when they write it, when the company writes down its assets, writes down its inventory. So the ratio like asset turnover or inventory turnover. What do I mean? Remember that for asset turnover, the denominator has reduced. So it looks as if the company is more efficient because the asset size has reduced, right? So it will look as if they are able to turn over their assets more. Same thing for your inventory turnover. Please note that it doesn't mean that the company is doing better, right? The company is actually even what? They've lost some assets that they've actually even written. So don't be confused whenever you see that this ratio are a bit better after inventory writes down. Now, let's look at the impact of inflation and depreciation, right? Impact of inflation and deflation also in the cost of goods sold and also the closing value of inventory. Now, please note, right? Whenever you, assuming that the prices are not increasing or reducing, assuming that prices are constant, what you notice is that, let's assume that prices are constant over the last 20 years. Irrespective of inventory valuation method I use, see that the cost of goods sold, the closing value of inventory, and even the profitability of the company will remain the same, irrespective of the inventory valuation method that you use. However, whenever you have inflation, whenever you have prices rising, and then you have goods, the quantity of the company, if the quantity of inventory, if it's increasing or is remaining constant, you will notice that your first in, first out, we have the lowest cost of goods sold. The first in, first out, we have the lowest cost of goods sold, because the cost of goods sold is taking the what? The historical cost of what? Of inventory. And because it's having the lowest cost of goods sold relative to other inventory valuation method, you notice that it will also have the highest profits, right? However, last in, first out, we have the highest cost of goods sold and then the what? The lowest profits, right? Compared to all the other inventory valuation method. Of course, the weighted average cost will actually be in the middle. Now, whenever you have a deflation, right, or prices trending down in terms, and then you have either quantity of inventories that is either constant or is increasing, what you notice is that is your first in, first out that we have the what? Highest cost of goods sold. Recall that the first in, first out, we have the historical what? Value of that inventory in the what? In the cost of goods sold. And given that that historical cost is the lowest, remember that we're looking at, if you're looking at, is the highest rather, because prices are actually even going down. You see that you will have the highest cost of goods sold and the lowest profits. While conversely, the last in, first out, we have the lowest cost of goods sold and then what? The highest profits. Now, in terms of closing inventory, during in an inflationary environment, what you see is that is your first in, first out that we have the what? The highest closing inventory. Because don't forget, we are in an inflationary environment. The closing inventory, we have the what? The value of the inventory that is actually what? That you've actually even, the value of the inventory that you actually even that entered that particular company last. So it will have the what? The highest closing inventory, while last in, first out, we have the what? The lowest. In a deflationary environment, you see that first in, first out, we have the lowest closing inventory, while last in, first out, we have the what? The highest inventory. Okay, right? Ditto for under deflationary environment also. Okay. Now, in terms of inventory ratios, okay, I think there's some, let me see that, I think there's a comment here. Okay, you guys are just cracking me. Okay, that's fine. Now, in terms of inventory ratios, there's some ratios that are used to check the efficiency of inventory management. Because for an organization, particularly for manufacturing company and trading companies, right? How well you are able to manage your inventory can determine to a large extent how profitable that particular company is. So the inventory ratios are very, very important for manufacturing companies and trading companies. So the first one is your inventory turnover, which is simply your cost of goods sold, right, divided by your your average inventory. Looking at how many times you are selling it, you are able to sell your inventory. And of course, for that particular ratio, you note that the higher the better, because it means that you are actually even throwing out a lot of your inventory. Now, instead of looking at the number of times you're able to turn over your inventory, you might want to say, on an average, how long does an inventory stays in the warehouse, right? That will even show you if you are managing your inventory efficiently. Okay, right. So for this particular ratio, how do we compute it? There are two ways of computing it. Assuming you have your inventory turnover, just get the number of days in the period divided by your inventory turnover. So for instance, assuming I'm looking at the number of days in a year, that's 365 days, divided by your inventory turnover. That will give you your days of inventory account. However, assuming you don't have your inventory turnover, you can start from your what? So your closing inventory divided by your cost of goods sold, multiplied by the number of days in that particular period. Next is your gross profit margin. Of course, you all know your gross profit margin, which is your gross profit divided by your what? By your revenue. Okay. And then how do you know if a company is doing well through these ratios? The first thing to do is to first compare it to peers. And don't forget what I told you earlier. When you are comparing it to peers, you ensure that, look, the peer that you are comparing the company with is also using the same inventory valuation method. Because if you are comparing a company that is using weighted average with somebody that is using first in, first out, you're actually comparing apples and oranges, and your analysis might actually be wrong. Then after that, you might want to compare with your industry average, okay, to see if you are doing better or you are even doing worse. And of course, if a company is doing better, that should be reflected in the traditional profitability ratios, your return on assets, your return on equity, and also your current ratios. Okay. Any question before we go into long-term assets? Right? Any question? Okay, I'm not sure we have any question. So we assume that we are fine with inventory, analyzing inventory. So let's look at long-term assets. Okay. And in looking at long-term assets, the primary focus is intangible assets. The first one is your intangible assets. So for intangible assets, like we all know, your intangible assets are assets that you can't see, you can't touch, but you can feel the asset, you can feel its impact. And at times, you can even use that asset to generate revenue. Of course, for it to even be an asset, it is simply something that will result into inflow of what? Revenue in the future. Okay? Now, for your non-intangible assets, they are divided into two under IFRS. There's what we call identifiable intangible assets and unidentifiable intangible assets. Identifiable intangible assets are those that you can actually even separate it from that particular company. And because you can separate it from that particular company, you can actually sell it separately. But for the unidentifiable intangible assets, you see that look, it's already subsumed in that particular company. And it might be difficult for you to separate it and therefore you to sell it separately, unless you are selling that particular entity itself. Now, for an intangible asset to be identifiable, or for it to be an identifiable intangible asset, there are 5 conditions that it must meet. It must actually even meet under IFRS. The first one is that it must be identifiable. Of course, it must be identifiable. So that means that it can legally be separated from that particular company. Second condition is that it must be under the control of that entity. It must be expected to generate future economic benefits. Not only must it be expected to generate future economic benefits, those future economic benefits must also be probable. Something that is actually, we are almost sure that it will come into that particular entity, and then the cost of the asset must be able to be identified or measured separately. Reliable. Okay. Now, I'm sure we've heard goodwill before, but please note that goodwill, although now something that you also see is that for identifiable intangible assets, they are given value separately on the balance sheet. Okay. Now, the only exception is goodwill. You will see goodwill on the balance sheet. However, goodwill is not an identifiable intangible asset, because if you remember goodwill is only come about whenever you acquire in another company. So meaning that you only see goodwill in the financial statement of a company that have acquired another company, right? So you can't say, oh, my company, because if customers are liking me, everybody is happy with me because I want to go and create goodwill and financial statements. No, right? Whenever you see good, it's only when you've acquired another company, right? And then you can't actually even sell that good business separately. That is why you can't, the goodwill is not an identifiable intangible asset. Now, there are 3 ways in which a company can even come about an intangible asset. Is either you acquire that particular intangible asset separately, you develop it internally, or you acquire that particular intangible asset whenever you acquire another company, right? You come about that other intangible asset whenever you acquire another company. So we'll focus on the internally developed intangible asset, because that one is it's actually even very, very important. So that one zero in today. Okay. Now, for internally developed intangible assets. Now, you'll see that we'll talk about it a bit in the next couple of slides. You notice that for the cost of developing those intangible assets, there are some That is that there's some costs that are expensed, and then where some are capitalized. Okay, right? For it's one that is actually developed internally. However, whenever you acquire an intangible asset, all the total cost of acquiring it is actually what? Capitalized. So that means that in terms of strategy, either you want to develop it internally or you want to acquire it, would determine the valuation, or should I say, the amount of capitalization that you have on the balance sheet, and even to an extent, the expense associated with that particular intangible asset. So what do I mean? Let's assume that you acquire a particular intangible asset. You notice that the amount that you capitalize will be higher relative to a particular company that actually have the same intangible asset but was developed internally. So what you see is that the one that is developed internally, they're going to capitalize a lower amount, because remember what I told you, a proportion of that particular, all the cost of developing that intangible asset would have been expensed. While if you are acquiring it, you are capitalizing all the cost of acquiring it. Okay. Now, what you also notice that whenever you acquire an intangible asset, it will be what? A CFI item. It will be an investing activity item. However, if you develop it internally, the cost that is expense will be what? A CFO item. So you notice that it's not only the asset base that will be different, even the cash flow statement will actually even be different to an extent based on the strategy of getting that in that intangible assets. Same thing for your expenses. What you notice is that for a company that is acquiring an intangible asset from a third party, you see that in the year of acquisition, just the amount that they are going to expense based on that particular intangible asset is going to be lower compared to if they develop it. Recall that is the proportion that is amortized during the year that will be expensed in the income statement. However, in that year, for the person that is developing it internally, what you notice is that, look, because some component of their particular of the cost of even developing those intangible assets at expense, you see that in that particular year, the amount that will be expensed will be higher compared to if it has been acquired. But in subsequent years, what you see is that the person that acquired from a third party, you notice that in subsequent years, their expenses will be higher compared to the one that developed it internally. Because the one that developed it internally, don't forget, is lesser amount that is being capitalized. And remember, it is what is capitalized that will be expensed, that will be amortized in subsequent years, right? In the income statement. So meaning that the strategy of either acquiring it from a third party or developing it internally will affect the balance sheet, will affect the income statement, and will also affect the cash flow statement. Not only in that year, you see that the income statement subsequent years will also be affected by the strategy or decision taken during the particular year. Now, the next question you'll be asking ourselves is, look, which proportion of what proportion of the what do you call it? Which proportion is of the assets should we expense, or which proportion should be capitalized? Now, for IFRS, the development of most for other IFRS, when you're actually even developing an intangible asset internally, for most intangible assets, right, you are allowed to capitalize some portion of it. However, under US GAAP, it is only software that you are allowed to even capitalize any at all. Any other software under US GAAP, you need to expense everything. However, for software and for software and for most intangible assets under IFRS, you need to separate all the expenses into what we call research costs and what? Developmental costs. Now, research costs are all the costs expended during the research phase, while the development costs are all the costs incurred during the developmental phase. Now, the research phase is of a software development. It's seen as the period in which we are not yet sure if this particular software will be used. We are not yet sure if we will be able to complete it. We are not yet sure if this software will bring what? Future economic benefits into that particular company. So all the costs up to the point in which we are 100% sure, all those ones will be what? Will be expensed. However, once we've got it to a point in which we are sure that we can complete this software, right? Software development, there is already visibility on this particular project. We're even sure that it will bring in flow of economic benefits. Then we need to start what? Capitalizing it, right? So that is one that will actually be capitalized. But all the costs that is incurred up to that particular point, we have to what? We have to expense, right? All of them, right? We have to do so. Okay, now there's a question. How many years can intangible asset be amortized for? Yes, you need to amortize it over the expected useful life of that software. So for instance, let's assume that you acquire it from a third party. Remember that if you acquire it from a third party, there will be a lifespan of that license, right? Either they will tell you that you can use it for only, you have access to it for either 5 years or 10 years. You amortize it over that particular period. Even for the one that you develop internally, you also know that it will only be useful over a particular number of years. So you amortize it over the number of years in which you expect to use that particular asset. Okay. Now let's talk a bit about impairments. All right. Another curriculum. I think this one was expanded to include property, plants, and equipment, apart from even the intangible asset also. Now, under impairment, what's impairment? Similar to what you have under inventory. Impairment is simply, we always say that an asset is impaired if the value that we can get from that particular asset, if I can call it realizable value of that asset, is lower than the carrying value. Okay? So if the amount that we think we can realize from a particular asset is lower than the carrying value, we need to write that asset down to the realizable value. We need to write down the carrying value to the realizable value. And that difference is called what? Impairment. Now, the standard does not say that we need to test for impairment every year, but it says that at the end of every year, you need to check if there are signs of impairment. Then if there are signs of impairment, then you need to go ahead and now test for impairment. But if there are no signs of impairment, you don't need to bother yourself about even going and even testing for impairment. And then there's some indication of impairment. For instance, assuming that there is already indication of obsolescence, you might need to test for impairment. Like I mentioned earlier, assuming that you're using a software and there's already a new version in town, or your competitor has developed one that is actually even more efficient, you might need to test for the impairment of that particular asset. Or it could be that, let's assume that it's actually an intangible asset and it has been hacked, right? It is not as useful as it used to be. Or let's assume that it's a property, plant, and equipment, right? Let's assume that it's a building, and that area suddenly became prone to flood. You agree with me that the value of that particular property have actually even reduced. Or if there is a decline in demand, right, for that particular product, definitely it shows that look, they are indication of of impairment. Now, the question is, how do we test for impairment under US GAAP and under IFRS? There are a bit of difference on how we test for impairment. Now, under IFRS, right, the test for impairment, you need to compare the carrying value and the realizable amount. You need to compare the carrying value and the realizable amount, right? The question is, what's realizable amount? Your realizable amount is simply the higher of the what? The value in use and the fair value less cost to sell. What does it mean? Let's think about it. If you want to realize an asset, there are two ways of realizing an asset. Either you sell it or you use it. So if you are selling an asset, the amount that you comes to you is the fair value of that asset, the amount that you get when you sell it, less any cost to sell it. So let's assume that the cost of selling that building is 100 million. Then you need to get a broker that you pay 10 million. The amount that you realize from selling it is actually what? 90 million, because 100 million and then you need to pay 10 million to get your what? To get your 90 million. Now, the other alternative is for you to use that asset internally. And if you are using that asset internally, it's expected to contribute to what? The cash flow of the company. It's expected to increase the cash flow of that particular company. So the additional cash flow that you are going to get from using an asset, when you now discount it, that will give you the what? The value in use. Right? So the value is simply the what? The present value of the future cash flow or the additional cash flow generated from using that particular asset. So that's why we always say that your realizable amount is the higher of what? Fair value less cost to sell or value in use. And of course, you agree with me that as a rational human being, you notice that for an asset, you will realize an asset using the one that is higher. Because if it pays you more, if the value that you get from selling a particular asset is higher than the value from using it internally, what do? You sell it off. What if you think it's you generate more value to using it internally? What do? You keep it and you use it. Okay? So whenever the carrying value is higher than the realizable amount, we always say that the asset is paid. Then we write down the carrying value to the what? The realizable amount. Now, under US GAAP, there are two steps in actually even computing impairment, right? So we always there's something that we call the recoverability assessment. Is when you conduct that one. If that one is now showing you that, look, oh, the asset seems to be impaired, that's when you now go ahead and compute the what? The impairment loss. So what is recoverability assessment? The recoverability assessment is very simple. What you do here is that you simply compare the carrying value with the undiscounted future cash flow of that particular asset. Please note, it is the undiscounted future cash flow from using that particular asset. So whenever the carrying value is higher than the undiscounted future cash flow, we say that, look, that asset is impaired. And what do? We write it down. However, if the undiscounted future cash flow is what? Is higher than the carrying value, we say that asset is not impaired. So there's no point for you to compute the what? The impairment charge. Just keep on carrying it at the current value. Now, if let's even assume that the carrying value is what? Is higher than the undiscounted future cash. What do? Then you now proceed and compute the what? The impairment loss. And how do you compute the impairment loss? You simply compare the carrying value with the fair value of the what? Of the assets. Please note, the impairment loss, what you do is compare the what? The carrying value with the what? The fair value. Note that they are not comparing it with the undiscounted future cash flow, right? You don't use the undiscounted future cash flow here. What you use here is the what? The fair value of the assets. Okay? Right. So for your the impairment loss is then expensed, right? That impairment loss is expensed in your income statement, and of course, it reduces the profitability of the particular company. Please note that impairment loss is a non-cash item. So meaning that, assuming that we are computing our cash flow from operating activities, we would have actually added it back. And also note that one, when you are computing your free cash flow, your impairment loss is simply a non-cash item. Okay? Because of course, from this our explanation, you can see that look, we are simply adjusting the valuation of that particular asset. It is not a cash. It doesn't have anything to do with cash. Okay. Now, there are also what we call the long-term assets held for sale. Now, long-term assets held for sale are the assets that the company expects to sell in the near term, right? You can think about it as an asset, right, or group of assets that the company is not only that they are only planning to sell it, it is highly probable that that particular sale will be consummated within the next financial year. Right? So those are the ones that the non-current asset are the asset that you are planning to sell, and it's very, very probable that you sell it within the next financial year. So what a company typically do is that whenever you've designated an asset as current asset, non-current asset held for sale, the first thing you need to do, you need to stop depreciating that particular asset. Next, you now test it for impairment. Right? Of course, you remember how to test for impairment. Either you are using US GAAP or you are using what? IFRS. Now, after testing for impairment, then you now separate it from your other property plants, from your other non-term assets. So now there will now be a separate line called what? Non-current asset held for sale. Then you now put the value. Even there are some companies that they even put it below the line. They separate it from the assets and they even remove the impact from the liability. And after getting the total assets, that's when you now see non-current asset held for sale. They will now get the value. Some even separate that just to show that look, it is in the near term. Whenever you're analyzing our company, by the time you come next year, it should not be in our words. Now, the next question is, what about reversal of impairments? Right? Let's assume that we've written down an asset, and tomorrow the value of the assets increases. What do we do? Can we write it back up, or once it's written down, it is written down? Now let's look at under IFRS and US GAAP, the treatment differs a bit. Now, under IFRS, whenever the value of an asset increases, you can write it back up. However, it must not exceed the initial value of the asset before the write down. Right? So for instance, assuming that the value of an asset is 500 million. Okay? Right? The following year when we were testing for impairment, we believe that it is impaired and we wrote it down to what? To 400 million. After writing it down to 400 million, if the value increases to 800 million, we can't write it back up more than what? 500 million. Right? So simply, we can only reverse the impairment charge that is allowed before, that we actually even took before, right? We can't actually even exceed that particular impairment, right? Reversal. For US GAAP, whenever you've written down an asset, right? You can whenever you have a long-term a long-lived asset that is actually even held for use. Whenever you write it down, even if the value increases, it cannot go higher. You cannot even write it back up. You've written it down, it will continue the way it is. Okay? However, if the asset is held for sale, we can only reverse the impairment like we did under IFRS. That means that under US GAAP, it is only allowed if that particular impairment charge, you're only allowed to reverse the impairment charge when the non-current asset is held for sale. Or if it's held for use, you can reverse it under US GAAP. Right. Okay. Cool. Okay, cool. Yeah. Checking the comments that we have. So now let's talk about the recognition of long-lived assets held for sale. Not only held for sale, how do we recognize long-lived assets? Now, whenever you have long-lived assets, right, the recognition has to do with removing from the assets, right? How do long-lived assets or long-term assets, how do they even leave the balance sheets? right? They can only leave your balance sheet if they are sold, if they are exchanged for another asset, if they are abandoned or distributed to existing shareholders. So there are 4 ways in which you can remove or derecognize a long-lived asset from the balance sheets. Like I mentioned, you can either sell it, you can either exchange it for another asset, you can either abandon it, or you can distribute to what? To shareholders, but particularly when assuming that you're having a spin-off transaction. Now, whenever you sell a particular asset, right? In that case, you now be interested in the gain or the loss for the sale, right? Whenever you sold an asset, this question is, look, did you make a gain from it? What did we record a loss from it? If it's a gain or a loss that you've recorded from it, that will be your what? Will now be your income statement. And how do you compute your gain or loss from the sale of transaction? It will simply be from the sale of that non-current asset to be your what? Your sales proceed minus your carrying value of that long-term asset. Remember that your carrying value is simply your historical cost, less accumulated depreciation, and of course, you adjust for any impairment charge, right? Of course, I mentioned to you that your the gain or loss will be recorded in the what? In the income statement. And of course, you also see it at times in the explanatory notes. Okay. Also know that these gain or losses, these ones are actually what? They are non-cash items. And because they are non-cash items, what you see is that look, you need to adjust for it when you are preparing your cash flow from operating activities. Now, if an asset is abandoned, right? In this case, it's almost similar to what you have earlier, but here the only difference is that look, you are not getting any proceeds from it. So definitely there will be a loss from abandoning that particular asset. And that loss will be equal to the what? The carrying value of that particular asset, because you are not getting anything from abandoning that particular asset. Now, whenever you exchange an asset for another one, the standard requires you to estimate, like I use the word estimate, right? Because it might be difficult for you to get it. You estimate the gain, or let me say compute the gain or loss from what? That particular exchange, right? You know, you already have the value of the assets that you are letting go of. You need to compare it to the value of the assets that you are getting in return. That difference will tell you if you made the gain or a loss on what? That particular exchange. Now, you know that the ideal thing is to try and get the fair value of the assets that you are getting, right? And comparing the fair value of the asset that you're letting go of. However, it might be difficult for you to get a fair value of the asset that you're letting go of. If that is the case, the standard says that look, use the carrying value of, sorry, it can be difficult for you to get the fair value of the assets that you are actually even getting, right? The asset that is even coming that you are receiving in the exchange. If it's difficult for you to get a fair value, the next is that you should use the carrying value of the asset that you actually even want that is coming to your books. And if you can't get that one, the best thing for you to do is to use the carrying value of the asset that you are disposing. Okay? And in a spin-off, this one is very simple. The asset is simply removed from the balance sheets. Okay? Now, let's quickly look at some long-lived asset ratios that are very important that can help us to check how you are using your asset. The first one is your fixed asset turnover ratio, which is looking at your revenue divided by your average fixed assets. Here we are looking at the ability to use your revenue, to use your assets to generate revenue. And this one is showing you how much you are able to sweat your asset and generate revenue from it. And of course, for this particular ratio, you agree with me that the higher the ratio, the better. Now, the next ratio is telling you the average age of an asset, of a long-term asset. Now, when you are looking at the average age of the asset, this will help you to know maybe you should be thinking about what? Replacing that particular asset, because that one will also let you know how efficient your assets will be. Because you agree with me that look, the older your assets, the lower the efficiency, of that particular asset, the lower the profitability of that particular asset, the lower the income you should be able to even generate from using that particular asset. And how do you get the average age of the asset? Simply your accumulated depreciation, right, divided by your what? Depreciation expense. Okay? Now, similar to this is the remaining useful life. So your remaining useful life is your carrying value divided by your what? Your depreciation expense. However, let me add this. Please note that the average age of fixed assets and the remaining useful life of fixed assets, right? These ratios, you can only get it accurately. Number one, if you are using the cost model, I'm sure by now you know that there are two different methods of valuing long-term assets. You can either use the cost model or you use your what? Your revaluation model, right? Under US GAAP, only the cost model is allowed. While under IFRS, you can either use the cost model or you use your what? Revaluation model. You can only use this formula, average fixed age of assets and remaining useful life, if you are using your cost model. Also know that you'll only be able to get it accurate if you are also using the straight line method of depreciation. Okay? Now, of course, this one I will talk about depreciation expense. You also agree with me that assuming that we are looking at an intangible asset, we'll be talking about what? Amortization expense that we'll see there, not what? Not depreciation. Okay? Thank you very much. I think that is the end of our session today. But is there any question before I go? Is there any question that is something that is not clear that you want us to talk about? Is there anything that is not clear? Like any question that you want to ask before I go? Okay. I think
sorry, which ones are we doing tomorrow? Which courses?
Don't worry. Bukola, we answered, we actually even revert on that, but because of that, okay. Amit, your hand is up. Yeah, go ahead.
Yes, sir. Can you please give us a brief explanation about LIFO reserve?
Sorry?
Explanation about LIFO reserve, inventory reserve.
Okay. Okay, now. Okay, so now, whatever your LIFO reserve, right, is simply the difference between when you are using your what do you call it? Your LIFO method and your FIFO method. Okay, so for instance, assuming that you are using your LIFO, what will have been the inventory value? And if you are using FIFO, what will have been your inventory valuation? That difference, right? It is actually even what we call your LIFO reserve. And remember that when we're talking about LIFO reserve, because it is only US GAAP that you can use LIFO. Definitely, you only have it under what? Under US GAAP. And of course, it's also stated that it needs to also disclose this in the financial statements if you are using LIFO under US GAAP. Okay? Okay. So Aziz asked the question, Sam, I'm still coming back to you. Let me just quickly, Aziz said, is it all software that can be capitalized or just just software held for sale? It's simply for any software that you have under US GAAP is the one that you can actually even capitalize, right? Under US GAAP. So Sam, you have the floor.
Okay, good afternoon, sir. So just two quick ones. In the mock, I've seen some questions whereby they give us some ratios and they expect us to get like return on assets and return on equity and the rest. So that that 5-step DuPont analysis, I don't know if you can just touch on it, because it can be tricky at times whereby they want us to get a certain figure and they will give you some certain ratios. I'm trying to think of a question I can just bring up now, but if we can just help us touch how we can easily work on that DuPont one. And lastly, aside the two free mocks on the on the portal, how many more mocks would you advise us to do? Some people say 3 or 4 more mocks. I just want to ask your opinion. How many more mocks do you think we should do aside the free one online?
Okay, to me, see, the more mocks you can do, the more the better, the more the merrier, right? That's why I always say that it's always good. I always advise my students, right? That is always very good for you. The more questions you can practice, the more the merrier, right? So at a minimum, 2 or 3. But of course, know that when you are saying that you are doing mocks, it's not only the questions that you are practicing. You need to practice as many more questions as possible. Okay? Now, so let's look at your DuPont analysis briefly. So your ROE, remember that your ROE is your what? Is your, let's assume that, let's use PAT. You can use PAT blocks. You can use, let's use PAT divided by your shareholders' equity. Okay? So this is your ROE. Now, remember that okay, good. This is your PAT divided by your this is your ROE. Remember, now think about it this way, that your PAT, we can break it down into 2, which is your profit after tax divided by your what? Total assets. Remember that this is your ROE, right? Cool. And I can multiply it by your total assets divided by your what? Your shareholders' equity. So this is your two-way DuPont. Now, your two-way DuPont here is looking at yours, because think about it this way. If your total assets here, total asset counts total assets here, that means that I'm left with total PAT divided by shareholders' equity, which is same thing that what I have here. So meaning that I can say that your return on your ROE is the same thing as what? Your ROA, which is this ROA, multiplied by your leverage ratio. Okay? So this your ROE is looking at your what? What is the return I'm getting from using that particular asset? Now, this ROE, I can break the ROA further to say that, look, your ROA is the same. I can say that your ROA is simply your okay, I can break it further and tell you that, look, your return on assets, okay, set your ROA is your so should we use them? Okay, I'm break it further to get your 3-way DuPont and then also get the 5-way DuPont. Okay, so for the 3-way DuPont, right, what I'm doing now is to break down the ROA further into your into the distance together. Okay. Now here, what I will do is to break the ROA further into the proper driver, right? Good. Now here, I'm breaking it further into your assets turnover and then your net profit margin. Remember, your net profit margin is your what? Your PAT divided by your what? Revenue of your sales, right? And also remember that your revenue, your asset turnover is the same thing as your what? Your revenue divided by your what? Total assets. I'm sorry, divided by your what do you call it? Yeah, this was the total asset exactly. By total assets, and then I now have your leverage, which is what? Total assets divided by your what? shareholders' equity. So your three-way DuPont is simply breaking it down further into what? Your return on revenue, or your net profit margin, rather, and then your what? Your asset turnover, and then your what? Your what do you call it? Your leverage ratio. Okay, so this one is your three-way DuPont, right? And this is, of course, you agree with me that here, if we can break it, if we can actually even cross, if we can actually, you can see here that look, your arrow here, where's my revenue can cancel my revenue here, right? Oops, so my revenue can cancel my revenue here, right? And then my what do you call it? My total asset can also carry and cancel out my total assets, such that I end up with what? My what do you call it? My I end up with my what do you call it? My profit after tax divided by what? By shareholders' equity. So is it clear now?
It's clear, sir.
Okay.
So I actually once saw the question that gave me an issue. So I don't know if there's time, whether I just quickly share my screen, but if there's no time, it's fine. It's fine.
Okay, not a problem. What I will do is that I will drop my number. So if you have any question, you can actually reach out to me offline, and then we can actually even look at it. Then we can look at it, we can talk about it, right? One-on-one. Okay. Good. Now, okay, there's a question here on goodwill. Now, how many years is it amortized? Please note, I think I should have mentioned it. Please note, goodwill is not amortized. Goodwill is only tested for impairments. Now, let me even now explain to you, how do we get, what does goodwill mean? And how do we come about? I think I mentioned to you that it come about during acquisition. How does it get on the books? Now, if I want to acquire a company, the standard says that, look, I must get the first thing I want to do if I want to acquire a company, right? I must get the value of all the assets of the company and get the value of all the liability of the company. Then when I get, and I now get to get the net value. When I get the net, which is your assets minus liability, which is giving the net asset of that particular company. Let's assume that the asset is total 2.5 million. The liability is 1 million. So the net asset is 1.5 million. Now, I need to now compare how much I want to sell those assets, because I want to pay for that particular company rather. Remember that oftentimes the amount that you pay for a company is oftentimes higher than the value of those net assets. Now, please also note the value of the assets you are getting, that's the fair value of the asset, not the book value. The fair value of the liability is also the fair value. Now, oftentimes, like I mentioned, the amount that you are paying will be more than the net asset of that particular company, more than the 1.5. That's the net asset of that particular company. Why? Because if that company is a going concern, I need to induce the owners of the company to pay, to actually even let go of those assets. Because if the company is not in trouble, there's no reason for the owners of the company to sell it. So the excess of what I pay above the net asset of the company is what we call goodwill. So for this example now, let's assume that, we mentioned that the net asset is 1.5 million. If I end up paying 2 million, that difference between 2 million and 1.5, which is 500, it is what we have, is what we call 500,000, is what we call goodwill. That is how good we get into our books. And remember, for me paying that 500,000, I expect that the benefit that I'm going to get in the future will justify the additional 500,000 that I'm paying for those assets. So every year, right, what we now need to do is to check, do I think I will still be able to get additional benefit towards that 500,000? If the answer is yes, then that goodwill is fine. However, if I think that things are different, or I might not be able to get that benefit that will be up to 500,000, then I can say that that goodwill is what? Is a bit impaired. Then if it is impaired, then I will reduce the value. But if it is not impaired, I will keep on right, that goodwill will remain that 500,000 on my books. Okay, so goodwill is not amortized, it is only tested for impairment yearly. Don't worry, when you get to level 2, the first topic that we're going to do is intercorporate investment, right? And then we'll talk a lot about goodwill and then how to account for goodwill impairments. Okay, right. Yeah. For a spin-off, you said it should be removed from the balance sheet. What is the double entry effect? Good. Now remember that look, once you remove it from the what do you call it, from the asset, it will also have impact on the equities, right? Because remember that you're going to also remove the value from the equity, because that means that look, the shareholders are already getting some value from what they've actually even worth. Because remember that the shareholders are practically those that own the asset. So when you distribute some of the assets to that particular company, it will also have impact in the what? In the paid-up capital of that particular company. Okay. So any other question? Any question? Any other question? Right. I know that the time is very, very short. So let me give you my phone number, which is also my WhatsApp number. So if you have any question, you can actually even take it offline, and then you can reach out to me in your preparation. Please try and study as much as possible. Even by now, you should be focusing more on revision, right? It should be done with the proper routine. Okay. Thank you very much. All the best in your exam, right?
Thank you very much, Ayokule. Thank you so much. Thank you for always turning up for us. We really appreciate. So to everyone, tomorrow's section starts exactly 12 p.m. So I'll hopefully see you guys by then. Best of luck. I hope those that need Ayokule's number has taken that from the chat. I'll be closing the room now. So bye everyone. See you tomorrow.